Welcome to the rapid revision course in the subject of strategic financial management. A very important paper in group 1, and as the title goes, it is meant for revising rapidly. Now finance is a very vast subject and students often find it difficult to complete their studies well before the exams. As a result, when they go to do the first and the second revision, and some of the most important topics are left out, and the backlog is created, which becomes a burden on the last day, and students have to catch up with time. It's hardly possible. In fact, it is very difficult. As a result, they go to exam preparing only 70%. Now, to overcome this course has been designed so that in a short possible time, all the concepts which are required for the examination from all the chapters are covered. The course runs for around 40 to 45 hours. So if you are able to devote say 14 hours per day, so you are able to complete approximately 3 days. Now the course has been designed in such a way that it will help those students who have prepared at least once. So if you are not prepared at all, then also this course will be useful. Why? Because so many places I have explained the concepts from root, from the base. But this is not there for all the chapters, only for a few chapters where it is required to teach from the base. This course is best for those students who have studied SFM at least once. Let it be 1 year ago, let it be 6 months ago, let it be 1 month ago. So if you want to revise rapidly the entire paper, then this is the absolute course package which you are asking for. If you are able to complete SFM in 3 days, what else you want? Now, the problems which are selected in this course have been created and designed in such a way that almost every concept of SFM is covered. So how is this course? Let us see. Now after you complete this introduction video, you will select chapters. Now the order of selecting chapters is with you. I am not recommending that you should do this chapter first or that chapter first, because I told that I am expecting students who have studied SFM at least once. But I am giving a number for chapter. Now if you want to follow that particular order, you can follow the number. For example, derivatives futures is number 1. Derivative options is number 2. So this number would be there, which will help you to complete in a particular order only if you want. It's not a compulsion. So you can follow in that order and complete your studies. So first there will be chapter summary, where entire concepts pertaining to the chapter will be covered. I am speaking about what are the kinds of problem generally comes, how many problems have been asked in percentage terms. I have spoken about it. So it will give you a fair idea how much you should expect from which part of the chapter. After you go through the entire chapter summary, then formulas have been explained. So every chapter, wherever formulas are there, so they have been explained one by one. What is this formula, why we use, when we use, etc. Though formulas also appear in the chapter summary. So when you listen to only formulae, it is a revision of formula actually. After you complete the formula, then the problems are selected. So question is read first and then the solution is shown. Now when the solution is done by me, I've explained the concept once again. So when you listen to chapter summary, it is a revision. Then formula, it is a re-revision. And when you listen to solution of problems, it is a re-revision. So here in revision course itself, we have done certain things repeatedly. So that's how you actually master something. So when we come to problems, first I read the question. When I read the question, you may pause and solve for yourself in case you are ready, prepared, confident. You can solve for yourself, then see the solution. Identify errors, correct. That is one method. Other method is see the solution also. I've explained so many concepts. After having understood, then do the problems. Because you will have a book with questions. Okay, only questions will be there. So you select. You can solve from the book and then see the video. So you will be able to identify the areas where you have gone wrong, where you have to improve, and there will be clarification of so many things, and that's going to help you a lot. Because this paper is all about understanding the concepts, and this course actually targets explaining the concepts with the example of with the practical problems. So you must get the best out of this course. Now I require and I request you to have a separate notebook. You can give the heading rapid revision course, separate notebook, new notebook. I don't think you should have more than 200 pages. So when you see every chapter, when I explain the concept, for example, derivative future, price of futures, I write the formula. So you write the formula, price of futures. So I will tell you have to remember this, you have to remember that. So that also you can write down. So as you see the video, you build up your notes. So if you do that, then that 45 hours may extend to say 54 hours. But you would have built a notebook, say for 150, 170 pages, whatever it is, which you can revise it on the last day. Means a last day notebook has been created by you. That is advantage. Because you would not be able to see this video on the last day. Last day, how much time you have? After FR paper, 1.5 days. 1.5 days subtract 10 hours. So you may be getting hardly 24, 26 hours. So what I'm trying to tell you is, when you see this video, build a notebook. Whatever you see, keep writing. If I write a formula, you also write a formula. If I tell this is for this, you also write this for this. Means, because I have covered everything in this course. Whatever is there for the exam, everything I have covered. So this notebook will cover everything for you. So have a separate notebook, build your notes. Write remarks wherever required. Keep a red pen, mark all the important ones. Now, preparing for CA final nowadays requires you to concentrate on what institute is telling you. Institute tells that we are going to ask questions based on sections. So when I actually try to show you this, so you can see section 1, financial policy and corporate strategy. So how much percent? 5 to 10%. Risk management. So section 1, So by studying risk management, you cannot get 20 marks. What is the maximum mark? They have never asked more than 4 marks from risk management. First section usually comes for 4 marks. Second section, see the chapters. Bond, portfolio, So there are two major chapters. So they cover, usually problems come for 8 to 24 marks from bond and portfolio. See section 3, mutual fund, derivatives. So if you are very good in mutual funds and derivatives, then section 3. So like that, you must understand what institute has provided you, section, understand the section and prepare a proper plan. Do not miss out. For example, you decide, no, I am not going to do portfolio. I am not going to do mutual funds. Example, I am telling. I am not going to do interest rate risk management. Means what you are doing is you are leaving one chapter in each section. Then it is very dangerous. Why? Because if the question paper comes with only those chapters, then gone. So try to cover 2-3 sections completely. Suppose you cover section 2 and 3 excellently, and section 1, 5 and 6 also you are done. Section 4 you are not done at all. Then you are not at big risk. Because section 4, even if you don't do entirely, 30%. So let us take 120 marks, 30%, 36 marks. 120 minus 36 is 84. So 84 marks you can attempt. So what I am trying to say, try to do one section fully. Okay, so understand. So when you are actually revising, you must have identified your weakness. Try to target entire section. Do not leave anything in a section. Okay. Now, after having understood the section, you know very well in which direction you have to prepare. So you know at this point of time, before you see the course, you know your weak areas. And those weak areas should be targeted properly. If the weak area is in section 1, means you don't understand risk management, you don't understand financial theory, not a big deal. 8 marks is the maximum you can lose. But if your weak area is section 3, mutual funds, derivatives, securitization, then you are going to take a risk of 24 marks or 28 marks. So then it is better if you can rectify it. Remember, when you are somebody doing rapid revision course, they are very close to the exam date. So I am not telling you should go and do right from start. No, not at all. If you are able to cover 80% of the syllabus confidently, then you are sailing through. Let the paper come anyway, because I have dealt in this particular course problems covering every concept. So do not bother. Understand whatever I am telling. If you are not understanding, rewind the video. Listen again. Write down. See the problems where I have solved. Understand them. At this point, you are not supposed to do anything new. So this you have to keep in mind. Now, I have covered almost every November 2020 questions in this video. So you would wonder why there is a bias for November 2020 questions. This is the toughest question paper I have ever seen in CA final exam. Why tough? Was it all out of syllabus? No, not at all. They were all absolutely bang present in the syllabus. But all questions were asked in the reverse manner. Instead of asking what is 1 plus 2, which is 3, they ask if my answer is 3 and one other number is 2, what is the other number? So they ask every question in reverse manner. They were lengthy questions. So I have covered almost every question from November 2020 paper. If I am right, arithmetically 9 questions I have covered. So total 13 questions were there. Somewhere repeat, I already covered the course. So what I am trying to say, this course has also taken into account the toughest questions which you could expect. I don't think you can, you can expect a tougher question. They were tough in the sense that they consumed a lot of time. They were not routine questions. They were not repeat questions. So what I'm trying to tell you is, even the toughest have been covered in this course. So when I in the beginning I would have told it is a November 2020 question. So pay attention to that clearly and try to work out on your own after you see the video. And it's very important that at the end of the course you must be knowing how to solve each and every problem on your own. If you are able to do it, then you can be rest assured you will fare well in the exam. Execution on the exam day is very important. You learn everything right from start to end, but if you don't execute well on the exam day, it is not good. See, that actually comes out of confidence. Now we are very confident that I have understood the concept and I am able to do independently any day, anytime, and that's what we want. And please understand one more thing. It is not important that your final answer should match. Even if you have done 80% of the question answers correctly, you get 80% of the marks. That is the beauty of finance. If you understand the concept and if you are able to reproduce 80% of the answer, you get 80% of the marks. As in so many students who are scoring 70, 75. When you see their final answers, 3-4 final answers are wrong, still 75 possible. Why not? So please understand that, suppose you are able to understand most of it, you must give a chance. So you must attempt it actually. Now, this rapid revision course do not cover theory. Now the course is designed to help those students who are struggling with the majority out of 120 marks. Let us take November 2020 exam. Out of 120 marks, theory came for 16 marks, 15 marks, sorry, 15. I am excluding choice. So 15 marks. So 120 minus 15 is 105. So this course is designed to cover 105 out of 120 marks, which is major. I'll give you some simple technique or secret. For theory, do securitization chapter fully. Do startup chapter fully. Do risk management fully. And the first chapter, financial theory. So the 4 chapters cover 10 to 12 marks. Out of 16 marks, you are securing 10 to 12 marks. What else you want? Suppose you want to do entire theory, then you should do all the chapters. But just for your information, mutual fund is a major theory chapter. One of the largest theory chapter after Forex. So mutual funds and Forex, if you do, then 9 out of 10 situations, you would be attempting all the theory. So let me revise what I told you. First chapter, that is financial theory and strategic management. Second chapter, risk management. Third chapter, securitization. Fourth chapter, startups, venture capital, that is the last chapter of your book. Mutual funds, Forex. So this will cover, almost everything. In portfolio management chapter, that is, if in your material you would have found, there is alternative investments. Not a single question has come till now. So you may go through it. So I have said everything about the theory. And you are deciding, I am not going to do theory. I don't want 100 out of 100 in SFM. I am happy if I get 65 or 70. Then you can take a chance, not do theory at all. But let me tell you, theory is not difficult. Securitization will take hardly 2 hours for you to complete. Why to miss out? One question will come every time. Every attempt on question has come. What else you want? 4 marks. One theory chapter of 10 pages you complete. Similarly, startup. Every attempt on question has come. At least do this, 8 marks will be covered. So the course is designed to help that 105 marks of the 120 marks. Okay, so you must actually get full advantage of the course. I repeat once again, have a separate notebook before you start the video of chapters. Keep the notebook, red pen, everything ready, calculator ready, and as I explained, just pay attention. You must be sitting in a room where there is no disturbance whatsoever. Concentration has to be full. Chapters which are large have been broken down into parts. For example, bond market, there are two videos. So you see part 1, part 2. Don't break it. Don't see bond market 1 and then forex 1. Don't break it. If you take a chapter, complete it. Let's get going. Let us do the chapter of derivatives futures. Now, how I'm going to proceed with every chapter, you must understand that first. Once I take a chapter, we are going to go through what are all the problems that can be asked in this chapter and the formulae that is going to be used. And when I'm going to talk about formulae, we are going to talk about concepts behind the formulae more than the formulae, because we have a separate formulae video that is following this particular chapter summary. So therefore, we are going to do the summary of this chapter, keeping in mind the problems that are going to be asked in the examination. What are all the traps that are usually set? What are all the common errors students do in the exam? We are going to keep in mind all these things. Now this will help you to protect yourself from making or repeating those errors. We are not going to solve any problem when I discuss the chapter summary, because the problems, selected problems, follow the formula video. So after you listen to chapter summary now, you will immediately go through formula summary. After that, select problems will be there, and you can read the problem, pause the video, solve and verify your solution, or see the solution of all the selected problems. Let the chapter end, then you practice all the problems. And the problems are given to you in hard copy or soft copy format. You can see the problems and solve. Now, this chapter of derivatives, that is equity futures. As I told, I am going to do chapter summary. It means absolutely dedicated towards writing exam. We are not going to talk about the definition, basics, etc. Remember, this is a rapid revision course. Rapid revision course. So I am going to rapidly revise all the things which are required. What are all the problems that can come? So problems, what you can do is you can write, as I write, problems which can come. Number one, price of stock. When you talk of price of stock, it could be simple interest, it could be CCRI, and this could be with dividend, this could be without dividend. Then price of index, this could be simple interest, this could be CCRI. So they may give dividend yield, with dividend yield, without dividend yield. They may ask about price of security, simple interest or compound interest. When they talk of compound interest with frequency given, so they will give whether it will be compounded monthly, yearly, quarterly, bi-monthly, etc. So these are about pricing. So pricing of security or pricing of futures. Now here remember I'm assuming futures. So these are all futures. So price of futures of stock, price of futures of index, price of, here you can say they may call it as future or they may call it as forward. So this chapter is about futures, derivative futures. So we are not talking about price of stock, we are talking about price of futures, of stock, of index, of security, like that. So these are all about pricing. You cannot expect a dedicated problem on pricing. You cannot expect that, because you know how many marks they can give, 4 marks. So you may get a small problem for 4 marks. Usually problems carry 8 to 12 marks. So you may not get a dedicated problem for pricing. Now, pricing is a main part of this chapter. Then you may get a problem on margins. Calculating or calculation of initial margin, verification of maintenance margin, applying variation margin, testing margin call, calculating gains or losses. So all this could be covering all, you can say this can come under the section of margins. For your information, just one problem has been asked till now. Therefore, very high chance that you may get problems on margins frequently. Especially the problem which I have selected for revision course. You must understand it very well. You can get a problem like that anytime soon, anytime. So pricing is one type of problem you can expect. Margins is the other. Third, now you have to pause the video. As you listen to me, first you listen to me, pause the video, copy. That is a better way. You can get a problem on arbitrage. When futures are overpriced, when futures are underpriced, Now in November 2008, if I am right, I don't recollect, November 2008 or June 2009, still 12 or 11 or 12 years have passed. They ask a problem on arbitrage. After that, they are not asked. I was expecting this exam, it didn't come. You must be prepared to see this problem very soon. Usually, you should be getting an overpriced futures problem. So one problem has been selected in the revision course and I have solved. You must go through it. So here we are going to discuss overprice, underprice, both. But I expect overpriced futures problem might come in the exam. So arbitrage is the third type. Now hedging using equity futures we are covering separately in a chapter. Now these are all the problems you can expect in the exam from this chapter. All put, if they ask arbitrage, you can get for 8 marks. If they ask margins, a complete problem you can get for 8 marks. If they ask pricing, you can 4 marks. A very, very important chapter actually. Derivatives is the foundation of so many other chapters later on, which you are going to see. So these are all the types of problems you can expect from this chapter. Now let us go through the concepts or the fundamentals covering pricing, margins, arbitrage. Pricing. Now you can write down, why I am telling you to write down, I'll tell you. After you write the FR paper and come for SFM, if you go through this again and again 2-3 times, in that 1.5 days time, it will help you immensely because I'm covering everything here. And I'm writing only the snippet summary. So this will save tremendous amount of time. You can devote the remaining time for solving important problems. And here we will be covering all the concepts. And so many things, usually I tell my students to write in red, mark important. Those and all I may not discuss completely, but though I'll be telling this, everything is important here. So therefore, there is no question of marking anything red. Everything is red. Right? Okay. So first, price of stock futures. Simple interest. Now we know it is simple interest. Whenever CCRI is not given, continuous compounding is not given, whenever exponential is not given, then use simple interest formula. So whenever CCRI not given, whenever continuous compounding word not given, whenever exponential value not given, use the simple interest formula. Now when you use simple interest formula, what is the price of futures? F equal to S plus SRT minus D. Now the dividend is on dividend is absolute, calculated on face value, paid are to be paid, sorry, on or before maturity. So you must remember these things. So they will give dividend 5 rupees. Okay, you can take it. They will give 10%. Okay, 10% of face value. If it is 10 rupee, so 10% of 10 is 1 rupee. Right? And it should be paid on or before expiry. So you must see these words, institute might confuse you. So if it is going to be price of stock futures, then we use this formula F equal to S plus SRT minus D. In overseas exam, they call it as cost of carry. They may give separately. Your R is interest, T is tenure in years. So S is price of stock. Today. So S is the price of stock today. I want to find 3-month futures price. So F will give me the price of futures 3 months hence. So therefore F will be equal to S plus SRT minus D. So this one formula you can expect, or you can use. Then rarely they may give dividend yield of a stock. I am not writing that. Rarely means once in 1 lakh times. So we don't, but remember they can give dividend yield. Then we have to use the price of index futures formula. So price of index futures, simple interest. So here it will be F equal to S plus SRT minus S into D by 100 into T by 12. So here also it is R by 100 and T by 12. So here this S into R by 100 into T by 12. So here D is dividend yield. Dividend yield of index. Now dividend yield of index, you must be careful. Now dividend yield of what? Dividend yield of same corresponding period of the past year. Same corresponding period. Suppose you are calculating January 1. You are calculating futures price of index on January 1. The future is going to expire on March 31st. So January 1 to March 31st is 3 months. Starting from Jan, ending in March. Now estimating dividend yield of index for future period is difficult. There are many companies in the index. Therefore, the practice in the market is to use the dividend yield information of the same period of the past year. So instead of assume that we are in 2020, so January 1, 2020 to March 31, 2020, that is the futures period. But I will not use this period dividend yield. I will use Jan 1 to March 31, 2019. I'll use the dividend yield as a proxy this year. So that is the practice in the market. The reason is getting dividend yield information for a period in future is virtually impossible or difficult. So dividend yield of index of same person, but you will not be bothered in the exam. They will give, but they make you like this: index paid dividend of 3% during the same period last year. So that is how they will give. It will be past tense, remember. So this will be F equal to F. So this is your formula for index futures. Usually this kind of formula will not use for stock, because for stock I will know the dividend absolute terms. For index, absolute dividend is not possible. Now, whatever is not possible in simple interest means simple interest is not given. They have given price of, find the price of security. Now we are going to do this. Price of security, compounding frequency is given. When compounding frequency is given, they are not writing continuous compounding, not continuous compounding. For continuous compounding, we have separate formula. So they are asking compounding. They will write, example, find price of 6-month security which has quarterly compounding, of interest rates. So now you can see they are asking 6-month security price, 6-month security forward price or futures price. Now 6-month security they are asking, is it paying simple interest? No, they have used the word compounding. Okay, is it continuous compounding? No, it is compounding. What is the frequency of compounding? Every 3 months, quarterly. So we use the formula F equal to S 1 plus R upon 12 by N raised to 12 by N into T. Now you have to be very careful. T is years, N is frequency. So what is the frequency? You are going to compound every 3 months, because quarterly means every 3. So how we are going to do? We are going to do F S, whatever S they give, 1 plus R, whatever R they give, 12 upon 3, then 12 upon 3 into 6 upon 12. You can see T is in years. So I have written here 6 upon 12. I have written here 12 upon 3. And then we should calculate. So this is the formula for your this one. So we have seen 3 formula till now. This one, simple interest stock. This one, simple interest index. This one, compound interest for security stock rates, whatever they give. Then we go to price of security. CCRI. Now it is not simple interest. It is CCRA. So F equal to S e raised to RT. So here exponential will be given. Exponential will be given compulsorily. Now just an important mark here, you can write approximate value is slightly greater than 1 plus RT. I can write here approximate value is 1 plus RT. Suppose they don't give, don't leave the problem. Approximate value is 1 plus RT. Use that and complete the problem. But they will definitely give. So this is for without dividend. Without dividend. Now if it is dividend, then what we do? F equal to S minus D e raised to minus RT, direct 1 into e raised to plus RT. So I am writing T1, T2. Now remember, this is with dividend. With absolute dividend. You can see this minus sign. Two minus sign. What is T1? T1 is dividend paid at T1 period from today. What is T2? Expiry of futures at T2 period from today. So S minus D e raised to minus RT1 and E plus RT2. So this is the formula we use for stocks that are paying dividend, and you know the absolute value. And it's absolute value 2, 3 like that, or 20% of face value like that. But if they give in dividend that is yield form, usually for indices, this is usually for stocks. Usually for stocks. Now we write usually for indices. What is that? F equal to S e raised to R minus D T. So R is a cost of carry, D is a dividend yield. So R minus D into T. So this is dividend yield of index or security. Suppose sometimes they may give stock dividend yield and CCRI. So then you have to use this. So CCRI we saw three formula, 1, 2, and next we see margins. Whenever you are entering into a futures transaction, buy or sell, for buy or sell, pay initial margin. Pay what? Initial margin. And once you enter into transaction, then maintain maintenance margin in the margin account. So you have to maintain that level. And if when it goes, we call it as MM. When margin account balance goes below MM, suppose maintenance margin is 10,000 and margin account balance has gone below 10,000, then what will happen? There will be margin call. So client will get margin call. On margin call, what you have to do? You have to pay money in the margin account. On margin call, client should pay money in the margin account. And bring it back to initial margin level. And bring it back. So here I write IM. So like that. So you have to see the problem. Refer solved problem. So this is what you can get from margin. Just one question has been asked. You can expect the problem which you have solved in the revision. Okay. Now last type of problem what you can get is arbitrage. What they will give you data to calculate theoretical futures will be given, and market price of futures will also be given. So how to calculate theoretical price? We know, we already seen S plus SRT minus D, any of the form. Usually they will give, usually it will come, usually simple interest problems will come. So first they will give you data to calculate theoretical price. So you calculate that. Then they will also give you market price. What do you do? Compare. What is it to compare? Theoretical price versus market price. Now there are two scenarios. Futures price or market futures price is greater than theoretical price, or market futures price is less than theoretical price. Now in this case we call it as overvalued. In this case we call it as undervalued. So they will give you data to calculate theoretical future. They will give you market price of futures. You have to compare. if market price of futures is more, then futures are overvalued in the market. In that case, what we do? Now, overvalued, whichever is overvalued, sell. So the strategy is sell overvalued asset. Therefore, sell futures. So you sell futures. Second, arbitrage is defined as a pair of transactions, I mean two transactions, one buy and one sell. So here you are sold, so you have to buy. In two different markets, futures market, stock market. So you are sold in future market, now you have to buy in stock market. Now when you want to buy in stock market, you need money. You don't put from pocket, no. You will borrow. Borrow to buy stock. Pay interest for borrowing. Number 4, since you have bought stock, you will receive dividend. Receive dividend. Remember, answer should be equal to market price of futures minus theoretical price of futures. So this is what you will do when the futures are overvalued. Futures market price is more. You can see here overvalued. So anything is overvalued, sell. Sell futures. So what is the other transaction? Sell. Opposite of sell word is buy. Opposite market of futures is spot. So buy stock. But you don't want to use your money. So therefore you will borrow. And when you borrow, you have to pay interest. So that you pay at expiry. Okay. Now this particular thing is solved. Refer solved problem. After this summary, chapter summary, we have formula video and then we have problems. Now what happens if futures are undervalued? So then you buy undervalued futures. So what is arbitrage? Arbitrage means buy two trades, one buy, other sell. So sell. So you have bought in futures market. So where you will sell? You will sell in stock market. So yes, you have sold in stock market, but what you do is you write sell stock. So buy futures. Okay, buy underlying future return. So here you are buying underlying future, you are selling stock. So what are the strategies you will do? Let me write down. Number 1, buy futures. Number 2, sell stock. But you may not have stock. So what to do? Borrow from stock market. There is something called securities lending and borrowing mechanism. Based on that, you can borrow stocks if you want to sell it. Okay, so you borrow and the institution will charge what is called as financial charges. So financial charges will be levied and then you have to borrow. Now in our beautiful world of calculating arbitrage profit, we ignore that. Okay, So when you do problem, you can see transaction costs are ignored. So you buy future, the opposite of buy is sell. Future is one market, other market is stock market. Sell stock. Third, deposit funds. Deposits funds from sale. So you deposit the funds. Why? See what you do? Bought future. Now you might be wondering why we are not taking margins and all. See, we are in the beautiful world of no margins, no STT, no cess, etc. So this you have to write as assumption. If you don't write the assumption, then gone, mark gone. So we are assuming that there is no charge and all. So here I will buy future, but I will not pay margin. I will sell stock. If I don't have stock, I will borrow from somebody, borrow from stock holding, borrow from market under SLBM mechanism. I will borrow and I will sell the stock. Now when you sell the stock, you get money, deposit in bank. Okay. Now finally, so bought future, sold stock, deposit funds, and record opportunity loss of dividend. Had you held the stock, you would have received dividend, but you have sold the stock. Since you have sold the stock, you have to record the opportunity loss of not receiving dividend. So in that case, if you do this, so this 4 will be written and answer again will be same. Answer. So before we close this particular chapter, let us see the format of both. Now this problem is solved. This problem is not solved. So let us see format of both. Format of overvalued futures arbitrage. So we do right here, just see activity. So you write here, sell futures, buy stock, borrowing cost, dividend. So this activity. So you'll be writing the cash flow. So after writing the cash flow, so you'll be writing again activity. Now what is the difference between this activity? This activity today. This activity expiry. Now at expiry you will do exactly opposite. Just see, here I written sell future, I will write buy future. I written buy stock, I will do sell stock. I have borrowing cost, I will pay it, paid. Dividend received. So I can do a net cash flow. So the net cash flow, here terms of F and S will cancel, you get answer. So when you see the solved problem, you will get some idea. Now, what is the format for format of undervalued futures arbitrage. So what is the format? Let us see. Activity today. Cash flow. Activity expiry. Let me write this clearly. Activity expiry. Cash flow. Net cash flow. So remember here the futures are undervalued. Therefore, what you will do? You will buy futures. Now, when you buy in futures market, arbitrage is a pair transaction, one buy, one sell. I will sell stock. Now, after you sell the stock, you deposit money. And then we have to record loss of dividend. Now, once you are writing activity today, you should write the opposite here. Sell futures, buy stock, deposit received, dividend paid, and then net cash flow. So this is a format you have to show. The solved problem will help you with the format, especially for the overvalued future. For undervalued, you should do like this. Remember, for both, we have to write one thing very, very clearly. For both, assume all transaction costs including brokerage, commission, margin, etc. are ignored. You must write this assumption. If you don't write the assumption, you get the 0 mark. Another important thing is, when you are writing in the end, when you calculate total of net cash flow, so it will be somewhat like FT minus 1000 minus ST plus 1018 minus 5, etc. Now you will be cancelling FT and ST, but you must know that we should write FT and ST cancel out due to property of convergence of futures. Due to property of convergence of futures. This is very, very important, as important as this. So I can tell in arbitrage problem, remembering the format of the table, very important. Writing the assumption of arbitrage, that is writing the assumption of ignoring brokerage, etc., very important. And writing that due to property of convergence of futures, FT and ST cancelling out is extremely important. So you see the solved problem where we have done for overvalued futures. Similarly, you should be writing for undervalued futures. Okay, so this completes the entire chapter. So we have seen that there are 3 major parts: pricing, margins, arbitrage. Now you can see the formula video and then solve the problem. And this chapter, expect zero question, or if at all they have to be doing, they should be giving one question of 8 marks. Usually 4-5 attempts, one question comes. Hope we are getting everything. We are going to see first derivatives futures. That is the order I teach in the class. So we are going to see first formula from derivatives futures. Now price of stock futures, we can see that we have to know the stock price, we should know the rate of interest, we should know the time to expiry, and dividend D should be known. Now remember, dividend D is in absolute terms. If dividend D is not given in absolute terms, suppose they give, stock gave 10% dividend, so face value 10 rupee, that's what we will assume normally. So 10% dividend means 10% of face value, that is 1 rupee. So whenever they give some percentage of face value, convert to absolute value and then substitute in this formula. So what we get will be theoretical price of futures. We know that theoretical price of futures is different from market price of futures. If market price of futures are more, then the futures are overvalued. If market price of futures is less, then futures are undervalued. And if it is same, they are fairly valued. Similar to formula of stock futures, we have of index futures. The big difference is stock declares dividend, but index does not. In stock, we account only for future dividend that is likely to be given by the stock. In index, it is not. We use past dividend yield and use it as a proxy for future. Since there is no absolute dividend in index and we have only dividend yield, so we will never have D in absolute terms in index. It will be always in percentage terms, and that also annualized percentage term. So therefore we can see that the way we apply for rate of interest, that is SRT divided by 12 into 100, we apply SDT divided by 12 into 100. Remember, cost of carry we pay cost of carry, but we do not pay dividend, we receive dividend, therefore minus. So in the pricing of futures, all costs are added to the price of stock and all inflows like dividend is subtracted. We see here also. So simplifying, we have got this formula. Now these two formulae are linked to simple interest. If nothing is given in the question paper, we should simply use simple interest formula, that is this one or this one. If we assume compounding, remember in the real world we use continuous compounding. Now you will not get a question in the exam on compounding, and that is only compounding. You will get only continuous compounding. But if they give a question in the exam for compounding, then we use this formula. Now this formula is simple formula which you have learned in school, compound interest formula. Instead of amount we have price of futures, instead of principal we have stock, and RT, we write raised to RT. So this is, you can see we do 12 upon n. So we give the same effect here also. If I am compounding one time in a year, then I do 12 upon 1. If I compound once in a year, then I actually do it one time in a year, means this will be 12 upon 12, that is R upon 1 and 1 into T. This formula actually is used to find the price of futures when we have simple compounding. I mean, it is not continuous compounding. But this is not used in the real world. Now we have learned in school amount is equal to principal into 1 plus r raised to t. So this formula, instead of amount we have futures, instead of principal we have stock, and 1 plus r raised to t. Now see, this r is adjusted for frequency, because instead of r we have 12 upon n, and here we have written r divided by 12 upon n. Now what does n mean? Suppose I am compounding every 1 month, then n will be 1. So every 1 month n will be 1, means monthly compounding. Suppose I am compounding every 3 months, so n will be 3, then it is our quarterly compounding. Suppose I am compounding every 6 months, so n will be 6, it is half yearly compounding. Suppose I am compounding every year, then n will be 12, then it is called yearly compounding. So this formula incorporates use of compound interest formula to find the price of futures with compounding frequency incorporated. So just once it has come in the exam, so we should be prepared that if they give compounding frequency, then we are supposed to use this formula. Next we come to pricing of stock futures, continuous compounding rate of interest. When you compound continuously, then the value simplifies to this exponential. So this exponential actually is the simplification of all the terms that will appear when you continuously compound. So whenever they give in the exam exponential value, or they use the term continuous compounding, or they use the term continuous compounding rate of interest, then you are supposed to use this formula to find the price of futures. But remember, here we are finding the price of stock, of that stock which is not giving dividend, so non-dividend paying stock. But if stock gives dividend, which has not, this has not been asked even a single time in so many years. If a stock gives dividend, then we will know absolute dividend. Remember, in pricing of futures, all inflows will have to be subtracted. So therefore we have this minus sign. And since dividend is going to be paid sometime in future, we should take present value of it. So therefore we take present value. So you can see this is present value, e raised to minus rt. So in continuous compounding world, present value means multiply by e raised to minus rt, and future value means multiply by e raised to plus rt. So what we do is, we take the present value here, you can see this part of dividend. Dividend is going to be paid sometime in future, but you are finding price of futures today. So this minus sign is for present value, and this minus sign is to account for the concept that inflows are to be subtracted. So you do s minus d e raised to minus rt, and then we take the future value of that. Now in the case of index, we don't have absolute dividend, we have only dividend yield, which is always expressed in annualized percentage terms. Since R is also expressed in annualized percentage terms, and R we have to pay and D we will receive, so we have R minus dt, a fairly simple formula. Till now, all the exam questions on index, whenever they ask CCRI, use this formula. It's a very important formula, frequently comes in the exam. Next we come to commodity futures. So in commodity, instead of minus D, now you can see here this minus D which is there, but here we have plus S. Now in stock futures, dividend is an inflow. So by concept we have to subtract inflows. In commodity future, storage is an additional outflow along with the cost of commodity. Since it is an additional outflow, so we have a plus sign here. You can see this plus sign. But storage cost may be paid sometime in future. But since you are finding the price of futures today, we want a present value. So this doesn't change. So we have S plus S e raised to minus RT into e raised to RT. As I told you, this has never been asked. Now same concept here also. R cost of carry you have to pay, storage cost you have to pay. So therefore R plus S. So there is no minus here. How to find the value of futures contract? You have to multiply n number of underlying units in each contract and price of futures. Now initial margin and maintenance margin in future contracts. We get problems on initial margin and maintenance margin, but most of the problem they give the amount straight away. Sometime, 1 in 100 times I can say, they might give standard deviation and they might give mean. Following the concept of normal distribution, taking into account 99.9% chances of no default. Using the normal distribution concept, initial margin can be calculated as mu plus 3 sigma. So instead of initial margin given directly as say 25,000 or 20,000, they might give mean and they might give standard deviation. And we are supposed to remember this formula, mu plus 3 sigma. And maintenance margin will be usually some percentage of initial margin. So these are all the formulae you have to learn from this derivatives futures chapter. And when you go through the refresher course videos, you will learn how to do arbitrage. There is no formula. Actually, we use the price of futures formula there. So it is a strategy. It is not a formula. So that you will learn from the problem which we have solved in the video. Hope you have understood all these formulae. Let us read this problem. Ram takes a long position on the first day of March in 3-month Nifty futures when Nifty was 11,000. The risk-free rate of return is 6% per annum. The dividend yield on this stock index over the past year was as under. So they have given all the 12 months. They have given dividend. You can see the past tense paid means the data is pertaining to last year or the past year, and monthly dividend yields are given. So if you take January, it is given as 1.2%. It is the average dividend yield of 31 days of January. Similarly, February, it is given 1.2%. Assuming it is not a leap year, we can say 1.2% for February is the average dividend yield of 28 days of the month. So like that, they have given average monthly dividend yield. Okay. Now calculate the theoretical futures price, and they have given us exponential value indicating that the rate of interest is continuously compounded. Now, in this question, all the information is provided. The real test is how to use dividend yield in the formula. So let us see how to solve this problem. So we have the formula theoretical price of futures I can write index futures is equal to F is equal to S. Remember, here we are given continuously compounded rate of return. How we know that? Because in the question they are given exponential value, means you are supposed to use the formula where the exponential value is involved. So our formula will be F equal to S e raised to, now dividend yield is given, so therefore R minus D. So R is a cost of carry which we pay, and D is a dividend yield which we receive, therefore R minus D, and both are in percentage annualized form, therefore we straight away subtract into T. So we substitute here. Now it is given that when Nifty was 11,000, so he is buying Nifty future when it is 11,000. So S is equal to 11,000 into E raised to R. Now risk-free rate of return is 0.06 or 6% is given, minus 0.014. So here you can write here C working note below into, it's a 3-month futures, so 3 upon 12. So here we do the working note, relevant period 3 months from 1st March. Therefore we use data of March, April and May. Therefore average dividend yield is equal to 1.3% plus 1.4% plus 1.5% upon 3 equal to 1.4% or 0.014. So we substitute this, then we do 11,000 into E raised to. So when you actually calculate, we get this whatever value they are given, and this will be 11,000 into 1.01157. This is given to us. Remember, you have to show how you have got this. So this step is extremely important. If you don't show how you got 0.01150 and directly try to substitute this, you will get 0 mark. So you must show how you got this, and now once you get this, and when we multiply, we get the answer 11127 approximately. You can put an approximation sign. So the theoretical futures price is 11127. Okay, so what all we are discussing this lot of things. Dividend yield of index, we never get today's value, we always use past data. Number two, we use the same data, same corresponding data of the past. Number three, we must know which are the relevant months, so we take the data of the relevant months only. Number four, we have to take the average. Number five, we must remember that it is always stated in percentage annual terms. Therefore, we must not forget to multiply by the period. In this case, it is 3 months, so into 3 upon 12. Once we do all this, we get the required answer the way we are done now. Hope you are understood. Let us see this problem. Nifty is trading at 10,500. Given that the risk-free rate is 6% and the dividend yield on Nifty is 3% per annum. Assume that the investor buys 8 contracts of the 4-month futures on this index today. What will be the gain or loss after 3 months on selling the above futures if index turns out to be 10,250 at the end of 3 months? Assume lot size as 25 units. Now, this is a very popular problem. They have not given the price of Nifty futures. They have given the price of Nifty index. And investor is buying futures. So therefore, our target is to find out the price of Nifty futures. Once you find the price of Nifty futures, you will be doing your first task. Then it is said that the futures are sold after 3 months. And again they have given the value of index at the end of 3 months. So you have to again find the price of futures at the end of 3 months. And then finally find gain or loss. And this kind of problem, if you try to do at great speed, you will generally end up with error. You will be taking the index value as futures price. So the best way is to read the problem slowly, understand what is given to you, and also note that they have not used the word exponential or continuous compounding. They are not given anything. So we are going to use simple interest formula. Let us see how to do this problem. Now, let us write the initial information. So given is, I am writing as today's price of index 10,500. Risk-free rate is 6%. Dividend yield, using a small letter, small d, 3%. Remember, these are per annum. Now, tenure is 4 months. It is a 4-month futures. Now, investor is buying 8 contracts of 4-month futures on this index today. Now, we don't know the futures price, but we can calculate index futures price. Then only we will know at what price he bought. Now, after he is buying, then what he is doing? What will be the gain or loss after 3 months? So he is buying index futures today. It is a 4-month futures. So we can say he is buying at F today. So we have to calculate F. Now F is given by this formula. Now remember, there is no exponential given. and there is no mention of continuous compounding rate of interest. So we have to use simple interest formula. So F equal to S plus S into R into T minus S into R into D. Sorry, S into D into T. So in this case, we will be calculating F by substituting S, R, D and T. So once we calculate this, we will get at what price the investor has bought. Then it is given what will be gain or loss after 3 months. So after 3 months will be here. On selling this future, now he is going to sell this future here. So F3M. So what will be the futures price at the end of 3 months? Now we will have to calculate futures price again when the index turns out to be 10,250 at the end of 3 months. So on this day index is 10,500 and on this day index is 10,250. He is buying here and is going to sell here. So we have to calculate buying price of futures and selling price of futures. Buying price of futures we get this. Now selling price of futures. Now after 3 months have passed, this 4-month futures will have only 1 month to go. So the tenure of future will be 1 month. There will be no change in dividend yield D. There will be no change in R. S is changing. It is 10250. So we will again use the same formula. S into R upon 100. Now here I will use 1 upon 12 minus S into D upon 100. Here again I will use 1 upon 12. Now in this case I will be using 4 upon 12. So this is the price of 4-month futures. This is the price of 1 month futures, that is 3 months from today. So let us calculate F. Let us calculate F3M. So he is buying at F and selling at F3M. Let us see whether F3M is greater. If F3M is greater, he is selling at a higher price. Else he is selling at a lower price and making a loss. And remember, they are given is buying and selling 8 contracts and each contract is 25 units. We'll do that later on. First let us calculate F. Therefore F equal to 10,500 plus 10,500 into 6 upon 100 into 4 upon 12 minus 10,500 into 3 upon 100 into 4 upon 12. When you calculate this, we will be getting 10,605. So he is buying at 10,605. Now let us see at what price he is selling. So let us calculate that. Now F3 months, therefore F3 months will be 10,250 plus 10,250 into R doesn't change but tenure changes to 1 month. The tenure is months left for expiry. So 1 month is left, so 1 upon 12 minus 10,250 into 3 upon 100, it doesn't change either, 1 upon 12. When you calculate, F3 months will be 10275.63. So this will be 10275.63. So investor is buying futures at a higher price 10605 and selling futures at a lower price 10275.63. So you are buying at higher price and you are selling at lower price, therefore you are going to make a loss. Therefore we can write, therefore investor is selling at lower price of 10275.63 as compared to buying price of 10605 for 8 contracts with each underlying 25 units. Loss will be equal to 8 contracts into 25 units into 10605 minus 10275.63. Since I have written loss, I am not arriving at a negative value answer. I am just writing loss. So we can do this. So this will be 8 into 25 into this difference. You get 65,875 approximately 65,875. So loss is 65,875. So this is a fairly simple problem where we were required to calculate futures price twice. At the time he bought and at the time he sold. You have to be very careful that they have given index value. They did not give futures value. And one more assumption you may write for abundant precaution, that is whatever futures price you are calculating, that is theoretical price. Now what is the guarantee that in the market the same theoretical price will prevail? So therefore one may write, we assume that futures are trading at a fair value in the market. Means you are acquiring license to tell that market price of futures is same as calculated price of futures. You may write, since the question doesn't state make necessary assumption, we have not written, else we will write, we assume that futures are trading fairly, therefore we can buy and sell at the calculated prices as done above. Hope you understood this. Let us read this problem. The share of X Limited is currently selling for rupees 300. Risk-free interest rate is 12% per annum. A 3-month futures contract is selling for rupees 310. Calculate the arbitrage riskless profit 3 months hence. Assume that X Limited will pay a dividend of rupees 4 in the next 3 months. So this is a problem involving arbitrage of futures. They have given the stock price today. They have given the futures price also. So first we have to explore whether there is a possibility of arbitrage and then proceed to do the transaction. And it is also given clearly that the dividend is given in the next 3 months. We know that if the dividend is going to be given beyond 3 months, then it is not applicable for us. Let us see how we solve this problem. Now, futures price is given by the formula F is equal to S plus SRT minus D. S is the stock price today. SRT is called cost of carry and D is the dividend. Now this is how we calculate theoretical future price. And when we compare this with market futures price, what is market future price? The price of futures quoted in the market. So we are doing theoretical calculation. We are comparing with market price of futures. If there is a difference, then the difference can be exploited. And it can be taken as profit. And that is what we are going to do now. Now, one simple way to understand this is, what if F market is greater than F? So this is your case A. F market is greater than F means quoted price of futures is greater than the theoretical price which you have calculated. So let us substitute for F. So F market greater than S plus SRT minus D. So what I did, I replace F with the components of F, the formula. Now I take everything to the left hand side. F market minus S minus SRT plus D greater than 0. And the sign of F market is plus. Now you can see ideally F market should be equal to F, ideally, but it is not. If it is not, then you can see that now we have plus sign here, You can see that if I sell futures in the market, plus sign, suppose I sell, there is an inflow. So therefore there is a plus sign. So I am writing sell futures. And if I receive dividend, again there is a plus sign. Plus sign means inflow, means I have received. Minus S. So I buy stock. When I buy stock, I have to pay money. So minus S. And I have to pay cost of carry. So minus. So therefore I will sell futures in the market and I will buy stock. And how I will buy? I will buy by borrowing funds. Therefore I will pay this interest. And if I buy stock, I will receive dividend. Therefore plus the. I repeat. So I can get greater than 0 means I can exploit the difference between F market and theoretical F. I can get that profit. How? If I sell futures, I buy stock, but I buy using borrowed funds, therefore I pay interest. And since I have bought stock, I will receive dividend. So plus F market minus stock price minus cost of carry plus dividend will be greater than 0. So this is what this entire problem is about. So how we are going to present it, I'll show. But let us see what happens the other way. B. If F market is less than F, see, only three things are possible. Either F market is equal to F, then there is no incentive to do anything, because F market equal to F, and just see, therefore F market minus F equal to 0. So I am not getting anything, no profit. But here I am getting greater than 0. So therefore we are doing an arbitrage and realizing that money. It is also possible when F market is less than F. So let me substitute F market minus F is less than 0. Or I'll put the other way, easier way to understand is, therefore F greater than F market, therefore S plus SRT minus D greater than F market. So I will bring this side. So minus F market plus S plus SRT minus D greater than 0. So again you can see that we are having greater than 0 like this. Greater than 0 means I am going to make money. But when you will make money, you can see this is minus sign. So you have to buy futures. Now we are having plus sign. Therefore you have to sell stock. Plus sign means inflow. When you get inflow from a stock, when you sell it, again you are having plus. So when you sell stock, use the money and deposit to receive interest. And when you have sold stock, you are not going to get dividend. So it is an opportunity loss. So therefore we have got minus. So by buying futures, by selling stock, depositing the money received on sale of stock, and accounting for opportunity loss of dividend, we will end up with profit. So this is what the entire concept of arbitrage is about. An arbitrager is an individual. Pay attention very carefully. An arbitrager is an individual who will look for mispricing in futures. He will compare theoretical price with actual quoted market price of futures. If market price of futures is greater than theoretical price, then futures are overvalued in this portion. So here futures are overvalued. Why? Because the market price of futures is greater than the theoretical price of futures. So whenever futures are overvalued, he will sell futures, he will buy stock but using borrowed funds, therefore he will pay interest. And since he has bought stock, he will receive dividend. And if he does that, he will realize profit. Similarly, when futures are undervalued, that is F market less than F, then he will buy futures, he will sell stock. If he is not having stock, he will borrow and sell. And we are ignoring the borrowing cost of stock for convenience. In real life, we have to pay the borrowing cost of stock. Here, if you are not having stock, don't bother, borrow, sell, and ignore the financing charges. So you will buy futures, you will sell stock, and when you sell stock, you will get money. Deposit that money, receive interest. And since you have sold stock, you will not be eligible to receive stock dividend. Therefore, by selling stock, you are losing an opportunity. So account for operating loss of dividend. If you do this, you will end up with profit. And this is what the entire arbitrage is about. And this problem is connected with overvalued futures. So let us see how we do. The calculation aspect and the presentation is fairly easy. Understanding the concept, what I did just now or what I explained just now, is important. So let us write down what is given to us. Stock price is 300. R is 12%. T is 3 months. D is 4 rupees. So therefore, step 1, theoretical price of futures S plus SRT minus D is equal to 300 plus 300 into 12 upon 100 into 3 upon 12 minus 4. So 309 minus 4, 305. Step 2, compare with F market, which is rupees 310. Therefore, futures are overvalued in market. Therefore, arbitrage possible. So at this point, you should write F market greater than F market minus F greater than 0, F market minus S plus SRT minus D greater than 0, F market minus S minus SRT plus D greater than 0. So when you do this activity, you put a plus. So plus sign indicates plus means sell slash receive. It is an inflow. Minus means outflow. Buy slash pay. See, plus F market. Therefore, I will sell futures. Minus S. Therefore, I will buy stock. But arbitrager does not use his own funds. Arbitrager will use borrowed funds. Therefore, he will pay interest. And he will receive dividend. So that is what we are trying in step 3. Now this need not be shown in the exam, but this you can do in the rough work and verify whether you are writing the correct thing. So step 3, arbitrager will sell overvalued futures. Remember, overvalued means sell. That is another way to remember. Sell overvalued futures buy stock using borrowed funds as part of arbitrage. So this is what you should write in step 3. Step 4, table. One more aspect of arbitrage is whatever position arbitrager is creating today, he will close at the end of 3 months, that is expiry. Means he is not interested in keeping the future position, stock position for himself for years. His job is at the end of 3 months, he wants to exploit. How much? How much you want to exploit? So here, you can write here, arbitrager will exploit difference equal to 310 minus 305 equal to rupees 5 as profit. He will exploit difference. 310 is market price. 305 is theoretical. This is market price. This is theoretical price. So 310 minus 305, 5 rupees as profit. So our answer should be 5 rupees. Arbitrager does not take any position home. He is simply interested in collecting rupees 5. Now please don't mistake that is for only for 5 rupees he is doing so much. Remember, each futures contract may be 1000 shares. Suppose he is doing 50 contracts. So 50 into 1000 into 5, and that's a big number. So that's how we have to see. Now table. Now remembering table is also very easy. We write activity today. So what activity is going to do? Cash flow accrual you can write, or you can just write simply cash flow. I'll explain. Activity at expiry. So he's going to do activity today and he's going to do at expiry. Cash flow, net cash flow. Rupees. Now what he's going to do? He's going to sell overvalued futures. Sell futures. Now what is the futures price in market? 310. So I show plus 310. Please understand, you must not mistake that he is going to receive 310 today. Futures contract are settled at expiry. Broker will write down plus 310 to this person. That's all. No money given taken. Margins are paid, but we are ignoring margins. We are ignoring STT. We are ignoring education cess. We are ignoring any brokerage, commission, etc. in this problem. We are ignoring finance charges if it is existing. So 310 will be accounted. It will not be paid or given to anybody. So we have to account. You sell futures plus 310. What you are doing next? You are buying stock. So these are all activity you are doing. And when you buy stock, there is an outflow minus. What is the stock price? 300. Now, are you buying using own funds? No, you are borrowing. So borrowed, and you are going to pay interest here. You're going to pay interest at expiry. That is SRT. So what is SRT? SRT will be 300 into 12 upon 100 into 3 upon 12, 9 rupees. So this will be 9 minus, you're going to pay. Number 4, dividend. So you're going to receive, company is giving dividend of 4 rupees. So plus 4. So these are what you will show in the table. Remember, arbitrager will not take any position home. Means what? If he has bought futures today, he will sell futures at expiry. If he has bought stock today, he will sell stock. If he has sold futures today, then he will buy futures. Now when he buys futures, the broker will say sold so and so price, bought so and so price, difference, pay or receive, that's all. So settlement on at the end of 3 months, the net accounting settlement will happen. Today, the actual cash outflow is only for stock using borrowed funds. So arbitrator has not put any money from his pocket, borrowed from bank, paid for stock, and created a sell futures position with the broker. Since he has sold futures today, he will do the opposite at expiry, that is buy futures. So for expiry, I will use T. So let us assume that FT is the price at expiry. But he has bought, so I will put a minus sign. Since he has bought, buying involves outflow, therefore I will put minus FT. This is for futures. Now stock. He bought stock today. At expiry, what is the opposite? Sell stock. Sell means plus inflow. Stock ST. T I am indicating for expiry. Stock price at time T. Now let us write the net cash flow. This will be 310 minus FT. This will be ST minus 300. This will be minus 9. This will be plus 4. Therefore, total net cash flow at expiry will be 310 minus FT plus ST minus 300 minus 9 plus 4. And we have a very important property of futures that is called convergence of futures. By convergence of futures, what is the convergence property? Convergence property says that at expiry, FT equal to ST. So whatever is the stock price, that will be the futures price. So FT equal to ST, so minus FT and plus ST will cancel. So this will be equal to rupees 10 minus 9, 1 plus 4, 5 rupees is equal to arbitrage profit is equal to difference between market and theoretical futures prices. And this is what arbitrager has got, the difference. And one assumption you have to write without fail. Assumption: ignore margins, commissions, STT, etc. This is very important. So we are in the beautiful world of zero transaction cost. So we can see that how an arbitrager is exploited. So just to revise, step number 1, calculate theoretical price. Step number 2, compare with market price. If they are same, stop. No arbitrage possible. If they are unequal, yes, possible. So if futures are more in the market, then future is overvalued. Anything which is overvalued, you sell. And when you sell futures, you do the opposite in stock market. You can remember that way. Suppose I sell futures, I buy stock. But do I use my own money? No. I borrow money and buy stock. So similarly opposite. Suppose I buy future, I do opposite in stock. I sell stock. If I don't have stock, borrow and sell. But ignore the financing charges like that. So step 3, we wrote the process. Step 4, we did the table. Two very important part in the table. Whatever position I created today, I destroyed at expiry. Means I reverse. Number 2, due to property of convergence of futures, ST equal to FT. Therefore, in the final calculation, they will cancel out. And we get the answer as 5, which is the difference between market and theoretical futures price. Hope you understood this. Better to practice couple of times, especially on the presentation. Let us read this problem. The settlement price of a Nifty futures contract on a particular day in a particular month on NSE was 8288.4. So the meaning is an investor had dealt in this futures contract and it was settled at 8288.40. Whether the investor had gone long or short is not stated at this point. But the settlement rate is 8288.40. The multiple associated with the contract is 50. So this is another way of telling the number of units in each contract is 50. The initial margin for the contract is rupees 30,000 and the maintenance margin is rupees 20,000. The settlement prices on subsequent 8 days were as follows. Now it is given subsequent 8 days. So you have to exclude today and maybe from tomorrow. So the 8 prices are given. By calculating the mark-to-market cash flows and the daily margin account closing balances, find the net profit or loss in the account of an investor who has gone long at 8288.40. So now you can get convinced that the settlement price of 8288.40 was actually pertaining to a buy transaction because they are given the word investor had gone long. The investor has gone long at 8288.40 and he is paying initial margin and maintenance margin, initial margin of 30,000 and the settlement prices are given. So let us see how we solve this problem. Now contract, the investor is going long at 8288.4. Whenever you enter into a futures contract, you are supposed to pay margin. Now that initial margin is given as 30,000. Once you pay initial margin and the contract value moves up and down, so there will be gain or loss. Currently you are long at 8288.4. If the futures contract value increases, then you will receive inflow into your account. There is no problem there. But if the contract value falls, then there will be outflow from your account. And if the outflow is such that the margin account balance cannot be maintained at 20,000, means margin account balance goes below 20,000, then you have to put funds in account and bring the account balance back to initial margin level. So what we have to do is we have to find out what is the change every day, and they are given that each lot is 50. So we will calculate mark to market loss as, suppose X is the closing level, X minus 8288.4 into 50. So this is for day 1. So day 1. Now day 1 it is 7968.4. So X is 7968.4 minus 8288.4 into 50. So this will be 7. $16,000. So this is mark to market loss. So very first day you have lost 16,000. You had deposited 30,000. So 30,000 minus 16,000 is 14,000, and it has gone below maintenance margin limit of 20,000. So therefore you have to put further funds in the account. So let us see how we build the table. Now mark to market loss is 16,000. So balance after is 14,000. Now this is below maintenance margin. This 14,000 is below maintenance margin. Therefore you have to add that amount, which will bring back the account to initial margin level. I will add 16,000. So this will come to 30,000. And next day we start with 30,000. Now 8429.4, sorry, 8429.7 minus 7968.4 into 50. So 23065. This is plus. So balance after mark to market loss will be 53065. This is sufficiently above initial margin level, so no margin deposit. 53065. So that becomes the beginning for the next day. So like that we can build the entire table. And we will get this as the final table. So we can see that whenever the margin account goes below 20,000, here it has gone here, you have paid margins. So balance after mark to market loss is an important column. So you know that it has gone below maintenance margin. So then only you deposit further margin and bring it back to initial margin level. So now what is a net gain loss in the end? Now there are two methods to calculate net gain loss. Now method 1, closing balance of margin, that is 64 margin account 64470 minus opening balance of margin account, that is 30,000. So this is closing, this is opening. So your journey started by depositing 30,000, you ended up with 64,470, therefore you gained this much amount. So this is 34,470. Now you deposited this much money, so these are outflows. So less margin deposits. So that will be 26,690. So 34,470 minus 26,690, 7780. Now you did not withdraw anything, otherwise you would have accounted for that. So generally whenever margin account balance shows an amount above initial margin, in real life you can withdraw. So here that withdrawal is not written, so we are not accounting, otherwise that also will affect this. So anyway we are getting 7780. This is one method of calculating net gain loss. So this is gain. Second method is very easy. Closing index value minus opening position value, whatever value you took a position, into 50. So this will be 8444 minus 8288.4 into 50. 8444 minus 8288.4 into 50, 7780. So we could have directly calculated and put it. Therefore they are given use mark to market losses and calculate, draw the table. In the exam you are supposed to draw this table and always use this to verify your answer, because sometimes addition subtraction would be wrong. So use this to verify. So it's a double check that our answer is correct or wrong. Hope you understood this. Let us go to the chapter of derivatives, option segment. Now, what are all the kinds of problems which you can get from this chapter? So first let us write the problem that can be expected. First, you can get problems on basics. When I say basics, on call option, put option, premium, break-even point, all those basics questions. Second, on strategies. Now when we talk of strategies, they are not asked till now by using the name. If I am expecting market to be very volatile and the prices are going to zoom, name the strategy. They are not asked that way. What they have done is they have given a person is buying call option and put option, and these are the range of prices. So find out. Like that only they have asked. So they are not asked by name. Though in the material they are given names, but till now they are not asked. So I'm going to cover some of the names. So that is very important. So that is enough to be learned. And third is pricing. And pricing we have got 4 things to be learned. Binomial model, 1 period. Binomial model, 2 period. Black-Scholes model, and Black-Scholes model for dividend paying stock. And in binomial model 1 period, we have got 2 branches: risk neutral valuation approach, riskless hedge approach. So let me expand and write here: risk neutral valuation approach, riskless hedge approach. So when you are talking of revision in this chapter, you must ask yourself, do I know everything of this? Now let me give you some history which will definitely help you to prepare. Now binomial model, Black-Scholes, let us come to Black-Scholes model. This was last asked in November 2008. But every mock test, RTP or whatever you call, they have been keeping on showing it there. But they are not asking an exam. It didn't come even in the toughest paper of November 2020. According to me, November 2020 was the toughest paper ever in CFL. Even then, they didn't ask by Black-Scholes model. Now, Black-Scholes model for dividend paying stock is tougher than normal Black-Scholes model. They have never asked this. Binomial model 2 period was asked in November 2020. Riskless hedge approach, I think they asked in the previous exam. November 19, May 19. I don't know the exact, remember the exact year. And risk neutral valuation approach, they have asked many times. So this is about pricing. So if at all you want to break the question paper, if I want to take November 08 to November 20, I can say 50% of the times they ask pricing, 30% of the time they ask basics, and 20% of the time they ask strategies. Going forward, this is going to be very important, pricing. Strategy, they may ask, now if they start asking by names, then sky is the limit. So that they are not done till now. And basics, they have been asking. Whenever basic question comes, most students, they are able to solve the problem. So this is what is, the structure of this particular chapter, what all you must know. Now, if you talk of November 2020 paper, they asked binomial model 2 period, which was asked previously in June 2009. So after 11 years it came. But according to me, November 2020 was an intentional tough paper. Deliberate attempt to, make the paper so tough that students actually sweat out too much. Because every question was reverse. Every question was lengthy. Every answer was lengthy. So that is an unusual paper. Okay. So this is what you must be prepared. Now let us start here. Now the problems, what is included in this revision package, they cover, I'm just highlighting it so that you understand. So riskless hedge approach is covered. BS model is covered. BS model for dividend is covered. Binomial model 2 period is covered. Now this appears in real options. This will be there because I wanted to use risk neutral valuation approach and real option, because remember, if you do every type of problem for revision, then revision will be as good as a full preparation. So when you go to real options, you will find risk neutral valuation. So the entire thing is covered in the package. This rapid course, revision course. Now strategies are covered, basics are covered. So if you go through the questions selected for this course, this will cover the entire chapter. Now let us see one by one the concepts what you have to master. First, call option. Call option gives you right to buy. The underlying asset, right to buy underlying asset at strike price X. So I want to buy an asset, I want to buy a stock at a price X sometime in future. Then I buy call option. So call option means, you must remember, right to buy. So when you see the word call, your mind should convert it to right to buy. Now what happens on the day of exercise? On the day of exercise, could be expiry day also, or could be before expiry also. Remember, here we have two types of options. One is American option, other is European option. American option, you can exercise anytime. Means if it is a 3-month option, you can exercise after 1 day. But if it is a European option, you can exercise only on expiry date. So you have to remember this way: for American, anytime exercise. So if it is going to be anytime, so on the day of exercise could be any day. If it is an American option, you can exercise tomorrow also. If I buy today, I can exercise at the end of the day. Like that. Could be expiry day. So therefore we are written. So call option, if you are going to exercise, then you are going to compare ST. ST is the price on the day of exercise, price of underlying stock. What is the price of underlying stock on the day of exercise? That is ST. If ST is greater than X, exercise. And if you exercise, your payoff will be ST minus X. The payoff is actually the gains. Remember, only when ST is greater than X, ST minus X will be positive. So only when ST is greater than X, you are going to exercise. So therefore you are going to make money. Means there is going to be gain if you exercise. If ST is less than or equal to X, do not exercise. Then payoff will be 0. So call options, you will exercise when ST greater than X. Do not exercise when ST less than or equal to X. Now if you want to include profit into account, so sorry, premium. Now what is premium? Premium is paid upfront while buying the option. While buying the option. So if I buy an option, I have to pay a premium. Non-refundable. So when you buy option, you pay premium. It's not refundable. So when I exercise, so I will get some payoff. And from that payoff, I have to subtract premium because it is a payment which I made while buying the option. And this will give you profit. So profit is nothing but whatever gains I made on exercising less whatever I paid while buying the option. Now this is when you exercise. So this is going to be greater than, this will be maybe, in this case, payoff is greater than 0 if you exercise. If you don't exercise, then profit will be 0 minus premium, means it's going to be loss. This could be a loss or gain or break even. Why? Because if the payoff is 8, premium is 8, then it will be 0. Payoff is say 6. Suppose payoff is 6 and 6 minus 8 is minus 2. Suppose payoff is say 10 and 10 minus 8, 2. So depending upon payoff, profit would be positive, negative or 0. But if that is for exercising, and see this for exercising. But if it is not exercise, means entire premium is gone. So then the premium paid will result in a loss. So this is all about call options. Similarly, we have put option. What do put options give? Put options gives right to sell the underlying. Now you have to read put means right to sell. So whenever you are reading put option, you must think, oh, right to sell. So put options give you right to sell. So right to sell the underlying at strike price. So on the day of exercise, we have ST as the price of underlying. So if X greater than ST means what? I got a right to sell at 100 rupees. Suppose this is 100 and the price in the market is 70. Why I will sell in the market at 70 when I am having a right at 100? So X greater than ST, you exercise. But if X is less than or equal to ST, suppose ST is say 100 or 120, then I will not exercise. So not exercise. So this is what you must remember for put option. So your payoff here is X minus ST. So whenever you exercise, X will be greater than ST, then X minus ST will be positive. So payoff will be X minus ST. In that case, my profit will be payoff minus premium. Again, the same thing holds good. It could be positive, negative or 0. Suppose the premium is say 6, then this could be 6, this could be 8, this could be 4. If it is 6, 8 minus 6, 2. If it is 0, 6 minus 6, 0 or minus 2. The profit could be, either you make a loss depending upon how much premium you have paid. But this is for when you exercise. When you don't exercise, then what is the profit? When you don't exercise, payoff is 0. So payoff will be 0 minus premium. So this will result in loss. So whenever you don't exercise call or put, premium is a loss. So what is call option? Right to buy. Put option? Right to sell. When you exercise call option, so call exercise ST greater than X. Put exercise X greater than ST. So this is a real mantra of call and put. Remember, solve all the problem of call from the point of view of ST. Solve all the problem of put from the point of view of X. Suppose they give you problem on call. Then you have to think, is ST greater than X? Is ST less than X? Is ST equal to X? Like that you should talk. So if they give you a problem of put, then see, is X greater than ST? X less than ST? X equal to ST? Like that you should see. Okay, so you will be seeing this way. And in that case, the problem solving will be very easy. Okay. Let us now summarize what we spoke and we write in a simple form. Remember these things when you solve problems of call and put. First, call option. Always solve by comparing ST with respect to X. Payoff, you can write in a simple formula, max of ST minus X comma 0. So if you evaluate this bracket, you get the answer. If payoff is positive, exercise. So if greater than 0, exercise. Equal to 0 or less than equal to 0, do not exercise. Now, as far as put option is concerned, always solve by comparing X with ST and see whether X is greater, X is less, like that. Payoff equal to max, similar formula but opposite, X minus ST comma 0. If greater than 0, exercise. Less than or equal to 0, do not exercise. So call the number ST greater than X, exercise. ST less than X, do not exercise. X for put greater than ST, exercise. X less than or equal to ST, do not exercise. See, the purpose of this revision course is to ingrain in your mind the basic facts by repeatedly telling. Even if you know, there is no harm in hearing it again and again and again, because it will become a mantra which will come automatically when you solve problems. Okay, now let us write about break-even point. For call, the break-even point is X plus ST. For put, the break-even point is X minus ST. What do you mean by this? Means you will may in call, let us call this as BEP. In call, gains are made when ST greater than, sorry, I just written something wrong here. Premium, sorry, this premium. Gains are made only when ST is greater than break-even point. Input, again it is like that. Gains are made when X is greater than break-even point, or what you can say is, I'll take you, we have solved one problem with break-even point. Okay, so here I'll just show you. Suppose I have a call, example, strike price is 50, premium is 5, ST is say 56. So payoff is max ST minus X, 0, max 56 minus 50, 0 equal to 6. Premium is 5. So you are getting gains. So ST is greater than, here ST 56 is greater than X plus premium, which is 55. Similarly for put, X is say 50, premium is 4, ST is 45. So we can see that what is payoff? Payoff is max of X minus ST, 0 equal to max of 50 minus 45, 0 equal to 5. What is premium? Premium is 4. So gain 1. So we can see that X is greater than ST plus premium. So X is 50 and premium is 45. Sorry, ST plus premium is 45 plus 44, 49. So this gain we are seeing. So we wrote that. Now here, instead of writing, I will write ST greater than X plus premium. So we can write that way. X plus premium. And here also, here we will write ST plus premium. Instead of writing break-even point, because when you exchange sides, it will automatically tell you. So ST greater than X plus premium. So gains are made when ST is greater than X plus premium. Here gains are made when X is greater than ST plus premium. So call and put. So you always think call from ST's point of view. Always think put from X point of view. That's all. So this is quite important. So this whole entire thing is covered in basics. So 30% of the questions have come in this section. One of the most easiest. So we have got some problems. When you go through it, you'll be able to understand. Just master those problems. You know, the way we present and solve, that is enough. Absolutely enough. Now we come to pricing. Now, when we talk of pricing, I said there are so many things you must know. Binomial model, one period. Binomial model, two period. Black-Scholes model. In Black-Scholes, you got two branches. Stock not paying dividend. Stock paying dividend. In one period, we got two branches. Risk neutral and riskless hedge. Now this is explained in the problem completely. So we won't do it here. When you do the problem, you have a practical example, you will be seeing it. So we will discuss this. We'll write the formulas for this. Even this is explained very well in the problem. So what I done when I solved the problem, it was not just for solving. It is not just writing down the answer. I have explained the concept in detail completely. So we will write down all these things. Similarly, two periods. So this is what you must know. If you master this, then pricing, which is accounting for more than 50% of the options chapter derivatives, you'll be thorough. Now let us check risk neutral valuation first. Now, as I told, risk neutral, you will find in capital budgeting, real options in capital budgeting, risk neutral valuation approach. Remember, we are doing for one period now. Now how we do it? Suppose there is a stock. This stock can go up. So then what will happen? S into 1 plus U%. This is called SU. Or it can go down. Therefore minus D%. So this will be S into 1 minus D%. This will be SD. So the stock can go up or go down. So stock is going to be uncertain. Now this is uncertain. Now there is something which is certain. Suppose I invest this money in bank. So I will get rate of interest R for period T. Now this is your uncertain. This is your certain. If I want to use CCRI, I will write S e raised to RT. Now risk neutral valuation approach. Now you can see this very important word, neutral. Now it says that we are neutral between these two. We are neutral means we treat this uncertain one and certain one equal. That is the crux of this approach. Now if P is a probability of stock going up from S to SU and 1 minus P is the probability of stock going from S to SD, then what is the return you will get? You will get P into SU plus 1 minus P into SD. So P into SU, 1 minus P into SD. Remember, risk neutrality makes me put equal to sign S into 1 plus RT or S e raised to RT, depending upon whether they are given you simple interest or CCRI. Now this is your stage 1. Now by solving this, by substitution of S, SU, SD, R, T, we get P 1 minus P. Because SU will be given to you. This will be given, this will be given, this will be given, this will be given, this will be given. So what is left? P is left. So you get P. You can get P and 1 minus P. This first part. Now the derivative as don't have life on its own. It is dependent on the underlying. If the underlying is going up, see, underlying is going up with P probability and underlying is going down with 1 minus P probability, then derivative also will go up. See, derivative call will go up with P probability and derivative will go down with 1 minus P probability, because call option is the derivative of S. If S goes up with probability of P, C also will go up to CU with the probability of P. If S goes to probability of 1 minus P to SD, C also will go down to CD. Second stage, we apply this. Second stage. So we apply C, CU, P, CD. 1 minus P. Now what is CU? CU, we know the payoff formula, max SU minus X 0. What is CD? Max SD minus X 0. So you will get this. So what is the therefore value of call at expiry is equal to PCU plus 1 minus P CD. The probability into CU 1 minus P into CD. It's a value at expiry. But I want value here. So take the present value. Therefore, value of call today will be P into CU plus 1 minus P into CD upon 1 plus RT or E raised to RT, depending upon CCRI or. So this is how we find the value of call. If it is CCRI, we will write C is equal to PCU plus 1 minus PCD into E raised to minus RT, because E raised to RT below will go up. Okay. Now this is how we calculate the value of call option using binomial model, risk neutral valuation approach. So first, what is this? Just revise the step. First, find SU, SD. Then let P be the probability of stock going to SU. 1 minus P be the probability of stock going to SD. Therefore, P into SU plus 1 minus P into SD is the value of your investment in S after some time T. S will go to SU when? After time T. S will go to SD when? After time T. So P into SU plus 1 minus P into SD is what? Your value of your investment in stock after time T. So we do this P SU, this we do. And we are assuming risk neutrality, means we are trying to be neutral between uncertain risky investment and certain risk-free investment. So this is a risk-free investment. So therefore I am equating it. Just see, this equal to sign is a powerful symbol which equates risky returns with riskless returns, which helps me calculate P and 1 minus P. And then I use this P here. I use 1 minus P here. I calculate CU here. I calculate CD here. So I got all this. So I get the value of call at expiry. And when I divide by 1 plus RT, this is value of call at expiry. When I divide by 1 plus RT, I get value of call today, which is our answer. So certain terms which come in the exam along with problems that we are going to see now. Why? Because then I will use those sentences here. First is ITM, ATM, OTM. This is in the money, at the money, out of the money. Please understand, these terms are used to convey or to tell somebody what is the relationship between S and X. It is just to inform somebody what is the relationship between S greater than X, or S equal to X, or S less than X. Suppose I want to tell you that S is greater than X. Remember, it is a call option. Suppose I have bought a call option and I want to tell you S is greater than X. Now remember, it's a call option. S is greater than X means I'm going to make money, yes or no? In case I exercise today, I'll make money if it is a call option. So when I'm going to make money, it is called in the money. So instead of telling that S is greater than X, I will tell you, hello, my call option is in the money today. Means indirectly is telling the stock price in the market today as of now is greater than strike price. So it is a, you can say, a shortcut or a kind of a message you want to give in short. So if I want to tell you that I have purchased a call option and I am making money, then I will use the word in the money. So in the money means I am making money. When you will make money, S greater than X. And if S is equal to X, I will tell I am at the money. So suppose somebody comes, hey, what call option, what happened? No, yaar, I am at the money. Means what? Strike price is equal to stock price. Then you will ask, do you expect it will go into in the money? Yes, that is my expectation. Therefore, I am holding the call. If S increases, then I will exercise the option. That's how you communicate. So we use the word ITM, ATM, OTM when we talk, when we write a report, when you actually convey. Similarly, you bought a call option, what happened? Oh yeah, it is out of the money now. So out of the money means I am not making any money. So ATM is making money. This is even. So losing money. So when you are losing money in a call, when you will do that? When S is less than X, it is OTM. Now similarly for put. In put, when you will make money? When X greater than X. When you lose money? When X less than S. When you will neither lose nor gain, X equal to S. See carefully, for call I wrote, S first. For put I wrote X first. So this is not by heart. This is your ITM, ATM, OTM. In the exam, now I am coming to this risk neutral binomial pricing. So they will give the option is currently at the money. The option is currently at the money. And they will give only strike price. Sorry, X. They will give only X. Now how to get S? So at the money, option is currently at the money means S is equal to X or X will do whatever it is at the money. So when the strike price is given, that is the stock price also. Okay, so this is very important, remember. So you must know these terms. So in the money means making money. Out of the money means losing money. At the money means S equal to X. That's all. Remember this way. Now come to another two terms which are very popular. That is intrinsic value and time value. Now intrinsic value is I write as IV is same as payoff. Now, what is the formula for payoff? If it is a call, it is max of st minus x comma 0. For put, max of x minus st comma 0. So IV is same as payoff. Now, the premium what you pay, which is also called price, which is also called value. Remember, all three are one and the same. Indians we use. And what premium you have paid? 5 rupees. When you go to overseas market, what is the value of option? So they use the word value. In some countries they use what is the price? At what price you bought call option? They will use the word price. So all three are one and the same. Remember, all three are same, one and the same. Now this is broken into two parts, IV and TV. TV is your time value. IV is intrinsic value. Intrinsic value is same as payoff. Okay. Remember, I am talking to those students who are doing revision. I am expecting all these things you know very well. But trust me, if I am talking very basic, please accept it. That is the correct way to approach. So revision, you see, a great learner is one who listens very well all those things which he has already mastered. I'm using the word which he has already mastered. Just listen. Now, when you listen, keep on listening, that clarity will emerge. Clarity and total conviction, confidence will emerge. Coming back to this, so premium, whatever is paid, is broken into two parts, that is intrinsic value and time value. Now, what is time value? Time value is simple formula. Premium minus intrinsic value. Suppose I paid 10 rupees and payoff is 6 rupees. So 10 minus 6, 4 rupees. So 4 rupees is the time value. Okay. Till now, not a single question has been asked on time value. But you must know how to find time value is easy. You know the total premium, you know the payoff, subtract. When I say payoff, it is intrinsic value. Okay. So time value, this is how you have to. So this is all about intrinsic value and time value. And couple of things you must know. At expiry, this is also very, very important. At expiry means what? The last day has come. The option is not going to have life after today. Means time value is 0. Is there any time to pass? Is there any time to pass? No, it is the last day. It is expiry day. After this option is not going to be there. So at expiry, no need to tell. It is a universal fact, like there is a sun which rises in the east and sets in the west. So time value at expiry is 0. Now, unless they give it is 0.01 something, that I told you that time value, not a single question has come till now. But remember, they may give find the time value at expiry, obviously 0. Now, intrinsic value could be 0. Intrinsic value could be 0 or positive only. It cannot be negative. Remember, can intrinsic value be negative? No, because I am writing max. Are you able to see max? The max word will filter out negatives. Suppose this is 95 minus 100 comma 0. So what is the answer for this? It is 0. So when you are not going to exercise, IV is going to be 0. It cannot be negative. IV can be positive. Similarly, time value. Can time value be negative? Obviously not. Because at expiry, the lowest value of time value is 0. So IV cannot be, so it cannot be negative. So also TV. Therefore, premium cannot be negative. Now I am telling you, I really bet such intelligent questions will never be asked in the exam. But I am doing revision to make your thought very, very, very clear. Summarize. Premium, what is paid when you buy an option, call or put. It also got other names, that is price or value. So it has got two bifurcation: intrinsic value, time value. Intrinsic value is another name for payoff. So we have the formula for call: max st minus x comma 0. For put, max x minus st comma 0. What about time value? Time value is nothing but total premium minus intrinsic value. Time value is 0 at expiry. Intrinsic value can be 0 or positive. Again, it cannot be negative. Time value cannot be negative. Therefore, premium cannot be negative. Okay, so let us move ahead. So we have seen this risk neutral valuation approach. Okay, now riskless hedge is covered along with the problem. So when you see the problem, you will get the concept, the problem, the solution. Okay, so binomial 1 period is done. Similarly, 2 period. So 2 period dedicated problem is solved. You can go through it, but I'll just tell you the concept, one concept which you must know. Though I may repeat the concept when I solve the problem. Binomial two-period model. This came in November 2020 also. I'm not solving the problem. I'm just telling you the concept. Now, before we do this, I want to caution. Now, before you let me actually keep this aside. Before we do this, we'll come to that. I want to caution on one thing. When you see suggestion answer, practice manual, whatever it is, they are using direct formula for P and 1 minus P. P and 1 minus P formulae. Do not use the formulae. I'll tell you why. Because you have to remember different formulae for exponential, that is CCRI, simple interest, and D will be given, D may not be given, U will be given, U may not be given. So all those problems will come. So do not use. What is our best method? P into SU plus 1 minus P into SD is equal to S into 1 plus RT or S into e raised to RT. Now I told you that SU will be given, SD will be given, or given U will be given. You can calculate SU, or SU SD can be directly given. S will be given, R will be given, T will be given. Then you can calculate this calculation. I bet even the worst mathematics student will not take more than 1 minute. Why to remember the formula and clog your brain? So use this method. Therefore, I am not insisting on remembering formula. This will automatically, when you solve this, now you will get formula. What formula you will get? When you solve this, now I request you not to write the formula, not to by heart. But if you have already done it, you are very confident, then I will show you the traps. Beware of the traps. See, when you do for SI, the formula will be R minus D upon U minus D. So R is rate of interest. So you have to write in decimals. D will be negative, remember. D will be usually negative. Therefore, this minus sign and this negative will make it plus. Same thing. This will be, this you will write in decimals. This also you will write in decimal. This also you will write in decimals. And you have to be remembering, they will give, sometimes they will give like this. The stock will go up by 10% and go down by 6%. Now go down by 6%. So where is the negative sign? They use the word down. So how you are going to write here? So you will write go down by 10% and go up by 10%, go down by 6%. You will write like this. Then it is a problem. So when you write wrongly, who will protect you? So these are now D's go down by 6%. So D is minus 6%, remember. So do not fall in this trap. I strongly recommend not to actually use the formula. But still I am writing this because they are given in the book. So you know, if it is CCRI, then another formula. So P is equal to E raised to RT minus 1 plus D upon 1 plus U minus 1 plus D. So in the November 2020 exam, you are supposed to use this. So who will use this? So I will calculate this P and 1 minus P from here. Easy. Takes 1 minute. No problem of minus, plus, nothing. Okay. So this I want to caution. Now coming back to 2-period binomial model. Now 2-period means there is period 1 and there is period 2. So period 1 say 3 months, period 2 3 months. So what is the total period? 6 months. And it is 0, 3 months, 6 months. Stock is here currently, S. Now S will go up. You can see here. So S will go up to SU, or S will go down to SD at the end of period 1. So it can go up to SU or go down to SD. Once it reaches end of period 1, it can again go up. It will go up by how much percent? U percent. Again it will go up by how much percent? U percent. So what is this? This is S into 1 plus U. What is this? This is SU into 1 plus U, which we call it as SU. Remember this U and this U. Similarly, once it reaches SU, it can go down also, minus D percent. So this will be SU into 1 plus D. Remember 1 plus D I am writing, but D is negative, minus D percent. D has a negative value. So these are all the problems you will face when you use the formula. So SU into 1 plus D will be SUD. So this U is this D is this. Similarly, once the stock reaches here, it can go up by U percent. So what will be that value? It will be SD into 1 plus U. That will be SDU. You can see D, U. Remember, they are equal. They are same. Why same? You can see first you are applying U percent, then you are applying D percent. So what is this actually? S into 1 plus U into 1 plus D. So now here first you are applying down percent, then you are applying up percent. So therefore what is this? S 1 plus D into 1 plus U. Are they not same? They are same. So this, you follow this route or you follow this route, you will end up with same value. So therefore SUD equal to SUD equal to SDU. Then once the stock reaches here, it can go down. So there will be minus D. So this is minus D percent. Further minus D percent. SDD is equal to SD into 1 plus D. You can see D, D. So we got S initially. It can go to SU or SD. Then it can go to SUU, SUD, which is same as SDU, and SDD. So these are two period binomial model. You draw the tree from left to right, but evaluate from right to left. So institute gave like this in November 20 exam. Institute drew this diagram for you. Diagram was given to you. This was also calculated for you. This was calculated and given to you. And they wrote node number 1, node number 2, node number 3. They wrote like this in the diagram. Usually I don't write this node 1, I write node 3, because when I draw the tree from left to right, I evaluate from right to left. Means I have to evaluate this first, then I will evaluate this, then only I will evaluate this. So when I evaluate, the Roman letter 1 will be node number 1 for me, but institute gave like this 1, 2 and 3, and they said evaluate and find the price of call option, like that they gave. So when you solve the example, when you see the problem, everything is explained. But this entire thing, diagram was given to you. So your job was only to, now as far as what is called as a formula is concerned, I have seen many students preferring to use the formula for two period binomial model, and I agree with it. Now if you are very confident about this, remember D is negative, so here you are having 1 plus D. So the danger of doing a blunder here is CCRA is less. Okay, D is negative, so 1 minus 0.95, like that you will get. So what I am trying to say in short, you can use formula for two period, because otherwise, it doesn't take, I'll tell you 1 minute extra you will spend, because you have to find the probability in the first case. Okay. Now coming back, so first what we will do, we will evaluate this node and we will calculate the call option CU the way we did for single period. Then we will evaluate this node and we will calculate CD. Then we will evaluate this node and calculate C. Means you will do 3 times, number 1, number 2, number 3. So one period model you will do 3 times. And when you do 3 times, you will get what is called as the price of the call today. Time consuming, let me tell you, it is absolute time consuming. They gave the diagram, they gave SU, SD, SUU and all, still it is time consuming. But if you practice, it is not. Okay. So this is all about binomial two-period model. So when you look at the problem, the remaining small things will get clarified. Now we come to put call parity theorem. Put call parity theorem states that when you have a stock and put option with a specific strike price, the value of stock today and value of put option, when you add, it will be same as value of call option with of the same strike price and present value of strike price. So if it is CCRI, we can write it as x e raised to minus RT. So this is put call parity theorem formula. Now after many years in the study material, you are finding put call parity theorem formula printed. Now whether they will ask, if they are yet to ask, but they have done one thing. There is a problem where you are asked to find the value of put option. I repeat, there is a problem where you are asked to find the value of put option. What you can do is, you can calculate the value of call option using binomial Black-Scholes, whatever it is, and then substitute the value of call, substitute the value of x, r, t, s, and find the value of put option. The put call parity theorem helps us to calculate the value of put if you know the value of call, helps us to calculate the value of call if you know the value of put. The purpose of put call parity, parity means equality. So it gives equality, it gives an equation where one side you have put, other side you have call. So in the examination, if they are asking find the value of put and you are sure that you can calculate the value of call, do it, no problem. After you find the value of call, substitute in put call parity theorem and calculate the value of put. This is acceptable as per your material, and obviously it is a truth, so you can do it. You can directly do also, that is a different thing. You can directly do. You can find the value of put. When you see the real options problem, risk neutral valuation approach, we have done that. You can go through, you'll understand. So put call parity theorem, this is the formula you must remember. Next we come to Black-Scholes model. Popularly called as BS model, and there are two parts. Stocks not giving dividend, for stocks giving dividend. If the stocks are not giving dividend, if the stocks are not giving dividend, then we use the formula call option is equal to, what is the intrinsic value of call? Intrinsic value means payoff. What is the value? S minus X. Now, how to remember this? Suppose you access a call. Suppose I am going to access a call. Because when you access a call, what you have to do? You have to give money, that is the strike price, you will get shares. That is what we access a call. When you access a call, what do? You pay money and you get shares. When you pay money at expiry. Now why I am using the word expiry, not before? Because Black-Scholes model is used only for European options. Now European means what? Those options which can be exercised only at expiry. So I'm going to pay money at expiry. So am I paying X today? No, I'm paying X at expiry. So what is the value of X today? Present value of X. So therefore we have X e raised to minus RT. So S minus X e raised to RT. Now what is the probability that you will pay X? And what is the probability that you will become owner of shares? Because when I pay X, I'll get shares and that S will be my money. So the probability is given by ND1 and ND2. So ND1 and ND2 are normal distribution functions. Now normal distribution functions. So this is actually, they are actually probabilities. So therefore, they will never be exceeding 1. They will never be exceeding 1. Probability, what is it? 100% maximum. So they will never be exceeding 1. So this you should keep in mind. Now, what is D1? D1 is natural logarithm of S upon X plus R plus sigma square by 2 T upon sigma root T. Remember, you have to be very careful when you calculate. And D2 is D1 minus sigma root T. Remember, when you calculate D1 and D2, you will see in the question paper, they will give n. Suppose you are getting this 0. So I'm just writing simple example. I'm writing 0.75 and 0.73. Assume. So in the question paper, you will find normal distribution value for 0.75 is something. Normal distribution value of 0.73 is something. They will give. Now they will give this value. So from here, you know that D1 is this and D2 is this. So in the question paper, D1, D2 will be given. Remember, D1, D2 is lower. Why? Because you are subtracting, okay? D1 minus something, some positive value. Therefore, D1, D2 is always less than D1. So D1, D2 will be indirectly given in the question paper. Now, once you calculate this, substitute, you get the value of call option. Now the challenge is to know what kind of normal distribution function they will give. For example, there are the two popular, I will discuss the two popular ones. One is cumulative distribution. Now what do you mean by cumulative distribution? Suppose I draw a normal distribution curve and now this is 0. Remember, this side is positive, this side is negative, right? Suppose you got D1 equal to 0.75. So 0.75 is a positive value, so 0.75 will come here. Now this area is 0.5, this area is 0.5 and you are getting like this. So I am going to find out, I want the area of this. Why? Because Black-Scholes model, you need area from the point, this point. You need area from the point till minus infinity. Till minus infinity. So from the point till minus infinity, we want that area. Now when they give cumulative, they will give entire area from 0.75 till infinity. and that only we have to substitute for ND1 straight away. So ND1 and ND2 is cumulative area from the point to minus infinity in normal distribution curve. So when you take a normal distribution curve, once you find D1, from that point till minus infinity, this is what you have to substitute. So one way is they can give this value directly by telling the word cumulative. So when they give cumulative means they are given area from the point till minus infinity. So straight away substitute. Remember, use common sense. Probability cannot be greater than 1. That is rule number 1. Second, see from 0, you can see from 0, now this point, you know it is 0.5. So if it is positive, you know the value is going to be greater than 0.5. Similarly, if D1 is negative, suppose D1 value comes here. Suppose D1 value comes here. So you know the area is going to be less than 0.5. So these are the common sense you must use. So if D1 is positive, you know ND1 has to be greater than 0.5. If D1 is negative, ND1 has to be less than 0.5. And D2 should be less than D1, because we saw that we are subtracting something to find D2 from D1. Now these are all the simple things you must keep in mind. Now what is the other kind of table? This is one table. They will give one tail. One tail distribution they will give. Now what is the one tail distribution? Let us see. Again I am drawing center 0. And this is 0.75. One tail means they will give this area. So this will be given to you. Tail. So they will give, usually they will give right tail only, not somebody asks left tail. No, they will not give left tail. If they give left tail, they will call it cumulative, because I want area till minus infinity, remember. So when you give one tail means they will give area from point to plus infinity they will give. So they will give this. But do I need this? No, I want this. I want this area I want. I want this area. Now what is the total value? Total value is 1, because probability cannot exceed 1. So total area is 1. So this is 1 minus V. So this 1 minus V I will substitute for ND1. So when they give one tail, they are giving value till plus infinity. I don't want plus infinity. I want from the point till minus infinity. So you must apply this common sense. So they will give cumulative, straight away use it, no brainer. But one tail, think. One tail means they are given tail. I don't want tail. I want this side. So total is 1. 1 minus. Okay, this is how you will substitute. And this is all about Black-Scholes model for stocks not giving dividend. Now if stocks give dividend, then what is a small modification you have to make? So that we will show here. If the stock is giving dividend, then you have to find S star. S star is S minus D e raised to minus RT1. Now what is S star? What is this? Let us first understand. Black-Scholes model, one of the assumptions of Black-Scholes model is stock is not paying dividend. But they are given the problem that stock is paying dividend. Then can I apply Black-Scholes model? I cannot apply. What I should do? I should remove the dividend from stock price. It's like, suppose I buy a 100 rupees share in the market and stock has given dividend of 2 rupees. Then what is the share price next day? Assuming everything remains constant, share price becomes 98, because 100 rupees today I got dividend 2 rupees. Next day, next dividend price is 98. So I remove the dividend, no? Is it not? So same way, here I should remove the dividend. So therefore we have minus sign. So I remove the dividend, but I should remove present value of dividend. So what is present value? So dividend is going to be at time t1. So I will have to do e raised to minus rt1 will be given to you. So you should calculate S star. And once you calculate S star, you substitute here and you substitute here. So you will not use S. You will use S star. Okay, I repeat. Whenever stock is giving dividend, we will be virtually using the same formula. But instead of S, we will use S star. What is S star? S star is that stock price where we have removed the dividend element. When we remove the dividend element, we must remove the present value of dividend. So they will give option expiry is 6 months. Dividend is going to be paid in 3 months. So our T1 will be 3 months and our T will be 6 months, remember. So they will give two exponential value when our dividend is involved. Sometime they will give D in dividend yield form. Then it will be S star equal to S star will be equal to S e raised to minus dt. So whenever they give dividend in yield form, then you should do S star equal to S e raised to minus dt. Okay, and then you have to substitute. So we have solved a problem. We're using dividend, so we can go through that. So that will give you total clarity. So now whatever I have written here, I'm sure you would whatever important you will be writing it, and that book, whatever you are writing, refer on the last day. Remember, I am covering everything here, everything. Similarly, when I do problems, I'll be telling. So you keep on writing. So when you write, you will be creating a revision notebook to be studied just before the exam. So this is all about Black-Scholes model with dividend. So they may either give, as I told you, after November 2008, 12 years have passed. Not a single question has come on Black-Scholes model. And what we call with dividend or with for stock not giving dividend or for stock giving dividend. Remember, when they ask put option, you can do directly this call option and then use put call parity theorem. So if they give BS model put option, find put. So find put price, suppose they give. Then you can do either of the two methods. Find call, then use put call parity. Or find put directly. Find put directly. Now when I say this, they have not given the formula in the material if I am correct, but I am going to make you write the formula. Here there is no two steps. Directly you get a value of put. Put is equal to, say call, what we wrote, call is equal to S minus X we wrote. Put we will write X minus S. We wrote here e raised to minus RT because I am going to pay at expiry. Here I am going to receive at expiry. Therefore e raised to minus RT. So I wrote here ND1. Here also I will write N, but I will write minus D1. Here I will write ND2. Here I will write again ND2, but minus D2. So this is the answer for put. So when you evaluate this, you will get answer. But the challenge for you will be, so you will calculate D1. Our D1 comes to 0.75. Then you must actually, suppose you calculate D1, which is 0.75. So you will have to actually, ND1 is this. But you want N minus D1. Now N minus D1 will be here, minus 0.75. So you want this area, remember. You want this area here. And this one will be required here. So ND1 will be used in call. N minus D1 will be used in put. Same for D2. So this trap is there, or you have to be alert. But best is this. Prefer this method. Prefer this method. So there is a problem. When you go through it, you will understand. So this is all about pricing of option. Now final part, that is strategies. Strategies, as I told you, they didn't ask a single strategy till now, though they ask in a short note. Write short note on straddles and strangles, like that they wrote. So let us see some of the strategies. Now when you are bullish, certainly bullish. When you are certainly bullish, you buy call. When you are certainly bearish, you buy put. Now this is what I am writing. You must remember for the exam, it is enough. When you are bullish, remember I am not using the word certainly. I am just bullish, I'll write the word not bearish. When I am not bearish, I will sell put. When I am not bullish, okay, this is a better way to write. So let us remove this. I will sell call. 1, 2, 3, 4. As I told you, they will not ask you straight away. They have asked 4 or 5 times this one. An investor was thinking stock will go up. He was also thinking stock will go down. Therefore, he bought call option and he bought put option. Obviously, when stock is going up, he will buy call and put. So evaluate the option for this price. That's a very simple problem. So in fact, buying a call and buying a put is called straddle. So when you buy call, buy put, both with same strike, it is called buy straddle. So you are buying a straddle. Buy call, buy put, same strike. They have given this 4 or 5 times already. But they have never asked the student what is the name of the strategy. Neither they wrote in the question it is a straddle. We just want to evaluate and get marks. I have explained there is a problem where I have explained a straddle. Now if it is different strike, it is called a strangle. So buy call, buy put with different strike is called strangle. So one short note came in the exam. Write short note on straddles and strangles. So let us see when you are using. Now you are written here, I am certainly bullish, I use this. When I am I use this, sorry. When I am certainly bearish, I use this. When I am not bearish, I use this. I written. So when you do this straddle, when you want to do straddle, when you want to do strangle, let us see that now. Now, this is the fifth strategy. We are expecting a huge rise in stock price. Huge rise or huge fall in stock price. So somebody is asking, what is your opinion on the stock? It will go up tremendously or it will crash tremendously. Means either huge up or huge down. When that is possible? Generally it is possible during budget or important monetary policy event, policy days, election time, when you're expecting 550 seats, 270 one party, 270 another party, who will form, they're totally volatile. If this party comes, then it is very good, stock market will zoom. If this party comes, market will crash. Situations are there. Budget is very good, market will zoom. Budget is bad, we don't know. So just ahead of budget, people think either it will go up or it will crash. In those times, we buy straddle. So in those times, we buy call and we also buy put. So we buy call, we buy put. Remember, same strike price. Same strike price. So when you're, suppose the budget was extremely good, then call will give huge money. Put, you will lose premium, that's all. If the budget is horrible, then put will give huge money and you lose premium here. So that is a idea. Let us buy both. So buy straddle means buy call, buy. Then what is tangle? Suppose I don't buy at the same strike price. I buy at different strike price. Why? See, when you buy a call, assume that you have to pay 17 rupees. When you buy a put, you have to pay 15 rupees. So total 32 rupees you have to pay. And assume that budget was neither good nor bad. Then neither call will give you money nor put will give money. Entire 32 gone. So suppose I tell you buy call, you do buy a straddle. No, I don't think budget will be very good or very bad. It will be so-so. I will lose 32 rupees. I can't. Can you tell me something similar? Oh, tangle. So when you do this, so this will be the 12 different strike price, 12 and 8. I'm just writing. It's not exact thing. It will be 20. So when the trader wants to reduce the initial outflow of premium, then he will buy call and he will buy put both, but different strike price. That is called tangle. So those who want to limit the initial outflow, because premium you have to pay initially when you buy a call and put. And finally, last strategy. I don't think they will ever ask recently, I don't know, but it is there in the syllabus, so I'm just touching it. Butterfly spread. So here there will be 3 strike prices, say 10, 20, 30. So these are the strike prices. They will again, according to me, they will not give you right short note. They may give right short note on butterfly spread. As a theory question they might ask. But I don't think they will give us a problem. If at all they want to give a problem, they will give this, what I am going to show now. There are 3 strike prices of a stock, 10, 20, 30. The premium is, okay, suppose the stock price is say 20 today. Stock price is 20, remember. Then this will be the middle strike price, remember. In butterfly spread, whatever is the stock price today, that will be the middle strike price. And then this will be equidistant. So this is minus 10, this is plus 10 with respect to middle. So 3 strike prices will be selected. The middle strike price will coincide with the present stock price. Okay. So this will cost 6 rupees. This will cost 3 rupees. And this will cost 1 rupee. So they will give premium. What you will do is, you will buy, sorry, I'll write here. you will buy this one, you will buy this one, but you will sell 2 into this one. So 3 strike prices will be selected. Middle strike price will coincide with current stock price. The strike prices will be equidistant. Then you will buy the extreme strike prices, and you will sell twice the middle strike price. So this is butterfly spread. They will give in the form of problem, and then you have to evaluate using basics of call and put. So one example which is solved, not a butterfly spread, that will help you how to prepare a table and solve. So the one problem is there, but I doubt that will come in the exam. I'm doubting, because this is quite challenging for students, but you have to just remember. So even if you write short note whatever I said just now, butterfly spread is a strategy. Okay, when it is adopted, now when you are believing that market will move in narrow range. Suppose Nifty is today 13,250, so I expect Nifty to be 13,200 to 13,300. So Nifty is today this one. So I will select 3 strike prices: 13,250, 13,200, 13,300. I'm expecting market to be in this range. So I will buy this, I will buy this, I will sell twice of this. So whenever you're expecting market to be in narrow range, you do butterfly spread. Whenever we expect market to move in a narrow range, we do butterfly spread. We select 3 strike prices. The middle strike price will be corresponding to the current level, and the 2 other strike prices will be equidistant from the middle strike price. You buy the extremes, sell twice the middle. That's all. Now premium, you can just see here. If I buy this, I have to pay 6 rupees. If I buy this, I have to pay 1 rupee. If I sell this, I will get 2 into 3. So you get 1 rupee. So 1 rupee is the cost. That's all. The cost of the strategy is just 1 rupee. You bought 6 rupees, bought 1 rupee, but when you sold the 2 middle strike price, you received premium. When you sell call or put, you receive premium. When you buy call or put, you pay premium. So you got 6 you have to pay, 1 you have to pay, you can see here, and this 3 rupees is one option. So 2 options, 6 rupees. But you are selling, so you will receive. So 6 plus 1 minus 6 will give you 1 rupee. So this is the outflow. Very small outflow. So this is all about options. We discuss everything here, everything. Okay. So hope you understood this. Let us now see all the formulae in the chapter of derivatives option segment. In options, we have 2 options. One is call option, another is put option. Call options give you right to buy the underlying security, and put option gives you right to sell the underlying security. Now when we buy call option or put option, we are buying a right, and we are buying a right to buy or sell at a specific price, which we call it as X, or we can say strike price. So X is the strike price. So if I am buying a call option with a strike price X, I am having right to buy the share at this price. Now once you buy an option and we approach expiry, or we call day of exercise, then the stock price would have changed. We call it as ST. So the payoff, what the buyer will get, payoff is given by maximum of ST minus X, 0. Now for put option, this for call option, for put option, the payoff is given by X minus ST, 0. Please understand that whenever you solve any problem of call option, always see ST. Always see from the point of view of ST. whether st is greater than x or st is less than x or st is equal to x. Means compare from st's point of view. If st is greater than x, you exercise, and if st is less than or equal to x, do not exercise. If st is greater than x, this will be positive, this particular thing will be positive, and if st is less than or equal to x, payoff will be 0 because we have put maximum. Similarly, for buyer of put option, it is maximum of x minus st comma 0. Whenever we solve problem of put option, always see from the point of view of strike price, whether x is greater than st or x is less than st or x is equal to st. Here again, when x is greater than st, we exercise the put option and this particular payoff will be positive. So this is for the buyer of call option and buyer of put option. What about seller, the person who is selling the option? For seller, it is -1 into payoff of buyer, -1 into payoff of buyer. So we can see that for evaluating seller's position, we need not bother. We have to always calculate payoff of buyer. We should always calculate payoff of buyer and multiply the answer by -1. So evaluating from seller's point of view is very simple. Evaluate from buyer's point of view, whether buyer will exercise or not, and what is the payoff, and whatever answer you get, multiply by -1. And this is extremely important to know. Now, whenever we buy an option, we have to pay a premium upfront. In the beginning, we have to pay. Now, when we pay premium, that is the initial outflow. Outflow is gone. Now, day of exercise comes. If I exercise, then I am going to get positive payoff. Then this will be positive. If I exercise, this will be positive. Premium I have paid, it is having a negative sign. You can see here negative. So this will be positive, minus premium, you will have profit. But if the payoff is less than premium paid, then we have a loss. Now, please understand that when you evaluate a call option or put option, you may exercise an option, you may have positive payoff, but that may not be enough to recover the initial premium paid. Means, despite exercising an option, there is a possibility of making a loss. The reason is the payoff may not be enough to recover the premium paid. This concept many students miss, so you have to be very careful. Now, what is premium? Premium is also called value of an option, price of an option, or what we call as premium. It consists of two values, intrinsic value and time value. Now, intrinsic value is same as payoff. We can say payoff. So we can say intrinsic value is payoff plus time value. Now, when you approach expiry, the time is already gone. You cannot have the right to exercise further because option has approached expiry. At expiry, you don't have further right. The right is extinguished. So at expiry, time value is 0. So at expiry, only one value is possible, that is intrinsic value. Now, formula for intrinsic value is same as payoff. So on that day, if it is a call option, if st greater than x, then intrinsic value is positive. However, if st is less than or equal to x, intrinsic value is 0. So we can say that at expiry, time value is 0. Intrinsic value depends upon whether you exercise or not. If you exercise, intrinsic value is positive, else it is 0. So both intrinsic value and time value cannot be negative. Lowest value possible is 0. And intrinsic value can be positive if you are exercising. So whenever you buy an option, you pay premium. That depends on what is the quantum of intrinsic value and what is the quantum of time value. So here we have written that intrinsic value is same as the payoff of an option. Next is put call parity theorem. Put call parity theorem states that if you create a portfolio, so if you create a portfolio of S and P on one side, and you create another portfolio of call and deposit present value of strike price in a bank, that is on the other side, then the value of these two portfolio, that is 1 and portfolio 2, will be same at expiry. So this is what put call parity theorem states. Portfolio number 1 is stock plus put option. Portfolio number 2 is call option plus a deposit equal to present value of strike price. These two portfolios will have same value at expiry. Therefore, they should be having same value today. So therefore, we are having equal to sign here in between. Now this put call parity theorem helps us to find out the value of put if you know the value of call, helps us to find the value of call if you know the value of put. So extremely useful formula in the examination. Why? Because in the exam they can ask you find the value of put, and what you can do is you can find the value of call and use this theorem to find the value of put, or vice versa. So in the exam, suppose they ask you in a problem, find the value of call, find the value of put, then you should not use any method to do two times. You should do any method. Suppose you are using one particular method to find the value of call, and then use this formula to find the value of put. So we need not do the two models, two times. Use the model, calculate one of the values, and use the formula put call parity theorem to find the other value. So this is a very, very important formula, you must remember. Now, which are all the models we use in the exam, or which we have in syllabus? First is a binomial model, what we call as risk neutral approach. Now in this approach, a stock can take two values. A stock can take two values. We say SU and SD. Now, if I invest in the stock today, it can either go up to SU or it can go down to SD. What is the probability it can go to SU? Let us say P. What is the probability it can go to SD? The remaining probability, that is 1 minus P. So P into SU plus 1 minus P into SD is the expected value of stock at expiry. So this is the value of stock at expiry. Suppose I invest S rupees. Now today I am buying stock of S rupees. Then this is the expected value at expiry. Suppose instead of buying stock S, I put that money in bank. Then how much I will get? I will get S into 1 plus RD. Now if this is the case, risk neutral approach says that this should be equal to this. So from these two we get P and 1 minus P. So we will be getting P and 1 minus P by solving this. Then if S becomes SU, C can become CU. If S becomes SD, C will become CD. If stock S can go to SU with probability of P, C can go to CU with probability of P. If stock S can go to SD with a probability of 1 minus P, then C can go to CD with a probability of 1 minus P. So the expected value of call we got like this. So this is the expected value of call. So when you take the present value, we get the value of call, and this is what we have written here. So very simple formula, risk neutral valuation approach. Now you have to see the video where I have solved one problem and explained the concept also of another approach, and that is riskless hedge approach. Concepts have been explained, problem has been solved in detail, and they have asked just once till now, 1 or 2 times if I am right. So just go through that, and that will give you confidence, because it's very simple, it's not much difficult. So that is another approach under binomial model, that is riskless hedge approach. So these two approaches, that is risk neutral valuation approach and riskless hedge approach. So these are the two approaches you must know under binomial model. Next we come to Black-Scholes model. Now Black-Scholes model, if the stock is not paying dividend. Now Black and Scholes have devised this model with one major assumption, that this model can be used for stocks not giving dividend. So if the stock is not giving dividend, then we use this formula. C is equal to S ND1 minus X e raised to minus RT ND2. ND1 and ND2 are actually probabilities. They are probabilities. You can think of the form P and 1 minus P. But they are not exactly P and 1 minus P, but I'm just telling you how to recollect this. And I have explained how to remember this formula. I solved 2 problems in binomial Black-Scholes model in the video. I explained how to remember the formula also. So S in D1 minus X e raised to minus RT in D2. Now what is D1? D1 is natural logarithm of S upon X plus R plus sigma square by 2 into T divided by sigma root T, and D2 is this. Now you would wonder, who will remember all this formula? I am telling you, nothing is difficult if you are willing to do it, number 1. And number 2, if you are willing to write it down, 5 to 6 times. Now suppose you see today, write 5-6 times. After 10 days or 15 days, you see, again write it 5-6 times. It gets registered. And when you see the video, I solved a problem. I have explained how to remember this formula. It's better to explain that with a problem. Therefore, you have to see the video to get that. Now, what happens if this is for dividend, non-dividend paying stock? What about dividend paying stock? Suppose in the exam they give this stock is giving dividend. Then what I should do is I should remove the element of dividend from stock price. Now, if you remove the element of dividend from stock price, you are written adjust stock price. How? Stock price minus dividend. I had to remove dividend. Dividend is paid sometime later, say at time T1. Remember here expiry of the option is capital T. Here dividend payment time is T1, small t1 I have written. So take the present value of dividend and subtract it from S, and that will give you S star. So wherever we have S, I'll put S star. You can see here. So wherever we had S, you can see so we had S here as replaced with S star. We had S here replaced with S star. And what is S star? S star is this. S minus D e raised to minus RT1. So wherever we have S, replace with S star. Now this is when dividend is given in absolute term. If dividend is given in yield form, then we follow this. S star equal to S e raised to minus dt. Now, very important thing. If they ask the value of call option, we do all these things. Now, if they ask the value of put, then what we should do? The best method is find the value of call, use put call parity, and find the value of put. And that is what your study material is also showing. I repeat, suppose they ask you problem of put option, solve for problem of call option, and then use put call parity theorem formula, that is S plus P is equal to C plus X e raised to minus RT. So use this formula, substitute for all these things and find the value of put. Now if you want to use directly binomial model, suppose you want to use binomial model directly, then put option is equal to, what is the intrinsic value of put? Intrinsic value is nothing but payoff. In payoff, what is the formula we are having? We are having X minus S. Now when I excise put, when I am going to do at expiry, when I excise put, which I am going to do at expiry, now Black-Scholes model believes that their model can be used only for European options. European means expiry exercise only. So that is the main assumption of Black-Scholes model. So if I exercise at expiry, then I will get X, that is strike price. Since I am finding the value of put today and I am going to X later on, I am going to get X later on. So I should be writing here present value. So therefore we have X e raised to minus RT. So we have got X e raised to RT minus S. Then ND1 is associated with S, but you have to put minus sign. ND2 is associated with this, again you have to put minus sign. So you can solve this. So again in the video I have solved by this method, so you can go through it, but I am telling you, using put call parity, this is the best way to actually do it. Use put call parity theorem. Using put call parity theorem, you can find put option after you have found out what is the value of call option. There are a lot of option strategies, but I believe at least 4 you must know quite well. If you are bullish, buy call option. If you are bearish, buy put option. So how they will give in the exam? Mr. X is bullish and they may give call option, put option both. So what he will do, if he is bullish, buy call. Is bearish, buy put. Now there is one person who is both bullish and bearish. You ask him what is the view on the market, Now I feel market will go tremendously, but which side? No idea. He doesn't know whether market will go up or go down. So he is very much believing that market will be volatile, means either it will zoom up or zoom down, but he doesn't know the direction. See, that is the next one. So if you expect huge movement but direction unknown, then you buy straddle. What is straddle? Buy call and buy put. Remember, buyer of call and put pays premium. So when you buy call, pay premium. When you buy put, pay premium. So you are paying premium for two options. Now sometimes it can become very costly. Remember, we are not talking of just one option. In one option contract, there could be 1,000 shares. So if you are buying call, suppose 8 rupees, 8,000, and put option 16 rupees, 16,000. So 24,000 become very big inflow and gone. Premium once paid is non-refundable. So some investor will think, no, I don't want to pay so much of premium. I am very much sure market will go up in a big way, but I want to reduce my premium. Okay. Same view, just see this, same view, want to reduce premium by strangle. So in strangle, what you do is, the biggest difference between strangle and straddle is, in straddle you have same strike price. In strangle, they are different strike prices. They are different strike prices. So these four strategies you must remember. What are they? You are bullish, buy call. Bearish, buy put. Expect significant movement, but no direction. With the direction unknown. Buy straddle. What is buy straddle? Buy call, buy put, same strike. No, I don't want to pay so much of premium. I want to reduce it. Buy strangle. Buy call, buy put, different strike prices. Okay. So these are all the formula you must actually know under this chapter. And after seeing all the formulae, you must try the problems that are given, and that will give you that confidence of applying this formula and concepts properly. Let us read this problem. A trader is thinking of buying a call, strike price equal to 45, and a put, strike price equal to 53 of the same stock, and will pay rupees 6 and rupees 4 respectively to buy them. If he had bought 5 calls and 4 puts and the expiry price was rupees 43, what will be his total net gain or loss? Very popular problem, has come many times, involves testing the basics of call and put. Now this has come in various forms. Now sometimes they give as a simple problem, sometimes they give it as a strategy. Nevertheless, if we know the fundamentals of call and put, then we have to simply compare the strike price with the expiry stock price. The strike prices are 45 and 53 respectively, and the expiry stock price is 43. So we have to compare expiry stock price 43 with strike price 45 for call, and also we have to compare expiry stock price 43 with strike price of put, that is 53, and evaluate. Let us see how we solve this problem. Call option, strike price rupees 45, stock price at expiry, we write ST. T stands for tenure last. We usually use T for expiry. So when we put a subscript T, it is stock price at expiry. Stock price at expiry is 43. It is a call option since ST less than X, call option will not be exercised. Therefore, payoff is equal to 0. Now premium paid is equal to, it is given ₹6. So therefore loss per call is equal to 0 minus 6, or you can just put in bracket. Total calls is buying total five call options. So therefore total loss $30. Now we have to evaluate put options. We will put strike price equal to ₹53. Stock price at expiry is equal to 43 since X greater than ST. Put option will be exercise. Therefore there will be payoff. So payoff, we use our simple formula, maximum of X minus ST, 0 is equal to maximum of 53 minus 43, 0, which is 10. So there is a payoff of 10. What is the premium? Premium paid is equal to, it is given 4. So therefore profit is equal to payoff minus premium. 10 minus ₹4 is equal to ₹6. Total put options is equal to 4. Therefore total profit from put, or we can write 4 puts, is equal to ₹6 into 4 equal to ₹24. So in call options we can see that he has faced a loss of ₹30, and in put options there is a profit of ₹24. So in the exam actually you can highlight this. Examiner who is correcting the paper would be seeing these main things. Sometimes the answer is correct, interest steps are wrong. You can escape sometimes. We are not supposed to do that. So here we get finally, therefore total profit slash loss is equal to ₹30 plus ₹24 is equal to ₹6 loss. So we can say that loss is equal to ₹6. So therefore the answer for this problem is loss of 6. I hope you have understood this. Let us read this problem. An investor bought one share of XYZ October 40 call for rupees 2.25. So this 2.25 is a premium which he has paid. It is a call option and the strike price is 40. Now, and also bought one share of XYZ October 40 put for rupees 1.50. On the day of exercise, XYZ swung wildly, ranging from rupees 35 to rupees 45. Drawing the profit table for all the prices in this range, calculate the break-even point. Now, this again is a problem which tests the basics of call and put, but you are required to do in a different manner. You have to draw a table. Why? There are range of prices from 35 to 45. For each of the prices, that is 35, 36, 37 up to 45, you have to compare with the strike price of call and put, which is 40, and then evaluate. There will be one point where you will get zero profit, and that is our break-even point. Let us see how we solve this problem. Call options are exercised when ST greater than X. In this case, the strike price is given as 40. So whenever ST is greater than 40, there will be payoff equal to max of ST minus X, 0. Put options are exercised when X greater than ST. So whenever 40 exceeds stock price on the day of exercise, we have payoff, and that payoff will be equal to max of X minus ST, 0. Now they are given stock prices ranging from 35 to 45. So we know that call will not be exercised in the range 30 to 40. We know that put will not be exercised in the range 40 to 45, because we are going to exercise call only when it is greater than 40. So I am going to exercise when 41 to 45 I am going to exercise. And put option 40 should be greater than ST. So I am going to exercise put from 35 to 39. So we can say or 35 to less than 40. So I am going to exercise in this zone. So I will fill zero payoff for call till 40. And I will pay zero payoff for put from 40. So this is one aspect of this problem. Second is they are asking break-even point. Now what do you mean by break-even? Now break-even point means whatever payoff you are going to get from call and put should be equal to whatever premium you have paid for call and put. In that case, we will have zero profit. So they are asking what should be ST. They are asking what should be ST when we have a break even. Now premium is 1.50 for put, 2.25 for call. So premium is 3.75. Therefore, we know that combined payoff should be 3.75. Then only 3.75 minus 3.75 will be 0. So at what ST combined payoff will be 3.75? That's what they're asking. At what ST combined payoff will be 3.75. So we have to, since they are given the prices, we have to draw the table. And when we draw the table, applying this ST greater than 40, we fill up the values for payoff and we find at what place we are getting zero profit and we work. So the table is somewhat like this, where we draw, we write for call option first, then for put option. We can see that as shown here, 35 to 40, zero payoff. So you can see this particular part, I put zero payoff for call. And similarly for put, 40 to 45, zero payoff. So 40 to 45 put, we have zero payoff. So the remaining values we have filled. You can see call, we access call whenever ST greater than X. So we are having values here. Similarly for put, we have values for less than 40. Then we take the total payoff, because we want this total payoff. So we calculate total payoff. We get this 5, 4, 3, 0, 2, 1. So we get the 5, 4, 3, 2, 1, 0. Total payoff. And total premium is 3.75. So that is shown here. And we don't get 0 actually, we get all this. But we have to find that 0 point. We get all this because they are given prices ranging from 35 to 45 and I have taken 1 rupee, 35, 36, 37, 38, etc. So we find that 0 is between these two. This is 0.25, this is minus 0.75. So 0 is between them. So I work backward. So I write here 0, premium is minus 3.75 and I want total payoff is 3.75, this one. Then only it will be 0. Now we can see that call option above payoff is 0, below also payoff is 0. So I can safely put 0 and 40. Similarly put payoff I can, strike price I can write 40. So entire 3.75 has to come from put. So I can say what is the payoff of put? Put payoff is equal to X minus ST. Put payoff should be 3.75 is equal to 40 minus ST. Therefore ST is equal to 40 minus 3.75 equal to 36.25. So I fill here 36.25. So at 36.25 we have the first break-even point. We see down below the table we have got minus 0.75 and 0.25. So 0 is between them. So we write 0 and total premium is same and I want total payoff to be 3.75. Now we can see in the put column 0 payoff for this stock price zero payoff for this stock price. So any stock price between them will have zero payoff. So 0, 40. This strike price 40 doesn't change, we write that. And this should be 3.75. Then only total payoff will be 3.75. So we can write call payoff is ST minus X. Therefore 3.75 is equal to ST minus 40. Therefore ST equal to 43.75. So we write here 43.75. So we get another break-even point. So the correct answer is 36.25 and 43.75. Here two concepts you have to remember. The concept number one is this break-even point is different from individual option break-even points. If I buy a call, the break-even point is given by X plus premium. And for put, break-even point is given by X minus premium. So those break-even point you cannot use here. Remember, it is a combined position. Concept number one. Concept number two, you must remember, I am buying a call and a put, and it is popularly called as, I am buying a call and a put of same strike price. It is popularly called as straddle. Now, whenever you are buying a call and a put, you will have two break-even points. So if you remember this, so I know that I need two answers, and we are getting these two answers, 36.25 and 43.75. Just go through this video a couple of times. They have asked without naming straddle. They have asked this problem in a different way, and they can keep on asking this problem. Very important problem. Do see this a couple of times. Hope you understood. Let us read this problem. The following information is available for the equity stock of P Limited. S, that is stock price rupees 120. X, that is strike price rupees 110. R equal to 12%. Sigma equal to 40%, that is standard deviation. One tail value for 0.6612 is 0.2543, and for 0.3784 is 0.3526. Also given that e raised to 0.06 is 1.062 and natural logarithm of 1.091 is 0.0870. Calculate the price of 6-month call option and 6-month put option as per the Black-Scholes model. Now, Black-Scholes model problem was last asked in the year November 2008. Now, after that, we are yet to see this problem. Now, they have given S, X, R, sigma, and T. T is given indirectly as 6 months in the final part of the question. So all the 5 parameters are provided, and normal distribution table they are given the one tail value also. So let us see how we have to solve this problem. Call option, the intrinsic value is given as stock price minus strike price, and then what is the probability that you will get intrinsic value or you will get this payoff. So the probability of S is ND1, which is a normal distribution function, and probability of you paying X. When you will pay X, suppose I am buying a call option today, I will be exercising my call if ST greater than X when at expiry. So you are going to pay X, the strike price at expiry, not today. But you are finding value of call today. You are going to pay X at expiry. So in present value term, how much you are going to pay? So you are going to pay X into e raised to minus RT. So you are going to pay X into e raised to minus RT. What is the probability that you will pay this? That is ND2. So this is how you should learn this. First write S minus X. When you are going to pay X later on. What is the present value? X e raised to minus RT. What are the respective probabilities? ND1, ND2. Now what is D1? Natural logarithm of S upon X plus R plus sigma square by 2 T divided by sigma root T. And what is D2? D2 equal to D1 minus sigma root T. Now this is the value of call. What is the value of put? So we get from put call parity theorem. We get from put call parity that S plus P is equal to C plus PV of X. So once you find call option from the above Black-Scholes model formula, I substitute, I know S, I know PVX, then I get P. So they are asking what is the value of call and what is the value of put. So we have to calculate both. So let us see what are all given to us. Now first, S is given 120, X is given 110, R is given 12%, T is given 6 months or 6 upon 12 equal to 0.5 years, and sigma is given 40%. Step 1, find D1 and D2. So our step 1 is D1 equal to natural logarithm of S upon X plus R. We should write in decimal, 12% it is. Sigma square, this 0.4, 40% is 0.4, 0.4 square divided by 2 into T. T should be in years, 0.5. So we'll have to write this in decimals. We have to write this in decimals, this in year. You have to remember this. So we have done that, and then we write divided by sigma root T. Now natural logarithm 120 upon 110, 120 divided by 110 is 1.091. They are given that in the question 0870 plus 0.4 square divided by 2 plus 0.12 into 0.5 at 0.1, 0.5 square root into 0.4. Should write 4 decimals, 0.2828, 0.087 plus 0.1 divided by 0.2828, 0.6612. So d2 is d1 minus sigma root t. Now just see, I have written here sigma root t. This is sigma root t. So need not calculate. Sigma root t I have written specifically down 0.2828. So we should not be wasting our time. So this will be equal to 0.6612 minus 0.6612 minus 0.2828 is equal to 0.3784. So we calculated d1, d2. Step 2 is to calculate nd1 and nd2. Now they have given one tail value, means what they have given. Let us see. I draw the normal distribution curve, and remember this is center 0. On this side we have positive values, on this side we have negative values, and our d1 is positive. So this is our d1, it is 0.6612, and they are given one tail. One tail means they are given this value. So they are given us this value. So this is one tail, and one tail value they have given as 0.2543. But remember, I don't want this value. I want value to the left of the value. I want this. So this is required for substitution in the formula. This area is required for substituting in the formula for ND1. So I want the green shaded area. I don't want that red striped area that is given to us. Now what is this green shaded area? Therefore ND1 is equal to, now total area is 1. So 1 minus striped area, that is 0.2543. That is 0.7457. So I want green shaded area. Total area is 1. Striped area 0.2543 is given, but I don't want that. I want the balance. 1 minus 0.2543, 0.7457. Similarly, ND2 also. ND2 is equal to 1 minus, they have given that as 0.3526. 0.3526. That is 0.6474. So when you substitute this, so you get 0.6474. So I will substitute ND1, ND2 in the main formula. Step 3. Substitute in call option formula. C is equal to S. S is 120. ND1. ND1 is 0.7457 minus X. X is 110 into e raised to minus R. R is 0.12 0.5 into ND2. ND2 is 0.6474 is equal to, so let us do this, 120 into 0.7457, 89.484 minus 110 into e raised to 0.06, and that is the value we are having also, but it is minus into 0.6474, 89.484 minus 110 into 1 upon e raised to 0.06 into 0.6474, 89.484 minus 110 upon 1.062 into 0.6474. So we do that calculation. We get 22.43 approx. We get 22.43. It is given 22.41 approximately. Let us see what we are getting for put. So see, we are getting this marginal difference. You will definitely find in the exam also, because it all depends on how the question paper has been said. Here nothing is given, work in 2 decimal, etc. The reason is it's very difficult. Lot of decimals are involved, lot of calculations are there. Some student might take entire value in the calculator. Some will truncate. We have truncated to 4 decimals. Some would truncate to 3 decimal. There is no uniform rule in the market. The 4th and the 3rd decimal doesn't play a role at all in deciding whether I should buy an option or sell an option. So 22.43 we are getting. So approximately is near 22.4. That is the value of call. Step number 4, put call parity theorem. So I substitute that S plus P is equal to C plus PV of X. S is 120 plus P equal to 22.43 plus X. X is 110 into e raised to minus RT. So therefore P will be equal to rupees. So e raised to minus RT is 1.062, 1 upon 1.062. So 110 divided by 1.062 plus 22.43 will be the value on the right hand side, minus 120. We are getting 6.01 to be exact, and the answers given are 22.41 and 6.00, and it is very clearly written approximately. So that actually shows that if you are getting anywhere with 22.42, 22.41, 22.4 is okay. You should not be getting 22.3 or 5.90 or 6.10, etc. So one or two, the second, third decimal changing marginally is okay. So you can see the biggest advantage of this Black-Scholes model is it takes very less time to solve the problem, provided you know it. That's the biggest advantage, and you get 8 marks in possibly 8 minutes. We are not taken much time to solve this, but the groundwork which you have to do is quite large. You have to understand what is normal distribution. You should understand what is natural logarithm. You should be very careful while substituting for exponential, because we want e raised to minus RT. They have given e raised to RT in the question. So you have to be very alert. So these are the drawbacks, and They have not asked this problem for, I said in the beginning, for more than 20 attempts. So we are not sure. But I think it's always better to go prepared. Better you practice this problem 2-3 times and understand the normal distribution function. Hope you understood this. Let us read this problem. Suresh is interested in purchasing equity shares of ABC Limited, which are currently selling at rupees 500 each. He expects that price of share may go up to rupees 600 with a chance of 70% and may go down to rupees 460 with a chance of 30% in 3 months. A put option on the shares of ABC Limited can be exercised at the end of 3 months with a strike of rupees 530. Assume rate of interest as 8%. Then what will be the hedge ratio as per riskless hedge approach and the value of put option? Now this is a dedicated problem of riskless hedge approach. We mostly find the value of call or put using risk neutral valuation method. But Institute has already asked riskless hedge approach twice. So therefore, this problem gains importance. Method is fairly easy but slightly lengthy as compared to risk neutral valuation. Okay, since we have done problem with call option in the class, this problem is finding the value of put. So let us see how we do this problem. In the exam, they will not give calculate hedge ratio as per riskless hedge approach. They will simply ask calculate hedge ratio. A hedge ratio comes only in riskless hedge approach. So it doesn't come in risk neutral valuation approach. So when they ask hedge ratio, you have got only one method, that is riskless hedge approach. Let us first understand the meaning of the word hedge. Now hedge is having two positions which will offset each other when market changes. Suppose I got A share and B share. If market rises, A will go up, B will fall. If market falls, A will fall, B will go up. So we are seeing for change in market, A and B are moving in opposite direction. When they move in opposite direction exactly, then we can say that we have created a hedge. Means loss in gain should be offset by gain in, loss in one should be offset by gain in other, or vice versa. So that is how a hedge is created. Now here we are going to use the concept of hedge to create a portfolio. Now we are considering what? We are considering a stock. Now let us call that stock as S. Now this stock is represented by letter S. Now assume that I buy H shares of S. H, later on we are going to find that it is going to give us the answer for hedge ratio. So we are going to use the letter H for hedge. So you would ask why I am not using some other letter. So H is for hedge. Assume that I buy H shares of stock S. Now this is one position. Now I have to create another position in such a way that these two positions create a hedged portfolio. Means these two positions should behave like a hedge. Now we are in the process of calculating the price of an option. So I must have either a call option or a put option. So my hedge position will comprise of two assets. One is stock and other is option. One is stock and other is option. Now these two should behave in such a way that when S rises, the option part falls, or when H falls, the option part rises. Now we can say that these two will form part of portfolio. Now suppose I want to find the value of this portfolio. Value means today if I buy S shares of S, how much it will cost? It will cost H into S. Suppose I want to create an option position. Now what is call option? Call option, the intrinsic value is given by S minus X. When S rises, C also rises. When S falls, C also falls. So C and S are directly correlated. Now suppose this is buying, suppose you buy call. This is for the buyer of call. Now what is the position of seller of call? Now for seller of call, the position is -1 into buyer of call. Seller of call, we can say payoff is equal to -1 into buyer of call's payoff. So if you buy call, it will be directly correlated with stock. If you sell call, it will be inversely correlated with stock. So therefore, to create a hedge, while buying S shares of S, I will sell call option. So this is how we create a portfolio whose valuation today is V. Why valuation? Suppose I want to buy shares of S. H shares of S. What is the value HS? Now suppose I sell a call option. Now when I buy a call option, so I can write plus C. If I sell a call option, then H shares of S is the money which is going out. When I sell a call, I will receive premium. Therefore, reduce the cost minus C. That's how we get V. V is equal to HS minus C. Now let us see if it is a put option, how we do it. Now value of put is equal to X minus S. If S increases, P decreases. You can see S is having a negative sign. And intrinsic value of put is X minus S. If S falls, P rises. If S falls, P rises. So we can say that put option is inversely correlated with stock. So when you buy a put option, it will automatically be inversely correlated with stock. Now when you buy a stock, how much you have to pay? If I buy a stock, I have to pay H shares. I am assuming same quantum. I have to pay HS. If you buy a put option, how much you have to pay? Plus put option price. So this is V. So this is how we create a hedged portfolio. If they ask you to find the price of call, your hedged portfolio will be this. If they ask you to find the value of put as it is in this problem, the hedged portfolio will be this. So in the exam, you need not elaborate or explain so many things. You have to simply write like this. Let us buy H shares of S and buy a put option at a price of P. Therefore, value of portfolio today is equal to V is equal to HS plus P. So this should be your first statement. Let us see what is given in this problem. S is equal to 500, SU is equal to 600, SD equal to 460. So we can write here given R equal to 8%, and it is given that stock may go up or down in 3 months. So T is equal to 3 months. Now the value of portfolio today is V is equal to HS plus P. So at the end of 3 months, what will be P? P will be PU. So what is PU? Now PU is a 3-month option. So at the end of 3 months, an option generally has intrinsic value and time value. At expiry, time value is 0. So it will have only intrinsic value. The formula is max x minus SU comma 0. It will be max x is given as, you can write x is given as 530. So 530 minus 600 comma 0 equal to 0. Now at the end of 3 months, P will be equal to PU, or P will be equal to PD. What is PD? PD equal to max x minus SD comma 0. Max x minus, or 530 minus 460 comma 0 equal to 70. So this will be the value of put option. So therefore, what will be the value of portfolio? So when S goes up to SU, V will be equal to VU equal to HSU minus PU. So what will be the value of portfolio? When either it will be VU or VD. So VU means H into SU 600 minus PU 0 equal to 600H. So value of portfolio will become VU when S goes to SU. Now what will happen when S goes to SD? Then V will be VD equal to HSD minus PD equal to H into SD is 460 minus 70 equal to 460H minus 70. So we have got VU 600H VD 460H minus 70. Now, if I want to, first we created hedged portfolio. Suppose I want to create riskless hedged portfolio. Riskless means market will go up or market will fall. My portfolio value should not change. That is called riskless. Suppose I buy a stock of Reliance. I want to be riskless. Let the market go up, Reliance stock price will be same. Let the market go down, there will be no change in Reliance stock price. So I can say Reliance is riskless. In the same way, here we have created a hedged portfolio HS plus P. If I want the portfolio to be riskless, then VU should be equal to VD. So we use that concept. That's how the method has got the name riskless hedge approach. So if we want the portfolio to be riskless, then VU should be equal to VD. Therefore, 600H should be equal to 460H minus 70. Sorry, plus PD. I should be writing plus everywhere. 460H plus 70. So now when you subtract this, we get 140H equal to 70. H is equal to 0.5. So this is the hedge ratio. Now how to interpret this? We should interpret like this. If you want to create a hedged portfolio, you are supposed to buy half shares, H shares of S, half shares of H and a put option. Now we don't get half share in the market. Then neither I can buy one put option. Remember, a put option has 1000 underlying shares. So if I buy one put option, I'm actually buying 1000 shares. In that case, half of, automatically that half the quantity will be, 500 shares and one put option, like that. So we are getting hedge ratio as 0.5. So a hedged portfolio will be buying 0.5 shares of S for every put option bought. So I buy a put option, I buy 0.5 shares of S. So this is the first step of calculating this. Now what is the second part? Now we have created a hedge portfolio and we use the concept of risklessness, matched VU and VD and arrived at H. Now let us substitute H in that formula. When H is equal to 0.5, VU will be HSU plus P. 0.5 into 600 PU 0 equal to 300. VD will be HSD plus PD. 0.5 into 460 plus 70. This is again 300. So we can see that at the today the portfolio is HS plus P to time 0. At the end of 3 months, it is 300. Irrespective of market going up or going down, the portfolio value is 300. So what I am supposed to do? I want to find the value of put today. So therefore take the present value of this. Therefore present value of rupees 300 is equal to 300 divided by 1 plus RT. 300 divided by 1 plus 8% into 3 upon 12. This will be 294.12. Now when I take a present value, it is nothing but you can just see the diagram. If I take the present value of this, it is this value. But, therefore you can write, but present value of portfolio is HS plus P. Therefore, HS plus P is equal to 294.12. H is 0.5. 0.5 into 600 plus P equal to 294.12. P is equal to some error is 500, correct? I was getting negative value. I was wondering. So S is 500. So P is equal to 294.12 minus 250. So P is equal to 44.12. So this is the value of put option which we have got. So this is how we use riskless hedge approach to calculate. In the exam, hedge ratio can be calculated only by one method, the way we have done. Create a hedged portfolio, find the value of call option and stock, find the value of call option or put option for higher level, lower level, equate it. In other words, assume risklessness and you get hedge ratio. After finding hedge ratio, we do this part. Now this part you can do by risk neutral valuation approach, but again you have to start from beginning and do. But this method is very fast. If you practice this, this is faster. Straight away find VUVD, take PV, equate to HS plus P. In the case of call option, you will equate to HS minus C. So we got the answer 44.12. It's better to practice since institute has already asked 2 times in the last 15 years or so, and every likelihood that they can repeat it. Hope you understood this. Let us read this problem. Your stock price is currently rupees 250. Over each of the next 2 3-month periods, it is expected to go up by 6% or down by 5%. I repeat the sentence. Over each of the next 2 3-month periods. So 2 3-month period means total 6 months. So 3 months. 2 3 months period. Okay, it is expected to go up by 6% or down by 5%. The risk-free interest rate is 12% per annum with continuous compounding. What is the value of a 6-month European call option with a strike price of rupees 240? Given E raised to 0.02995 equal to 1.0304. Now this is a 2-period binomial model problem involving risk neutral valuation approach. Now the calculation, then drawing the binomial tree diagram, they will all take time. Now you will be lucky if the binomial tree diagram is given to you in the exam, where you can directly take the data from there. So that will save some time. Otherwise, drawing the tree diagram, calculating and evaluating every node is very time consuming. So you have to be very careful whether to attempt this, especially when you have less time. Let us see how we solve this problem. So it is a two-period binomial model, and we will use risk neutral valuation approach. So what is given to us? Let us write down and draw a rough diagram for that. Price is 250. Today, so it can go up by 6%. So plus 6%. So 6% when you apply, to 65, or it can go down by minus 5%. When you apply that, you get to 37.5. Now this is at the end of one period. This is beginning. So 0, period 1. Now over each of next 3 month period. So this is your 3 month. This is one period. Now we will have another period of 3 months. So 6 months. So at the end of this period, stock will again go up by 6%. So we get SUU, that is up level and up level, 265 plus 6%, that will be 280.9, or minus 5%, 251.75. This will be SUD, first up then down, like that, SUD. Now once it goes to SD, it can again go up by 6%. So this SDU, and when you calculate, it will be same. And finally SDD, so minus 5%, SDD, and when you calculate, you get 225.65. We can write 63 also, is perfectly correct. So I just written the actual calculation. Now this is how the stock is going to behave. If the stock is going to behave like this, now what is the strike price given to us? Strike price is 240. R is equal to 12%. T is 3 months, 3 months each period. So total 6 months. And remember, that's why they have asked value of 6-month call. Okay. Now this is what is given. Now this is node 1. This is node 2. And this is node 3. Now when we draw a tree from left to right, we have to evaluate from right to left. So we will actually evaluate 3 times. We will use risk neutral valuation approach. Now First, we will evaluate node 1. So I'll just write like this. Now using SUU, I will calculate CUU. Now since it is a problem of call option, CUU will be max SUU minus x comma 0. Then I will evaluate CUD, which will be same as CDU. So CUD equal to CDU equal to max SUD minus x comma 0. Then I will evaluate CDD. So CDD will be max SDD minus x comma 0. Now when I evaluate this branch, that is node 1, suppose I evaluate node 1, I will get CU. And when I evaluate node 2, I will get CD. And finally, when I evaluate node 3, I will get C. Now we calculate CUU, CUD, CDD using this formula. But CU and CD comes out of calculation. I mean evaluation of node 1, 2, 3. Now what we do is, let us now start. So first you have to draw this diagram. This is step 1. Step 2. So after drawing the diagram, we should write, we use risk neutral valuation approach to evaluate nodes 1, 2 and 3. So what is this risk neutral valuation approach? We have to briefly write. So we write that consider risk neutrality between investing in stock and investing in risk-free asset giving a return of 12%. So this has to be written. Then we come to node 1. Now what does risk neutral approach say? Now here one point before we proceed ahead. According to risk neutral approach, let us see for node 1. I'll just write here, then I'll erase it. For node 1, if P is a probability of stock going up and 1 minus P is the probability of stock going down. Remember, in all the three branches or all the three nodes, the stock going up percentage is same. Stock going down percentage is same. Rate of interest doesn't change throughout the problem. And time period is 3 months. So therefore, the up probability and down probability will not be different for all the three nodes. This we can easily prove it, but it is beyond the scope of this discussion. I repeat, we can write here, since percentage of stock going up slash going down is same in all the three nodes, and R and T, which is 3 months, does not change. We assume same probability of stock going up, that is P, and of stock going down, that is 1 minus P. So the probability of stock going up by 6% and probability of stock going down by 5%, that is P and 1 minus P, will remain same in all the three nodes. The reason is the up percentage and down percentage do not change in the three nodes, and R and T remains constant throughout the problem. So for node 1 we can write, therefore P into SU plus 1 minus P into SD. So first we have to write node 1, sorry, P into SUU, 1 minus P into SUD will be is equal to SU into 1 plus RT. Just pay attention here. This is SU. We are evaluating this. P into SUU. 1 minus P into SUD is same as investing at SU at 12%. So we are now writing for this node. So P into SUU plus 1 minus P into SUD is equal to SU into 1 plus RT. So when we substitute this, we get P into 280.9 plus 1 minus P into 251.75 is equal to 265 into, now here they have given exponential, so we should be using e raised to RT. So 265 into, they are given the value of e raised to RT, e raised to 0.12 into 3 upon 12. So you can actually assume the exponential value as e raised to 0.03, which is almost the same, 1.0304. So 265 into e raised to 0.03, and this will be 280.9p minus 251.75p plus 251.75. When we solve, we get p is equal to 0.7309. Let's verify once more. Point 7309 is correct. So 1 minus p is equal to 0.2691. Now this p we can use entirely, node 1, node 2, node 3. Now we evaluate node 1. So since derivative takes the same probability as the underlying, the probability of SU, or sorry, CU going to CUU will be 0.7309, and the probability of CD going to CUD. So we are writing this actually. Probability of CU going to CUU, and we can write CU going to CUD. CU and CU going to CUD will be 0.2691. So we write this probability here now, 0.7309, 0.2691. Now we have to find what is CUU and CUD, where CUU equal to max SUU minus x comma 0 equal to max 280.9 minus 240 comma 0 to 40.9. CUD will be max SUD minus x comma 0 equal to max SUD is 251.75 minus 240 comma 0 equal to 11.75. So we got this value. So once you got the value, so we write this here, 40.9 equal to 40.9 equal to 11.75. Now we multiply this. So we multiply PU into CUU plus PD, or sorry, we will write P into CUU 1 minus P into CUD. This will give expected value of call at the end of 6 months. Therefore, expected value of call at the end of 6 months will be 0.7309 into 40.9, 0.2691 into 11.75. You get 33.06. Now this is the value at the end of 6 months. So we have to bring it to at the end of 3 months. See, 33.06 is the value here. 33.06 is value here. Now I want to find value here. So I want this. So we take the present value of that. Therefore, value at the end of 3 months. Remember, I have written here at the end of 6 months. Now I am writing at the end of 3 months. So we have to take the present value. Will be 33.06 divided by e raised to RT. Or I will write like this, one intermediate step into e raised to minus RT, which is 33.06 upon e raised to RT. 33.06 upon 1.0304. That will be equal to 32.08. So this is the value of CU. The CU is 32.08. Now this completes node 1. Next we come to node 2. Here we need not write entire step. We can write similarly. Evaluating node 2, we get CD equal to probability into SDU plus 1 minus probability into CDU 1 minus P into CDD into, so we have to take the present value. Now what is CDU? Where CDU will be max SDU minus x comma 0 equal to max SDU is 251.75 minus 240 comma 0 equal to 11.75. CDD will be max SDD minus x comma 0 max 225.625 minus 240 comma 0 equal to 0. So by substituting we get CD equal to 0.7309 into 11.75 plus 2691 into 0 into e raised to. So when you do this calculation, get 8.33. Let us verify this once again. 7309 into 11.75. $8.33. So by evaluating node 1, we got CU 32.08. By evaluating node 2, we got CD 8.33. Now let us calculate further. Node 3. Similarly, by evaluating node 3, we get. Now we are coming one period ahead. So this will be P into CU plus 1 minus P into CD into e raised to minus RT. This will be the value of call 7309 into CU. We got it as 32.08 plus 0.2691 into 8.33 into e raised to minus 0.03 . Point 7309 into 32.08 0.2691 into 8.33 24.93. So we need not write detail. In the first node you have to write entire thing. So how we procedure actually, we drew this first, then we kept this figure ready. Actually we should be filling up, you should fill up these things, 0.7309, 0.2691. Now this is 0. So CD we got 8.33. And we got 24.93. So this is how we proceed. First, draw the diagram. Do the calculation of SUU, SUSD, CUU, SUSD, SUU, SUD, then SDU, SDD. So this diagram should be completed first. Then keep this diagram ready. Then write step 2, that we are using risk neutral approach and we are going to use same probability. Calculate value at the end of 3 months CU and CD. Then once you do that, we are ready to do evaluation of node 3 and we get the final answer. This is a very time consuming problem. Before you decide to attempt this in the exam, think twice. If you want to attempt for sure, practice this at least 5 times. Hope you understood this. Let us read this problem. The stock is currently trading at rupees 70 and put option exercisable in 6 months has an exercise price of rupees 80. The standard deviation of continuously compounded returns at a stock is estimated to be 26% per year. The annualized treasury bill rate corresponding to this option life is 12% per annum. The stock is expected to give dividend of rupees 15 at the end of 3 months. Determine the value of a 6-month put option. Extracted from tables, natural logarithm, value of e raised to minus 0.06, e raised to minus 0.03, cumulative normal distribution value of negative 1.5762 and negative 1.76 are given. Now this is a problem on Black-Scholes model, but there is a change as compared to the previous one. Here the stock is giving dividend. We know that Black-Scholes model cannot be applied for those stocks which pay dividend. And if you want to apply Black-Scholes model to find the price of a dividend paying stock, then you should remove the effect of dividend. Then only you can find the price of an option using BS model or Black-Scholes model. Let us see how we solve this problem. We can do by 2 methods. First, find the value of call S minus X and D1, present value of X and D2. And then use put call parity theorem. S plus P is equal to C plus PV of X. So this is method 1. Find call and use put call parity. Method 2 is find put directly. What is put option? X. Intrinsic value is X minus S. When you access put, when you are going to get strike price at expiry, so e raised to minus RT. And here we have N minus D1, N minus D2. Now in the study material they are given this method, so we can use this method. We can use either of the methods to calculate. Now here one major difference is stock is giving dividend and dividend is given in absolute form. So we have to calculate S star, S, that is stock price. We have to remove the element of dividend, S minus D, e raised to minus R T2. Now T2 is a period when dividend is going to be given. It is given at the end of 3 months. So T2 is 3 months. Now let us write down what are all given. What is S? S is 70. What is T? T is 6 months. Strike rate 80. R 12%. Sigma 26%. And given e raised to minus 0.06 to 0.9418, e raised to minus 0.03, 0.9704. Now let us first calculate D1 and D2. D1 is equal to natural logarithm of S star upon X. Why S star? Why not S? Because in this problem stock is giving dividend. So I need S star. And that will be put here. So S star upon a plus R plus sigma square by 2 T upon sigma root T. D2 is equal to D1 minus sigma root T. One more important thing you must remember about S star is, if stock is giving dividend, then our formula, this S star will be like the S star. This also will be S star. So you can see where all we have put S star. Here, here, here. So wherever S is there, it will be replaced by S star. Where we have S, in call option formula we have S. In put call parity we have S. In this put formula we have S. So, and here also natural logarithm we have S. So instead of S we have to use S star. Now let us calculate S star first, where S star is S minus D e raised to minus RT2. S is 70 minus 15 e raised to minus 0.12, 12, 70 minus 15 e raised to minus 0.03. So when you calculate this, 0.9704 into 15, 70, 55.44. So therefore D1 will be equal to natural logarithm of 55.44 divided by strike price, that is 80, plus R square, 0.12 square plus 0.26 square divided by 2 into T. Now this is very important to remember, this should be years. This should be in decimal. This should be in decimal. So let us complete that. Divided by sigma root t. 0.26 into root 6 upon 12. When you calculate, you get. Now remember, natural logarithm is minus 0.3666. So we get the answer here minus 1.5764. Now this will be 0.5 square root into 0.26. 0.1838. Why this is useful? Because in D2 we need this. D2 is equal to D1 minus sigma root T minus 1.5764 minus 0.1838. 1.7602 negative. So now they have given cumulative value of normal distribution. Means what? See, in Black-Scholes model, we use normal distribution values. This is 0. This is negative. And here we have positive side. And this is minus here. So let us assume that it is here. 1.5764. In Black-Scholes model, we need this area from the point to minus infinity. So we need this area. Now they have given this area directly 0.0575. So they have given cumulative value 0.0575. This is cumulative value. So whenever cumulative value is given, you can straight away use it because it is the area from the point to minus infinity. So we can use this for ND1. Now if I use this, C will be equal to S star 55.44 into ND1 0.0575 minus 80 e raised to minus RT e raised to 0.12 into 6 upon 12 into ND2. Now ND1, let us write here ND1 0.0575 ND2 0.0392. So this will be equal to 0.0392. So when you substitute this, you will get 0.23. Let us verify once. E raised to minus 0.06 is 0.9418. At 0.23. So we're getting call option is equal to 0.23. Therefore, using put call parity, we can find P. So this will be S plus P is equal to C plus X e raised to minus RT. Remember this we used to write as PV of X. So S is 70 plus put option equal to 0.23 plus 80 into e raised to minus 0.06. Therefore P equal to 0.9418 into 80 plus 0.23 minus, sorry, one mistake here, this should be 55.44 S star, 55.44, 20.13. So this is how we calculate the value of put option. So this method 1 where we have calculated. Now this method has been given in your material. So always know how to find the value of call, then use put call parity theorem. Method 2 we can adopt now. Method 2 directly calculating. This is also acceptable, where price of put is equal to intrinsic value X minus S e raised to minus RT n minus D2 n minus D1. Now what is, we have one formula, n D1 plus n minus D1 is always 1. So this is very important to note. Means when you take any value, say n of 0.75 plus n of minus 0.75, this will be 1. So when you take n of any value, so you'll get same. So here we will use this concept. So here D1 itself is negative. You have to be very careful here. You should not be doing a mistake. So here our D1 we got it as minus 1 point. So here it will be minus 1.5764. Here D1 is negative plus n of minus 1.5764 is equal to 1. Now we need n minus D1 here. Just see here. We need n minus D1. So we need this. Or I can say I need this. Now they are given this. So therefore n minus D1 will be equal to 1 minus 0.0575. So because they are given this as 0.0575. So this will be equal to 1 minus 0.0575, 0.9425. Similarly, n minus D2 will be equal to similarly 0.0392. .9608. I'm going to use this input call formula, but again we have a star here. So P is equal to X. X is 80 into e raised to minus RT. So that is e raised to minus RT minus 0.06, 0.9418 into n minus d2, 0.9608 minus s star 55.44, 0.9425. So 80.9418 into 0.9608, 72.39 minus 52.25. Getting 20.14, almost same. See, almost same. Now you can do by any method. Now I have, if d1 or d2 is negative, then this calculation becomes very tough in the exam. So mark this important in case you want to follow the second method. First method is equally easy. First find the value of call, use put call parity. Now the most important things you have to remember, the trap. If the normal distribution is not cumulative, then we should learn. Then instead of e raised to minus rt, they give e raised to rt. You have to be careful. When a problem involves stock giving dividend, we should not forget to use S star instead of S. So these were the important learnings in this particular problem. Hope you have understood this. Okay, let us see now valuations part 1, that is valuations related to dividend discount model. Now this is a very important part of SFM, and this chapter has applications in portfolio management, valuations too, that is corporate valuation, and also in foreign exchange. Very important, and the concept of this valuation is going to be useful in the chapter of bond markets also. So very important chapter. Therefore, I generally teach this valuation DDM ahead of so many other chapters. Now let us see what all you can expect from this chapter. Now this chapter, generally you get a problem where you are asked to find the price of a share, and they will give the information on dividend and its growth. So therefore we are having this chapter, the tag dividend discount model, DDM. Now DDM was given by Gordon. Now Gordon says that you can find the price of a share if you know, if you know what it gives, and if you discount what it gives. Let me explain this. So any asset can be valued from the inflows what we get from that asset. Suppose I invest in real estate, I get rentals. So that is the inflow from real estate, I discount. And when I discount, I can find a value. Similarly, when I invest in equity shares, what does equity share give me every year? Dividend. So when I discount dividend, I can find the value of the asset, that is value of equity share. So this principle was applied by Gordon, and he brought out the most popular model called dividend discount model. So what we do is, we discount the dividends using expected rate of return. Suppose I expect 10% return, so my K is 10, and the company is giving dividend, then I write first year dividend, second year dividend, third year dividend, and so on. And when you do it, you get price of equity share today. So according to Gordon, price of an equity share is nothing but future dividends discounted. Remember the word future. Suppose companies declare dividend this year, it should not be taken into account because it has already been obtained. We have already received it. So it is out of question to discount it. Whatever you are going to get from next year, only those will form part of the calculation. So dividend discount model says that price of a share today, so therefore we have 0. So this represents today, is nothing but future dividend discounted. If future, this is future dividend. Future. So you discount only future dividends. Gordon gave 3 approaches. First approach, constant dividend approach. Under this approach, Gordon said that price will be equal to D upon K. Remember, the word constant is there. Now when I say constant, D1, D2, D3, Dn, whatever it is, everything is same. Therefore we have D here. Whenever a company is giving constant dividend forever, now we had some companies which gave 1 rupee dividend every year, that's all. So in that case, you discount 1 rupee with your expected rate of return, you get a price of a share. Now this concept we use, in suppose I am investing in a 10-year project and the project is such, it could be a kind of a machine which will give me 1 lakh rupees per annum for 10 years. So 1 lakh is constant per annum for 10 years. So 1 lakh divided by, assume that my expected rate of return is 16%. So 1 lakh divided by 0.16 will give the valuation of that machine or valuation of the project. So what I am trying to say is, the cash flow, whenever the cash flows are constant, so write that cash flow and discount with expected rate of return. It is an equity share, therefore we are writing dividend. If it is a bond, we will write coupon. So this is a very useful. If it is a preference share, we write preference dividend. So like that, this particular equation, this particular formula is very important. So whenever they give constant cash flow, constant means same cash flow every year, forever. Same every year, forever. Then we use this formula. Gordon's second approach was constant growth approach. Now growth of what? Growth of dividend. Now dividend is going to grow forever. Growth of dividend forever. In that case, the formula given by is P0 is equal to D1 upon K minus G. Now D1 is future dividend, next year dividend. So today I am calculating P0. It will be D1. If it is P1, it will be D2. If it is P2, it will be D3. If it is P16, it will be D17. So when I discount, you have to find when you are finding the price. I am finding price in the 5th year. And I have to discount 6th dividend, like that. So this will be always, I will put arrow other way. +1. So it's very useful in the exam. The problems come. It has come many times. Find the price of share in the 4th year. So they will ask P4. assume that the dividend is going to grow forever. So P4 equal to D5 upon, like that you should do. So general formula is P0 equal to D1 upon K minus G. D1 is our next year dividend. I am talking in front with respect to P0. K is expected rate of return of the investor, and G is a growth of dividend. Very popular formula. This can be used for valuing projects also. Suppose a project is going to give me cash flows which are going to grow 6% forever. So, and I know today's cash flow. So add 6% to it, I'll get next year cash flow divided by K minus G will give me the value of the project. Please understand, the principle is same. If I am finding out the value of project, I will use the word V0. I will use the word CF1 upon K minus G, which is same. So if it is share, we write P0 D1. If it is project, we write V0 CF1 like. Okay, so this was the second approach of DDM. Then third approach, two-stage approach. Which is broken into two parts. First stage, second perpetual stage. Now perpetual means this one. So this is also called perpetual model. Perpetual growth or perpetual model. Perpetual means forever. So remember this particular, suddenly you will get a question. Instead you'll ask, calculate shares using perpetual model. Perpetual means growth is forever. Assume perpetual growth means assume constant growth forever. Perpetual means constant growth forever. That is the meaning of the word perpetual. So these terms are very important. Now in the second stage, the first in the two-stage approach, there will be two stages. First stage, second stage. Second stage will be perpetual. So we write P0 equal to D1 upon 1 plus K. So we individually discount dividend. Suppose I write Dn upon 1 plus K raised to N. So this will be, suppose N is 4 years, then first stage is 4 years. N is 3 years, first stage is 3 years. And second stage is perpetual. So it will be Dn plus 1 upon K minus G into 1 upon, so it will be plus 1 upon 1 plus K raised to N. So you can just see what all I have written here. This is N, this is same, this is N, this is plus 1. So this one, so if N is 4, then you can easily write up to 4, then D5 upon K minus G, and so on. So whenever they give a problem where they are giving individual dividend growth rate for first n years, then you discount by first stage, and then they will give perpetual growth forever. So put a, so in from there will be you will put a stop there for individual discounting and then perpetual discounting. So the perpetual discounting formula comes here. This one is from the second part. Okay, so we have problems. So when you will understand from the problem I have explained again. Now Sometimes there may be 4 stages also, 3 stages also. So we'll, there is something called H model. So it is not specifically mentioned, but we let us learn that. So in that multiple stage growth, so we have P0 equal to stage 1, stage 2, and then stage 3, which could be perpetual. Remember one thing, if you want to find the price of a share, you must account for dividends till infinity. It is absurd to calculate price of a share just by discounting next 20-year dividend. 20 is a big number, of course, but you have to discount till infinity. Therefore, the last stage will always be a perpetual stage, because perpetuity takes up to infinity, forever. The last stage is always forever. Now, before last stage, there may be 2 stages here in this case. So in this case, it could be, a steep growth of dividend. It could be linear growth, then perpetual growth. Now this particular problem was asked in November 2020 exam, and you can see the problem where I've explained everything. So initially there is a steep growth. Now dividend is growing at a steep rate. Say from 12% to 20%. Then there is a linear fall to 16%. Then it is maintained at 16% forever. The dividend growth rate is steep, so discount individually in the first stage. Then linear fall, again discount individually in the second stage. Then constant forever. Then use the perpetual model, that is d1 upon k minus g. So that model you use for the third stage. Now the term linear you have to understand. Now this, you can see the problem, 2-3 problems are solved. From there you can get a revision. But let us see what is the meaning of the word linear. So linear word comes from line. Linear comes from line. So when I draw a graph, this is a line. Suppose first year, second year, third year, fourth year, fifth year. So this is first year, second year, third year, fourth year, fifth year. Now, linearly, it is growing linearly. Now, linearly means, suppose the dividend is, let us say it is 12, 13, 14, 15, 16. So you can see that over a period of 1, 2, 3, 4, dividend is linearly growing. See, 1, 2, 3, 4. What is the difference between this? 16 minus 12 equal to 4. sorry, 16 minus 12 divided by 4 equal to 1%. So 1% growth. What is the difference here? 5 minus 1 equal to 4 years. Or we'll just write like this. 16 minus 2 equal to 4% growth. 5 minus 1 equal to 4 years. So over a period of 4 years, over a period of 4 years, dividend is increasing from 12 to 16%. See, 12 over a period of 4 years, dividend is increasing from 12 to 16%. So per year, what is the increase? So 4% divided by 4 will give you 1% growth per annum. So this is your linear growth. So 1% every year. If the growth is 1% every year, then rate of increase, that is 13 minus 12 here, is equal to 1 per year. Similarly here, it is 14 minus 13 for 1 year. Similarly here, 15 minus 14 per year. Similarly here, 16 minus 15. So you can see the slope at every point is same. Therefore, you are able to draw a line. Therefore, we call this linear growth. The linear growth means you have to apply, equally per annum. So let me give some different example. Suppose they give in the exam, that dividend is going to grow from 10% to 20%. Linearly, they will use a word. Dividend is going to grow from 10% to 20% linearly over the next 4 years. Now, what is the difference here? 20 minus 10 equal to 10. What is the difference here? 5 minus 1 equal to 4. Therefore, what is growth per annum? Growth per annum will be 10 upon 4 equal to 2.5%. So every year 2.5%. So suppose I am discounting, assume that we have a 3 stage like this. This is stage 1, this is linear, and this is perpetual. Suppose here it is 10%. That is stage 1, last is 10%. Now linear, how many years are there? 4 years. 1, 2, 3, 4. So here I should apply 12.5. Because 2.5% is increasing. Then I should apply 15. Then I should apply 17.5. Then I should apply 20%. So I should increase every year by 2.5%. So linear means, see how many years. See difference in percentage. So percentage growth divided by number of years will give you dividend increase per annum. And you should apply. So November 2020 problem I have solved and see. Now here what I demonstrated just now is a linear rise. It could be linear fall also. Dividend fell. Dividend fell from 20%. It fell from 20% to 15% like that. So 20, 19, 18, 17, 16, assume. So in that case, what is the difference? It is falling, remember. In that case, what is 16 minus 20 equal to minus 4%. Number of years is 4 equal to minus 1%. So every year you should decrease the dividend growth rate by 1%. So in November 2020, they gave about fall. They can give increase also. A company which is growing at full speed. So linear growth can be in the first stage. Linear growth could be in the second stage. If it is in the first stage, it is usually positive. If it is in the second stage, it is usually negative, means it is falling. So November 20, they ask this. So when you see the problem, I have explained that. So how to find out? Just summarizing, you should find out what is the difference, what is the growth, total growth. They will give in the question clearly. Dividend grew from 16% to 20%. 20 minus 16, 4. Dividend fell from 16% to 12%. 16 minus 12. So 12 minus 16 minus 4. Fell means negative, minus 4. Over 4 years. So you get years. Percentage growth divided by number of years will get you percentage growth per annum. And that we should apply. Very, very important. Now, so this is all about valuation. Certain other formulas you must remember in this chapter. And before I forget, there is a dedicated problem on rights issue, which is included with this problem number, last problem. So that is on valuation. So valuation of rights, they have not yet asked even once, but I have included one full dedicated problem. Let's go through it. Very easy. You might have mastered in the previous classes, but still do not take it lightly. It did come in the old syllabus very recently, so you could get any time. Now coming to important formula. Now dividend growth rate can be calculated by multiplying B and ROE. What is B? B is a retention ratio calculated as 1 minus dividend payout ratio. So many problems you will see dividend payout ratio they will give, and you are expected to remember that for G we need B. So B you can calculate from dividend payout ratio by 1 minus DPO. Now what is dividend payout ratio? DPS upon EPS. Whatever earnings company made, how much they distributed to shareholders per share basis. Earning per share denominator, dividend per share numerator. So when you do DPS upon EPS, you get dividend payout ratio. And when you do 1 minus dividend payout ratio, you get B. Once you get B, you can calculate G. And the G is useful in our dividend discount model. Okay, very important formula. Now, ROE. ROE is given as PAT upon equity. Now, DuPont gave a formula and he wrote like this: PAT upon sales into sales upon assets into assets upon equity. You can see they are getting cancelled. So it is ultimately PAT upon equity only. Now what is this? This is your net profit margin. See, if you are not aware of this, you are expected to write all this rapid revision course. I am covering everything. So if you have written down everything what you see in the video, you have created a book to be read on the last day, and sufficiently you can cover the entire book. Okay, net profit margin, and this is called asset turnover ratio. And this I will write it as debt plus equity, because assets of the balance sheet. On the left hand side what we have, equity and debt. So we will write D plus E upon E, or this I can write as 1 plus debt upon equity. So this he calls it leverage. So debt equity. And this problem also came in November 2020. This entire thing. So they gave this, they gave this, they gave this, and you are expected to calculate G. So from here we got ROE. So ROE was indirectly given as the breakup of these three, and this G is also called as sustainable or maintainable growth rate. So they may ask, calculate is already popularly called SGR. SGR, sustainable growth rate. So G will be asked to be you are expected to calculate G. So they will give B indirectly, they will give ROE indirectly, and once you get G, you can substitute in the dividend discount model formula. So it's very popular, ROE. Now if you see the balance sheet, so we have assets, we have a liability. In liability you have share capital, you have reserves, and this is external liability. External liability. This is own funds. Share capital is the promoter's own money. Reserves, own earnings, which he has generated from the business. Now, what is this called? This is called net worth. This is called net worth. Also called as book value. So, share capital plus reserves is your book value. So, book value is equal to share capital plus reserves. Suppose I want to calculate PAT. So what I do ROE into book value. So they will ask you to calculate PAT by giving share capital, reserves, and ROE. So you should do PAT is equal to ROE into book value. Now when you divide by number of shares, divide by number of shares, you get PAT upon N is equal to ROE into book value upon N. So what I did, I divided by a number of shares on both sides. So PAT upon N is what? EPS is equal to ROE into book value per share. So our EPS equal to ROE into book value per share. So all these formulas, so this formula, this formula, this formula, this one, this one, this one, they all will be used in the exam. So they will give you indirectly, and then you are expected to apply concepts and generate the formula or calculate it. So all these are connected with dividend discount model, where G can be calculated using its various elements. Now this PAT, ROE into book value, this is very important. Sometimes it will not strike. Similarly, this is also very important. Okay. Now, this is what you will be studying in the entire chapter. And this chapter I have seen till now, at least 8 marks have come in every exam. And everything I covered, trust me, I covered everything here. Okay, hope you understood this. Let us now take the formulae from the chapter of valuation. We are dividing this valuation chapter into 2 parts, that pertaining to dividend discount model or DDM and corporate valuation. We will see DDM valuation part first. Which are the formulae you have to learn or concepts you have to learn in this chapter? Suppose a company is paying dividend which is constant throughout, what we call as constant dividend approach. So a constant dividend approach, so we will have D. Constant dividend means D1 will be equal to D2 equal to D3 equal to Dn equal to D. Every year you will get only D. In that case, we simply divide the dividend by expected rate of return. You can see that we are getting P0 equal to D upon K. Now, in the exam, you rarely get problem of constant dividend approach. But you can get this particular concept in a different form. For example, they may ask, find the value of the project which gives constant cash flow forever. So that cash flow, we will be writing CF divided by K, expected rate of return, and this will be the value of the project. So the concept, you have to remember the concept. Remember, if you are discounting dividend using expected rate of return, we get price of share. So we get price of share. If you discount cash flow with expected rate of return, we get value of the company, value of the project, we can say. Suppose I have a project and that project is going to give 10,000 rupees every year for 5 years, or sorry, 10,000 rupees forever. So then 10,000 divided by expected rate of return will be the value of the project. Similarly, we are going to see next, we have bond market where a bond is giving same coupon forever. So that is a perpetual bond. So the concept is, whenever you are getting something perpetual forever, then whatever we are getting, that will be in the numerator, and whatever is the expected rate of return will be in the denominator. So we have P0 equal to D upon K. Now if you have constant growth approach, then we have P0 equal to D1 upon K minus G. So where D1 is a future dividend, G is the growth rate of dividend. Please understand, this is very, very important. Now this G is growth rate of dividend. Now in the exam, if they give the growth rate of earning is 10% and there is no other information of dividend growth rate, then you should assume that, let us assume that growth rate of dividend is same as growth rate of earning, and then you should use. So G is very, very important. It is growth rate of dividend. So when growth rate of dividend is given, and when you know next year dividend, so that is D1, we can find the value of share today. This is your constant growth approach. Now the third type is two-stage growth approach. So in two-stage growth approach, we actually have two stages. You can just see here. This is stage 1 of 5 years. And this accounts for year 6 to infinity. So we have to account for dividend in the first stage. So we do it individually, d1 upon 1 plus k, d2 upon 1 plus k square, till d5 upon 1 plus k raised to 5. So this is your first stage. Then from here second stage starts. And in the second stage, it is perpetual growth. Means whatever dividend was there at the end of 5th year will grow perpetually. So we have d5 into 1 plus g, k minus g into 1 plus k raised to 5. The best way to write this will be like this. P0 equal to d1 upon 1 plus k, d2 upon 1 plus k square, plus d5 upon 1 plus k raised to 5. So this is your first part, first stage. Second stage, instead of d5 you write p5, p5 upon 1 plus k raised to 5. You remember these are same, 1 plus k raised to 5, 1 plus k raised to 5. Here it is d5, d5, p5. Now in the first stage I am accounting for dividend from year 1 to 5. And when I say p5, what is p5? P5 accounts for dividend from year 6 to infinity. And remember, we are assuming perpetual growth from year 6 to infinity. Mean the last year dividend d5 will grow perpetually forever. So the first stage discounts dividend as it comes, and it discounts individually, and subsequently beyond year 5 it is perpetual. So we write p5, and p5 is nothing but d6 upon k minus g. So that is this part. And p5 you calculate at the end of 5th year. So therefore you discount 5 times. So similarly for a two-stage growth model, where first stage is 3 years and the perpetual stage is after 3 years, we can write P0 equal to d1 upon 1 plus k, d2 upon 1 plus k square, d3 upon 1 plus k cube. So this is for the first stage, plus simply write p3 upon 1 plus k cube. That's all. So d3 will become p3 and this will remain same. What is p3? p3 is d4 upon k minus g. So this p3 is this. So like that we can do the two-stage growth approach to calculate price of an equity share. Which are the other formulae you are supposed to learn? Now whenever growth rate of dividend is not directly given, then we have to multiply retention ratio B into return on equity, where B is equal to 1 minus dividend payout ratio. Now what is dividend payout ratio? Dividend payout ratio is DPS upon EPS, how much earning the company has made. Out of that, how much dividend the company gave. So that will give you dividend payout ratio. So 1 minus dividend payout ratio will be retention ratio. So this retention ratio B is very important. Then how you calculate PAT? What is profit? Now suppose I invested in my company. Assume that I started a small company. I put 1 crore. Okay, so 1 crore is my book value because it is my money. What is book value? Share capital plus reserves. So I invested 1 crore in the business. So my share capital is 1 crore. Suppose I earned 15% on that 1 crore. So that is return on equity. So 15% on 1 crore. So I will be getting 15 lakhs. So 15% on 1 crore. 15% is return on equity. 1 crore is book value. You can see book equity. You can see ROE into book equity will give you PAT. So profit is nothing but ROE into book value. Now book equity. What is book equity? Equity capital plus reserves, also called book value. Suppose you want to calculate book value per share, then divide by number of shares. So book value per share will be, so we can write BVPS is equal to book value divided by number of shares. Now suppose I divide this entire formula by n. Now suppose I divide this PAT divided by n. Divide PAT by n. So here also I will divide by n. So PAT divided by n is EPS. And book value divided by n is book value per share. You can see that PAT is equal to ROE into book equity when you divide by number of shares on both sides, because EPS equal to ROE into book value per share. Again, this is a very important formula. Now, this is a specific condition. This is a specific condition, means whenever return on equity generated by the company equals expected rate of return, whenever return on equity is equaling the expected rate of return generated or expected rate of return of the investor on the company. That is a better way to understand. Company earned ROE, investor expected K, and when ROE equals K, then we can calculate P ratio as 1 upon K. We can calculate P ratio as 1 upon K. Or I can say K is equal to 1 upon P ratio. Now whenever they give in the problem ROE equal to K and you require K for calculation, then what you can do is you can take reciprocal of P ratio. So when you take reciprocal of P ratio, you can see here I get K. So this is a specific condition. Please remember, we can't use this everywhere. And suppose they give P ratio and they are not given K, then you can take inverse of P ratio, 1 upon P, that you can take it as K. But you should write the assumption that we believe that it's a specific case of ROE equal to K. So finally summarizing, whenever ROE is equal to expected rate of return of the shareholder, we have a license to use K is equal to 1 upon P ratio. Next we come to sustainable growth rate. Sometimes they will not give G. then we have already calculated G is equal to B into ROE. You can see here B into ROE. So we write B into ROE. Now DuPont gave this formula. So this is DuPont's formula for ROE. So 1 plus this is leverage. This is asset turnover ATO, and this is net profit margin. So DuPont says that ROE is a combination of three factors. One is leverage, means the amount of debt the company has used. Second is asset turnover ratio, assets which are held by the company, how frequently they are turned in a year to generate profits. And third one is net profit margin. I think it is, I said, written exactly reverse. Net profit margin, asset turnover ratio. So according to DuPont, ROE is a factor of leverage, net profit margin, and asset turnover ratio. So in the exam, sometimes they will ask, calculate sustainable growth rate, and they will give all these things. So in that case, you are supposed to calculate this way. So these are all the formulae we are supposed to learn, concepts and formulae from this chapter. Hope you understood. Let us read this problem. A company has 25 lakh shares of face value rupees 100. Its reserves and surplus constitute rupees 1500 lakhs. Its return on equity is 15% and follows a policy of retaining 60% of its annual earnings. If the opportunity cost of capital is 18%, what is the price of its share? Make suitable assumption. This is a popular problem on finding the price of a share using Gordon's dividend discount model. So the assumption pertains to dividend discount model, and the required informations are given, though slightly indirectly. Let us see how we solve this problem. So first we will write we assume dividend discount model assumptions to hold true. In this problem, the part of earnings that will be retained, that is 60%, is given. So that part of earnings which is not retained is paid, that we call as dividend. So this problem has the following information given to us. Let us write them one by one. N is equal to, that is number of shares, 25 lakhs. Face value is equal to rupees 100. Now this will give us share capital. Therefore share capital rupees 2500 lakhs. Then we are given reserves and surplus equal to 1500 lakhs. So we call share capital plus reserves and surplus as book value. Is equal to 4,000 lakhs. At this point, you would be wondering why we have calculated book value. Please note in the problem, they have given 60% of annual earnings shall be retained, but they have not given earnings. So without calculating earnings, we cannot calculate how much is retained or how much is paid. So without earnings, I cannot get dividend. Now how to get earnings? They have given return on earnings, ROE. See, ROE given is 15%. So return on equity, ROE is given, return on equity. So what is equity? Equity means own funds. So these are own funds. So return on this will be your earnings. So we have this formula, PAT is equal to ROE into book value. So whatever I have invested in the business, equity plus whatever I garnered over the years, that is reserves and surplus. So that is my capital today. How much return you earned on that? 15%. So 15% into 4,000 lakhs is equal to rupees 600 lakhs. Is my earnings this year. And remember, an assumption of dividend discount model is that ROE remains constant. We are not supposed to write assumptions anywhere. I said in the beginning also, whenever we are writing on the top, we assume dividend discount model, comma, its assumptions to hold true. We can write its assumptions to hold true. We have got PAT. Now I can find EPS. EPS is equal to PAT upon number of shares. 600 lakhs upon 25 lakhs. That will give you 24. Now how much is retained? Retained is equal to B is equal to 0.6 or 60%. Therefore paid is equal to D equal to 0.4 into rupees 24. That is 9.6. So we have got dividend. Now what does dividend discount model state? Dividend discount model gives us the formula for calculating price of share. P0 is equal to D1 upon K minus G. Again, you should be writing here that I am going to use one more assumption. I am assuming that dividends will grow perpetually. So here we assume perpetual means forever. perpetual growth of dividends at G percentage rate. Now we are not given G also in the problem. Now let us see, if I want to find a value of share, I have K, that is given as opportunity cost of capital is 18%. We know D, but we don't know G. So we have to calculate G. So we have formula G is equal to B into ROE. Whatever the company is retaining, the return into retained will give us the growth in the company, and this ROE is going to remain constant, and dividend payout ratio will remain constant. These are all assumptions of dividend discount model. So if ROE remains constant, it will be 15%. Dividend payout ratio will remain constant, means retention ratio will remain constant, that is 60%. So 60% will remain constant. 15% ROE will remain constant. So 15% into 60%. So 0.6 into 15%. This 9% will remain constant. So growth will be constant, perpetual. Therefore, I can use this formula. So that is a logic actually. So therefore, we can calculate D1, D0 into 1 plus G, 9.60. And therefore we can calculate P0 as 9.60 when you calculate this, $116.27. So this is the correct answer. So how we have proceeded? First of all, when we read the problem, we got a hint that we can find the price of share using dividend, because we can find price of share by various methods. But which method to use? Which formula to use? How will you come to know? So we find that they have given earnings, they have given retention ratio. Indirectly, we can find dividend. Therefore, we are going to use dividend discount model. Then, once we know the dividend discount model, we must know this formula. P0 is equal to D1 upon K minus G. But what we did, we first calculated dividend, because for finding that we want dividend. For getting dividend, we want earnings. And for getting earnings, we need book value. Then only ROE into book value will give PAT. Divided by number of shares, we get EPS. Then when you remove the retention ratio, you get payout ratio. So payout ratio into earning will give us dividend. Then our next task was, we wanted growth. And I explained to you that growth is nothing but B into ROE. And assuming perpetual growth model, we got P0 equal to D1 upon K minus G. After substituting, we got the answer 116.27. It's a fairly easy problem, but still you have to execute it correctly to get full marks. Hope you understood this. Let us read this problem. Comment on the quoted share price based on the following data. So we are provided with details of income statement, and we are also provided with dividend payout ratio, number of shares issued, ROE, and expected rate of return of investor, that is K. And we are provided with current market price of rupees 20. So we have to comment. Now what we will do? We will first calculate theoretical share price and then we will compare with market price. So theoretical price versus market price comparison. This also involves an assumption. So we are going to assume that dividends are going to grow perpetually. So again a problem involving DDM, dividend discount model. Let us see how we solve this problem. Now what I have to comment is given that whether they are undervalued or overvalued. Now how you can do that? Only when you calculate theoretical share price. So you calculate theoretical share price, compare with current market price of 20 and then say whether shares are overvalued in the market or undervalued in the market. So we have to calculate theoretical share price and we are given dividend payout ratio. We can calculate PAT, profit after tax, from the table, and therefore we can calculate earning per share. So using that and dividend payout ratio, we can calculate dividend per share. And once we calculate dividend per share, using the other data, we can calculate the theoretical share price using dividend discount model. So what is the formula we have to use? According to dividend discount model, P0 is equal to D1 upon K minus G, or D0 into 1 plus G upon K minus G. Now expected return of investor is given directly. So this is given. Now G is not given, but we know when ROE is given. When ROE is given, we have this important formula: G is equal to retention ratio into ROE. So this is retention ratio is equal to 1 minus dividend payout ratio. Now dividend payout ratio is given as 28%. 1 minus 0.28, 0.72. So therefore G can be calculated. G is equal to 0.72. ROE is given 12.08. So 0.72 into 12.08, 8.7%. So this is percentage. So we got 8.7%. So this is also obtained now. Now we have to calculate D0. Now D0 is EPS into dividend payout ratio. Now dividend payout ratio is given. So we have to calculate EPS. EPS means I need PAT. So I need PAT. So how to calculate PAT? We are given information here. We can calculate sales, or revenue is given, sales 4 lakhs. Then operating margin is given 40%. So cost of goods sold is 60%. 2,40,000, 1,60,000. So this is our operating profit. So this is 60%. So COGS 1 minus operating margin. %60. Then we can call it as gross profit also, minus admin expenses 40,000. Minus depreciation of assets 80,000. Loss on sale minus loss 10,000. So this will be 30,000. So this is your EBIT minus I. Interest 10% debt, 10% on 1,50,000. So this is EBT. Tax rate is 33%. So 15,000 into 33%, 4950. $10,050. So this is your PAT. Now what is the number of shares? Shares issued 1,000. So EPS, so 10.05. So once you get EPS, therefore D0 equal to 10.05 into dividend payout ratio 28%. 10.05 into 28%. 2.814. So they have made work in 2 decimals, so it will be 2.81. So we can write now P0 equal to 2.81 into 1.087 divided by 0.24, because they are given K, expected return is 24, minus 0.087. So it will be 2.81 into 1.087 we are getting 19.96. So 19.96. If at all you want to round off, so we can say it's approximately 20. In case you had used 2.814 into 1.087 divided by 0.153 then we are getting 19.99, so approximately 20 rupees. So if at all, you can say almost, which is generally prices don't trade at 96 etc. So we can say share is marginally overvalued or fairly valued. Okay, so we can say the third answer, share is fairly valued, can be accepted as the correct answer. In case it is written overvalued, because we have strictly taken two decimal, then also it is correct. So here, we will be asked whether it is overvalued. So we can say, we can write both like this. So in this case, we can write it is fairly valued. Suppose you don't write this, then you can say that share price is very close to share price, or theoretical share price is very close to quoted market price. Shares, though marginally overvalued, is as good as fair price. Sometimes in the exam, couple of exam questions I know, the answer differed in the second decimal or the third decimal, and student wrote overvalued, but institute gave, I remember a problem very well, institute said it is fair value, or the decision was unbiased. So better to write in this manner, better to incorporate this when you are getting very close answer. So instead we'll see you have done the correct calculation, 19.96 full marks, and you have also written that approximately equal to 20. Therefore your decision is like this: share price is very close to quoted market price, share though marginally overvalued, so you have written is as good as fair price, that also you have written. So you are trying to sit on the fence, here it works. Hope you understood this. Let us read this problem. The following data of the company X Limited is available. Earning per share and dividend per share are given. The above earnings are expected to grow at 20% over next 3 years. So also dividend. Subsequently, earnings will grow at 10% only. When earnings growth falls, X Limited will maintain a dividend payout of 60% to keep shareholders happy. If the expected rate of return of shareholders of X Limited is 16%, what is the intrinsic value of share of X Limited? Work in two decimals and use PV factors of 16%. So they are given to us. A very, very important problem, and it involves understanding of two-stage growth model. Now from which point we have to apply perpetual growth in a two-stage growth model. And this problem has been asked, if I recollect correctly, once. A very, very important problem in any examination. Let us see how we solve this problem. Now, what is the price of share using dividend discount model in two-stage approach? So we write d1 upon 1 plus k, d2 upon 1 plus k square, d3 upon 1 plus k cube, d4 upon 1 plus k raised to 4. I suppose this is the first stage. Stage 1, 4 years. Suppose this is the perpetual stage. So for perpetual stage, I write P4. So P4 is a share price accounting for dividend year 5 to infinity. But since I am finding P0, so I have to discount 4. So this is 4. So I have to discount 4 times. 1 plus k raised to 4. Where P4 is D5 k minus G2. Now this is stage 1, where we have growth of G1 percentage. This stage 2, growth of G2 percentage. This is a simple way we should be writing. Now in this problem, they have not given dividend information directly. So let us see how we should do this. Now EPS is given. Now current year EPS, let us say current EPS 9.56, DPS 3.84. Now let us see what is going to happen in the next 3 years. So we write year 1, year 2, year 3. Now year 1 is going to grow by 20%. So it is written that we should use only 2 decimals. So 9.56 into 20%, 9.56 into 1.2, 11.47. Now when you press 1.2 first and then 9.56 equal to will give you so 13.76, 16.51. Now you are supposed to round off to 2 decimal at every stage. Now so also dividend. So dividend also is that apply 20%. Now after this, the earnings growth is falling. Subsequently, earnings will grow at 10% only. So we apply 10%, 16.51 into 1.1, 18.16. Now we do this for 2, 3, 4 years. I'll tell you the reason. Now this way of solution is not given in the session answer. It is very difficult for a student to know from when we have to use the perpetual stage. So therefore this method is a foolproof method where you would know from when to use perpetual formula, that is the second stage. So let us do for the given earnings will grow subsequently 10%. We do for at least 3 more entries, 5, 6, 7. Though this may not form part of answer, but this is extremely useful for you to understand. So 18.16 into 1.1, 19.98, 21.98, 24.18. Now let us see what is given next. When earnings growth falls to X limited, X limited will maintain a dividend payout of 60%. Now let us take dividend payout. So now here it has fallen. So now it is going to keep 60% dividend payout. So now it will maintain 60%. Dividend payout is given by DPS by EPS. So EPS is, we want DPS. DPS is dividend payout ratio into EPS. So we should write 60% of 18.16. So that will be 10.9, 11.99, 13.19, 14.51. So we have drawn this. So let us fill up the DPO in the previous one. 3.84 upon 9.56, 40.19, again 40.19, 40.22. And this will be 6.64 divided by 16.51, 40.22. We verify this. And 3.84 divided by 9.56, 40.17. Now we are not interested in dividend payout, we are interested in dividend growth. By how much dividend is growing with respect to previous year. So we will write here G percentage. And we'll try to see from which year there is a constant growth, and that is the crux of the problem. So this will be, first one will be, so there will be nothing here, 4.61 minus 3.84 upon 3.84 into 100. So we'll do this. Get 20.05%. Then 19.96. Now actually it is 20% because it is growing at 20%. Dividend we are applying. So this should be 20, but we are getting this because of round off, since we are rounded off the DPS and EPS values. So you could as well write 20%, but you should actually calculate and write these values. It's okay. Then next we are getting 64.16% because there is a huge jump now. Then we are getting 10%, 10%, 10%. In fact, we are getting 10.01%. Now you can see in the G column, then we should draw a line from where 10% starts. So 10% starts from this. What is this here? So after 4 years, 10% starts. So we have got D1, D2, D3, D4. So D1, D2, D3 and D4. So these 4 will come here. And then P4. So the D5 will come here. G2. Now this is G2. G2 will come here. And they are given K equal to 16%. So given K equal to 16%. Remember, dividend is a post-tax cash flow. So when tax rate is given, do not get confused. If I am using dividend, I have already paid taxes. I have appropriated everything. Finally, I am giving to shareholders. So where is the question of applying tax? And remember, you have to find out who is calculating share price. In the world of taxation on dividend, on receipt, then we can think, then we should know the tax rate of the individual. So sometimes tax rate will be given, you have to be very careful. But when investor is calculating and tax rate of company is given, we should ignore. But if tax rate of individual is given and it is given that dividend is taxable in the hands of the individual, then only the tax rate will be applicable to be applied on D. Then they have given expected rate of return 16%. So what we do is we substitute all this. So now you understand why we did this extra. This extra we did because we just want to ascertain that dividend growth rate should be constant. So it is getting constant after the year 4. So 4 years will be first stage, beyond 4 years perpetual stage. So when we substitute, we get P0 equal to first dividend 3.84 by 1.16, 4.61 by 1.16 square, 5.53 by 1. Sorry, that is current, I should not take. I should take from year 1, 4.61, 5.53. It's better to draw a line here so that we don't get confused. Then 6.64 upon 1.16 cube, 10.90 upon 1.16 raised to 4 plus P4 upon 1.16 raised to 4. P4 is 11.99 upon 0.16 minus 0.10. When you use the given P factors and calculate, you will be getting the answer 128.66. The P factors are provided. You are supposed to multiply with the same. You are not supposed to round up. Yes, you have to verify whether it is indeed the P factor of 16%. If it is of 12% or something, you are not supposed to use that wrong data given in the question. This already happened with the institute somewhere in the year 2012. They gave one particular percentage, they gave some other P factor, and students who overused some other P factor got 0 mark. So you have to just verify once whether 1 upon 1.16 is indeed 0.862. So 1 divided by 1.16 is 0.862, and then equal to will verify every other thing. Just a matter of 5 or 10 seconds max. So you have to use the P factor, and this is how we are supposed to solve this problem. Very, very important problem. You should definitely give a look on the last day. Hope you understood this. Let us read this problem. An investor is considering to purchase the equity shares of LX Limited, whose current market price is rupees 112. The company is proposing a dividend of rupees 4 for the next year. LX Limited is expected to grow at 20% per annum for the next 4 years. The growth will decline linearly to 16% per annum after first 4 years. Thereafter, it will stabilize at 16% per annum infinitely. The investor requires a return of 20% per annum. Is it worth to purchase the share at this price? Now you can see that it is involving 3 stages. Now if you see, the first stage is, it is given here, expected to grow at 20% for the next 4 years. Then it is declining linearly. It is declining linearly to 16% after first 4 years. Thereafter, it will stabilize at 16% infinitely. So we have the first 4 years where we have to apply 20%. Then we have the next 4 years where we have to linearly reduce it. That is, reduce 20 to 16%. 19, 18, we'll just see how we do it. And then finally use 16% for the perpetual stage. This problem was asked in November 2020 exam, and it involves application of the concept linear. Let us see how we do this problem. Okay, this problem was asked in November 2020 exam. In fact, this was question number 6A. Now this was related to dividend discount model, but this problem I have selected for this revision course only because it has got the concept of linear. Now whenever anything increases or decreases linearly, now the word linearly comes from line. So when you draw a graph, say year 1, year 2, year 3, year 4, and we have got dividend growth rate 16, 17, 18, 19, 20. When I say linearly, it means as a year increases, the dividend growth rate increases and we are able to draw a straight line. So let us see this. Year 1, 16%. Year 2, 17%. Year 3, 18%. Year 4, 19%. So we can say that dividend has grown linearly from 16% to 19% over 4 years. So the jump you can see, in fact it was earlier 15. So 15 to 19 you must check, because it is 16 in the first year. So in the 0 year, it is this coordinate is actually 0, 15. So in the beginning it was 15. So we must take it like this. In the beginning it was 15. So 15 to 19. So 4 plus 4% increase and 4 years. So if you actually take, it is 1% for 1 year, 4% over 4 years. And if you plot, you can see you are getting line. Therefore, they call it linear growth. Now, this concept of linear growth was tested in November 2020 exam. So, in this example, we are going to see how we are going to use this concept and find the price of a share. Now, linear growth means it will be even, remember, even. For example, let us take another example. Suppose it is given that dividend grew from 12% to 20% over years 2018 to 2021. Now what is this? This is 20 minus 12, 8%. What is this? 21 minus 18, 3 years. So each year it is 8 upon 3. So the increase is 8%, 8 upon 3. So suppose if you do 8 upon 3, 8 divided by 3, it is 2.67. So it is 2.67% per year. So if they give dividend grew linearly from 12 to 20 over 3 years, means you must apply 2.67% increase for every, like that. So linear means you have to find the difference in dividend percent, you have to find difference in years, and then dividend percent upon number of years. So that's how we do. Then only you get a straight line. So the word linear comes from the word line. So you should be able to draw a straight line graph. So here also you can see, suppose you have 0 year, 1 year. So the dividend grew from, this is 12%. So this 0 coordinate is 0, 12. This is 2.67. 12 plus 2.67. This is 12 plus 2 into 2.67, like that. So when you draw a graph, you get a straight line. So this is the concept of linear. Now let us solve this problem. Question 6a. Question 6a came for 8 marks, and what are all given? Let us see. Now investor is considering purchase of equity shares. Current market price is 112. So current market price is 112. Now company is proposing a dividend for the next year. So we have got D1 is equal to rupees 4. LX is expected to grow 20% per annum for the next 4 years. Now is expected to grow. Now remember, first year dividend is already given. So when you draw a timeline, now this is 0, 1, 2, 3, 4. Remember, they are telling from the start. It is expected to grow 20% over the first 4 years. So the jump is, first year, second year, third year, 4 year. So how much it is going to grow? 20%. So if this was 4, which is already given, so I have to do 3 more jumps, because they are given expected to grow 20% for the next 4 years. So they are giving the statement at the start. So they are giving the statement here. So 20% for the first. Now first dividend you need not calculate, because they are given straight away. Expected to be 4 next year. So apply 20% on 4. We get 4.8. Again 20%, 5.76. Again 20%, 6.912. So you should be pressing 1.2 in the calculator first, and then into 4, then equal to, like that you will get. So D2 is equal to 4 into 1.2, 4.8. D3 is equal to 4.8 into 1.2, 5.76. D4 is equal to 5.76 into 1.2, 6.912. Now, after that, what they are given? The growth will decline linearly to 16%. Now they are given decline linearly to 16. So let us check this graph. Now it is 20 here. Currently it is 20 at time 0. At time 1 it will be how much? Now let us see what is the dividend fall. Dividend fall is 20 to 16. That is how much? 4%. What is number of years? Number of years is, it is given over next 4 years. After first 4 years, it declined linearly 16% after first 4 years. So after first 4 years means they decline linearly means actually they should be telling over next 4 years. They decline linearly means here it is assumed as 1%, but they should be clearly stating over next 4 years. So let us assume 1% fall. The number of years will be 4. So this will be 1% fall. So 4% upon 4 is equal to 1% fall every year. So they should be actually telling it will decline from 20% to 16%. They should be putting the sentence like this: the growth will decline linearly to 16% per annum over next 4 years. Like that they should say. They can also say over next 2 years also. In that case it will be 2% fall. But they are not stated, so we cannot expect that perfection in this. So we are assuming 1% linear fall. So this will be 20, then 19 in the first year, then 18 in the second year, then 17 in the third year, 16 in the fourth year. So when you join the points, so you get straight line. So you get straight line here. Just a minute. So this is what linearly, the linear adjective form of line. You get linear fall. So we are going to apply, now this is in our case it is the 5th year. So in this case this will be 19%. This will be 6th year. It will be 18%. This will be 7th year. This will be 17%. 8th year. This will be 16%. So like that. So these are all 20. Now here we need not apply because they are given 20% straight away. First year dividend is given. So 20, 20, 20, 19, 18, 17, 16. So let us calculate. So D5 will be 6.912 into 1.19, 8.225. D6 will be 8.225 into 1.18. That will be 9.706. Then D7 will be 9.706 into 1.17. It will be 11.356. This information will there be in the calculator. You need not erase it. You have to simply put 1.18, 1.17 like that. Now, so I have calculated all this. So 8.225, 9.706, 11.356. Now, I may write 8th year or I may not write. Why I am telling that? If you see the PV table that is given, it was given in the exam. PV table was given only for 7 years. It was not given for 8 years. Let us see the reason by reading the next sentence. the growth will decline linearly to 16% per annum after 4 years, after first 4 years. Thereafter, it will stabilize at 16% infinitely. So here, this stabilization rate is also 16%. So I can say that the perpetual growth is beyond this period. So this is your perpetual growth period. So perpetual growth period starts after 7 years. You can say why? Because in the 8th year it is 16%, but beyond 8 is also 16%. So I can easily say that from 7th year itself it is 16%. So then I don't need the PE factor for 8th year. I can apply perpetuity from the end of 7th year itself. Okay, so therefore we write, since we are provided with PV factors from 1 to 7 years only, and perpetual growth of dividend is 16% from 8th year, which is same as dividend growth rate in 8th year. We can apply perpetuity from let's write down this 7th year itself. Therefore, P0 is equal to d1 upon 1 plus k, d2 upon 1 plus k square, plus d7 upon 1 plus k raised to 7, plus d7 into 1.16 upon k minus 0.16 into 1 upon 1 plus k raised to 7. You can see that I am using only till 7th year. So therefore P0 is equal to 4.4 upon 1.20. Just 20% is a discount factor. You can see that investor requires a return of 20% per annum. Calculate the intrinsic value of share. So 1.20 plus 4.8, 1.20 square, 5.76, 20 cube, 6.912, then we have the linear rate 8.225, plus 9.706 11.356 plus 11.356 into 1.16 divided by 0.2 minus 0.16 into 1 upon 1.2 raised to. When you use the p factors, which is given, we get an answer of 114.90. So this was the answer expected from students in the exam using p factors only up to 7 years. Now, can I do up to 8th year? Can I use p factor up to 8th year? They are not given. According to me, no. Whichever information is provided to you, you must use only that. In the exam, they provided info till 7th year PV only, 7th year p factor only. Now, in order to show that we can also do till 8th year, so the p factor information I am not keen. I want to tell my students you can do by this method also, but in the exam you could not have done that. So we could have done P0 is equal to D1 upon 1 plus K, D2 upon 1 plus K square plus D8 upon 1 plus K raised to 8 plus, so here we would have applied D8 11.356, we would have got 13.173. So this is actually 11.356 into 1.16. Let me verify again. 356 into 1.16. 13.17296. So 13.173. I use that. And then I apply 13.173 into 1.16 divided by 0.2 minus 0.16 into 1 upon 1 plus K raised to 8. This will also give you the same answer. Okay, so approximately there will be some, approximately you get for 115 due to round off error. So you get the same. Here used PV factor till year 7. Used P factor till year 8. Approximately you get 115. You can just verify. But this answer you should have written in the exam. Those who have attempted, they should have got this. Ultimately, they are asking whether it is worth to purchase the share at this price. So decision, since MPS is less than fair price, one can purchase. So this is what you should have written to get 8 marks in the November 2020 exam. So the main concept in this problem was understanding the word linear. You can see so many traps were there in the problem. The trap number 1 was this information. See, they gave the first information of dividend and they said next 4 years. So there is a danger that student would have done 4 years after 4. That should not be done. Secondly, they gave P factor, they use the word linear. If you are not understanding that concept, then it is not, you are not going to do it. Third, they are given P factor only up to 7. That is a big trap actually. The student would be forced to take 8. I am not sure whether institute would be kind enough to give marks. They would say I gave only up to P factor 7. So where is the question of you taking another P factor? Though you can arithmetically calculate, but you are using information outside the question paper. So they may not give. Okay. So this is Ridium with linear growth. Hope you have understood this. Let us read this problem. Amco Limited has issued 75,000 equity shares of rupees 10 each. The current market price per share is rupees 36. The company has a plan to make a rights issue of one new equity share at a price of rupees 24 for every 4 shares held. Calculate the theoretical post rights price per share and theoretical value of the rights alone. Very simple problem on rights issue. This was asked in the recent exam of old syllabus. Though rights issue problem do not come in the CFL exam, since there is a mention of it in the material, it is better that we go through the basic problems. In fact, there are 3 or 4 problems which can come, but surrounding these two of them are put here, and we can examine the other 2 questions also along with this problem. Now let us understand what is a rights issue. Now basically we know rights issue is given to existing shareholders. Now the reasons could be so many, we are not going to examine that. The existing shareholders will have more faith in the company. They know the details about the company functioning, etc. And if the money to be garnered is fairly small, why not tap the existing shareholders? So that is a motive behind rights issue. And depending upon the funds required and depending upon how much capital or reserves the company needs to keep, the rights issue ratios are determined. Now suppose I say that I have n shares outstanding before rights, and P0 is the price of shares in the market. So then what is the market value? Therefore market value before rights will be n into P0. Now assume that the company is going to give rights of R shares for n shares held. So rights ratio is going to be R shares for every, or we can say R shares for n shares. So we can say that it is 1 share for every when you divide, so you get n upon r. Now why I'm telling this, sometimes if the ratio is not 1:4, suppose it is 3:16, so then it becomes a big problem. So let me put into example now. Suppose I have got example, n is 10,000 shares. Company is going to give 4,000 shares rights. Therefore, ratio will be 4,000 is to 10,000. Okay. So in that case, this will be 4 for every 10. Okay, here I wrote reverse. 4 for every 10. So this will be, you can see, this is our n, this is our r. So ratio will be, therefore ratio will be this, r upon n. That will be 4 upon 10 equal to 0.4. You have to understand, very simple thing, but the way I put here. So here we are taking care of how we write in the formula. Here I have taken care of an example. So this rights issue has been given. Now we want to find out this. What is going to be market value after rights? Now before rights is clear, n into P0. After rights, what is going to happen? Let us see market value. Okay. So we are going to write like this. Now theoretically, how much it should be? Theoretically, see, before is NP0. So market value after rights will be market value before rights plus additional value due to rights. Additional value due to rights. Now how we calculate that? Now we have to calculate theoretically. Theoretically, we don't know market price. Do we know at what price it will quote in the market after rights? That is not available now. What is available to us? Available is what is the share price today. What is going to be the share price after rights? We don't know that. But I know one thing. How much value I am adding to existing market value, I know theoretically, remember. So therefore we can calculate only theoretically, since we do not know market price of share after rights. We can calculate market value post rights only theoretically. Remember, I am calculating today. Okay, so I don't know what is going to be market value, market price of share after rights. I don't know. Theoretically, I can do. Just see how. Now, theoretically, if you see how much value I am adding, suppose if S is the subscription price of rights. If S is the subscription price of rights and R is the number of right shares So I'm going to get R shares for N shares. So I have total N shares, and again here I'm going to get R shares. And if S is the subscription price, so R into S will be, therefore SR will be the value added by way of rights. So I am adding SR. So S into R is getting added to the current market value. But I want to calculate total market value. So add it. Therefore, total market value in bracket theoretically will be NP0 plus SR. So this is the total market value theoretically. Okay, after rights. And right after rights. So now per share. Therefore, theoretical value, or you can write theoretical X rights value per share. Now some of them write it as TE, theoretical X, TEPR, post rights value, etc. Okay, so but we'll just ignore that. Per share, remember now per share, NP0 plus SR divided by N plus R. NP0 current market value, SR new value added by subscribing to rights, divided by total shares what you will be having post rights. You will be having your own shares and you will be having additional R shares. So this is the first very important formula, and this was asked in this problem also. Now this is the theoretical price, theoretical X rights price. X rights means X means post rights. Now what you call before rights? Before rights is called as cum rights. Now we used to have newspapers. Nowadays newspapers don't print all these things. We don't get stock quotes at all because everybody has gone digital. So whenever the price is there of a share before rights, so it will be 90. When the record date is approaching, they will write 90 CR. And once the record date is over, they will write 90 XR, or sorry 88, whatever new price XR. So CR means cum rights, XR means X rights, that is post rights. Now one can ask, what is the price of rights alone? Theoretical price, theoretical price of rights alone. This could be a question, and this will be asked in this problem also. What is the price of rights alone, only rights? Now, what is the subscription price? That we have to find out. How much price I'm going to pay to get right? I'm going to pay S rupees. Just see here. You can see this, we have highlighted if S is a subscription price of rights. So I am going to pay S. So I will pay S today. Then I'll get rights. And then it will quote in the market. Theoretically, it should quote how much? Theoretical X rights price. Here calculated NP0 plus SR upon N plus R should be the value of share after rights issue. So if I give S, my shares will be valued at NP0 plus SR plus N plus upon N plus R. So what is the theoretical value of rights? We can say it is the difference between what is the value of shares post rights. Okay. And what value you paid for rights. Now what is the value of share post rights? The theoretical TERV we can say, I'll just write in short form. TERV. So I'll write theoretical X rights value. So this is going to be, so I paid S rupees and the share price, theoretical X rights price was theoretical X rights value of this. So the difference will give you, suppose I paid 10 rupees for rights. I paid only 10 rupees. Then when I pay 10 rupees, I'll get one share. And after rights issue, it is quoting at say 12 rupees. So 12 minus 10, 2 rupees I got. So that is the value of rights. So that value of rights I got. So theoretical value of rights. Theoretical value of rights alone. Now this TRV minus S, this will give you theoretical value per right. So this is per right. Now I got one right share. Assume that. Let us take, when we do the problem, I'll explain to you this particular part. For now, just you keep writing. I'm sure in case you don't have notes, you can write, pause the video and keep writing. So per right, this is the value we should write per right. Now what about per share? Now per share, I have to simply divide by, so theoretical value of rights alone, but per share will be same thing, TRV minus S divided by N. Okay, these two you will understand with the example much better. So for now we'll be actually writing the formula. So in this problem they have asked what is the theoretical post rights price and theoretical value of rights alone. Either of the two answers would have got you full marks, as it was in the suggested answer. They said students could have either written the theoretical value of rights per rights or per share. Both would have been given full marks. If you write both, then good. Okay, so now let us see this problem. Let us see this problem. So solution. Amco Limited has issued 75,000 equity shares. So 75,000 is our N number of shares, 75,000 of 10 each. The current market price is 36. So our P0 is 36. So current market value is 75,000 into 30. That is the current market value, NP0. Company has a plan to make a rights issue of one new equity share at a price of 24. So 24 is your S. So I had to pay 24 rupees for every 4 shares held. So 1:4 is the rights. So our R is 1, N is 4, 1:4, like that. Okay, you can say this way. Calculate theoretical post rights price and theoretical value of rights alone. Now, let us write down all this. N is 75,000, S is 24, P0 is 36, R is 1. So 1:4, or R is, rights, we can write, let us not write like this. We'll write ratio is 1:4. Now actually this is, you have to think like this, R, N. Better you keep like this, write like this in examples. Now first question, theoretical post rights value will be NP0 plus SR. NP0 current value, SR new value you are adding. You are subscribing to R shares by paying S price divided by N plus R. So this will be 75,000 into 36 plus 24 into 1 upon 4 plus 1. So when you do this, so here you should be writing now, it's not one share, you will be writing 1 upon 4 SR. So here for how many shares you are paying? 24 rupees. So 1/4 into this into 24. Okay. 75,000 divided by 4 into 24, then 75,000 6 divided by 5. So what I'm writing here, I should be writing full value. I'm sorry. Number of shares 75,000 plus 1/4 of 7. So 75,000 into 36 into 750 into 24. $33.6. You get 33.60. So you should be writing total shares Remember, when we talk about 1 share, 4 share, but here the number of shares are given 75,000. So you should be actually using 75,000 for this and etc. So we get 30. So this is the, remember, current market price is 36. Since the number of shares are increasing, the value per share will decrease. So 33.6 post rights price appears absolutely perfect as per concept. So this is the theoretical post rights price. Remember, theoretical. So theoretical means obviously today rights issue has come. I am contemplating what will be the price later on. I know that it will be less than 36. So theoretically I should be able to calculate. So this formula will help us calculate theoretical rights price. Now theoretical value of rights. Rights alone will be, this will be the price, this will be the value of share. Suppose you subscribe. Suppose you had 4 shares of the company. If you had 4 shares of the company, how many rights you will get? You will get 1 right. How much you will pay? I will pay 24. If you pay 24 today and after rights issue, what will be the price in the market? It will be 33.60. So what is the value of your rights? 33.60 minus 24. This will be 9.60. So this is the value of rights alone. I repeat once again. When you are having 4 shares only in the company, you will be given rights subscription. To what extent? 1 for every 4. Means you can apply for 1 rights because you are having 4 shares. So when you want to apply for 1 right, how much you will pay? You will pay 24 rupees because that is the subscription price. Okay, you paid, you got the shares in your demat account. Post rights, theoretically, how much it will quote? It will quote 33.60. So how much value you have benefited, you have gained? That is the value of rights alone. So value of rights is post rights or X rights price minus subscription price. So that is 9.6. Now if you want to calculate per share basis, on per share basis, this will be 9.60 upon 4, 2.4. Per share basis it is 2.4. So this you can verify. You can see, verify share price before rights minus share price after rights. No, share price before rights, there were no rights. Share price after rights, there were rights. Okay, so the difference, so in our case it is, before rights it was 36. After rights it was 33.60. What is the difference? What is the difference? Difference is 2.4. So on per share basis, look at this. Okay. So this is what you should be doing to solve the problem. And this was asked for some 8 marks. Fairly easy problem, but it was an old syllabus. But it is there in the new syllabus, you could get. Now, 2 more things get asked. It is not there in this question, but I want to cover. Verification of gain or loss. If you apply for rights or ignore it, or I will write not verification, calculation I can write. Calculation of gain or loss. when you apply for rights and when you ignore rights. Generally, when rights issue form comes or intimation comes by mail or whatever it is, you consult, should I apply for rights? If I apply, what I'm going to get? Remember, when you are applying for rights, you are thinking that after rights issue, the share price will zoom and you will make money. Now, at times you think, why to apply for right? Let us ignore. We are going to see if you ignore what happens. If you ignore what blunder you are committing, we are going to see that. So, let us see. Apply for rights. Suppose you apply for rights. If we apply for rights, so we are going to see in the context of this problem. Easy to understand. If you apply for rights, what is going to happen? Now let us first say A. Value of shares before rights 75,000 into 36 equal to 75,000 into 36. It is 27 lakhs. Now we have to verify what is the value of shares post rights. It will be 75,000 into 33.6. Remember, we have calculated only theoretically. Actual could be more than 33.6 or less than 33.6. We don't know that. But let us assume that theoretical thing will hold good. $25 lakh 20,000. Now we have to find out what is going to be the value of rights. Now, value of rights. Suppose you apply, you are going to apply. So how much you will get? 1/4 of 75,000 you will get into per right. What is the cost? 9.60. You can see here value of rights alone. Per right, what is the cost? 9.60. So this will be equal to 18,750 into 9.60. This is 1,80,000, which I calculated just now. So this comes to 27 lakhs. So when you apply for rights, value before rights, value after rights will be maintained. Remember, we are in the theoretical world. When you have the real price in the market, this could change everything. Suppose theoretically you calculated to apply for rights, and after rights the price zooms to 45. Then value after right. Now this is value. This value will zoom. If this zooms, everything depends on the 33.6. Now currently we are using theoretical, so it looks equal. So investor will be happy that he is protecting his value of holdings by applying for rights. Now suppose he doesn't apply for rights. He ignores, okay? Suppose he ignores. I'm actually using the same format so that you understand. If we ignore rates, then there will be no change here. Now here, value of rights will be 0. So 25 lakh 20,000. Now this here you can write here, therefore A equal to B. Now you can see that B is less than A, therefore loss to investors of 1,80,000. So when you don't subscribe to right, you are going to lose money. Therefore, if you don't want to subscribe, at least sell the rights. So whenever rights issue comes, you get renunciation opportunity. Means you say renunciation means I'm having something as a right, but I don't want to exercise that. I sell it. So in the market, you will find that theoretical value of rights alone is 9.60. But if the issue is good, you will get 11 rupees, 12 rupees also. So some investors think, why to wait for issue? It is 9.60 theoretically. Let us sell for 12 rupees. They will sell for 12 rupees. When they may be those investors who don't want to increase their holdings. Remember, when you subscribe to rights, your holding increases. I don't want to increase. So don't keep quiet. Don't ignore. If you ignore, you are gone. What you should do is, when the rights come, analyze. If it is very attractive, if you are having money, subscribe. If it is very attractive, you are not having money, sell the rights. Not in any case. Attractive, not attractive. Don't ignore it. If you ignore it, gone. So hope you have understood this. So this is, so our solution was only that 33.60 and 9.60. But all these things you must remember. Let us now see bond markets. When you see the study material, the quantum of matter that is given is so less, you will feel that it's a very small chapter. You may find it under security valuation, but the number of pages it covers is very less. The kind of question they ask, it is actually very vast. So there are so many formulas in this that you can't ignore anything. Means I can say that in few pages they have made an essence of approximately 150 pages of a book. So do not get duped by so less to study. A lot of things are there. So as you're going to see now. So bond markets. If you see this, it comes under section 2 of your syllabus. In section 2, invariably one question comes from bond markets. So section 2 they can ask anywhere between 20 to 25 marks. So of that, 25 to 30 marks if I'm right. Of that, 8 marks will be from here. So it's a very long chapter. So I'm going to write down everything, and there are many problems. You can just go through it and cover. First, price of a bond. Now when I say price of a bond, price of a coupon bond, coupon paying bond, we can write B0 is equal to C upon 1 plus K, C upon 1 plus K square and bond will return the face value. So this is your face value of the bond at maturity. So k raised to n. So this is your maturity. This is your expected rate of return. Expected rate of return. This is your coupon. This is today's price. So you can see 1, 1, 2, 3, 4, and 5. So 1 is B0. Parameter number 1, B0. Parameter number 2, coupon. Parameter number 3, K. Parameter number 4, Bn. Parameter number 5, N. So we have 5 parameters in bond. B0, C, K, Bn, and N. When you know 4 out of 5, you can find a fifth one. So we can find the bond price if I know coupon, expected rate of return, face value, years to maturity. So if I know the 4 parameters, I can calculate bond price. Now you should know how to calculate using PV factors. So we can write or B0 is equal to C into PVIFA A comma N plus Bn into PVIF K comma N. Now C is what? C is coupon. So do we have C every year? C, and every year we have C till last year. So we have C every year. Therefore we have A. PVIFA annually available every year. So we are discounting using K for n years. And we are discounting every year. So we have C into PVIFA Kn plus we have Bn only in the last year. In the nth year you can see. So therefore Bn into, there is no A. So we don't have A here. So PVIF K discount in the nth year. So this is a formula you must know to calculate bond price. If it is a semi-annual bond, semi means half. Semi-annual bond means a bond which is paying coupon every half year or once in 6 months. So how we do it? So if you pay C per annum, so you will pay C by 2 every half year into PVIFA. If your expected rate of return is K per annum, then for 6 months it is K by 2. If you are getting 5 coupons in 5 years, if it is a semi-annual bond, you will get 5 into 2, 10 coupons. Because if you are getting 5 coupons for 5 years in annual bond, if it is semi-annual, then you will get 2 coupons per annum. So 2 into 5, 10. This will be 2n plus face value will remain same. PVIF K by 2 comma 2n. So this will be the bond price for semi-annual bond. So this is price of annual bond. This is price of semi-annual bond. So this is how we calculate the price. Then next, I told that out of the 5 parameters, if you don't know one, you can calculate the remaining. Now let us write the parameters B0, C, K, Bn, N. Suppose I know B0, I know C, I know Bn, I know N. Now B0 I am getting from market. Assume that I get from market. So I called a bond dealer. What is the price in the market? The dealer will say, sir, it is 950. So 950 is a price from where I obtain from the market. And which bond? The bond which is paying coupon C, bond which is giving a face value at maturity, and I know the years to maturity, but I don't know K. I can find K. I can find K by substituting in this formula. By substituting in this formula, I can find K. Let us take an example. I am not going to spend time on calculation. So you have to trust my answer. It's a rapid revision course. Otherwise, it will go on it will be converted into a regular course. Suppose I have B0. I'm just first calculating simple B0 question mark. I have C is equal to 10%, K is equal to 12%, Bn equal to 1000, N equal to 5. So if you calculate B0, it will be 10% of 1000, that is 100 rupees, into PVIFA 12%, 5 plus 1000 into PVIF 12%, 5. Now, if I calculate this, I'll get 927 half. Please trust my answer. Okay. So when you calculate PVIFA, when you substitute this, you get 927 half. So if K equal to 12%, I get this. Now if K equal to 8%, what happens? It will be 100 into PVIFA 8%, 5, 1000 into PVIF 8%, 5. So this will be 1080.30. Now first lesson here. Now when you see the formula, we write like this: B0 equal to C upon 1 plus K plus C upon 1 plus K the whole square plus C plus Bn upon 1 plus K raised to N. So I write the formula like this, is it not? Now you can see when K was 12%, I got the price less, B0. So this is your B0. And when K was less, this was more. The K is here, denominator. If K increases, B0 decreases. You can see from here. So when K increases, denominator, if the weight of the denominator increases, the value decreases, is it not? Mathematically, think. So when the denominator becomes heavy or increase, B0 falls. And when K decreases, B0 increases. So we can say that B0 is inversely proportional to K. So this is inversely proportional. So we can find that B0 and K are inversely proportional. And what happens if B0 equals K? Suppose I substitute, if K equal to 10%, this will give B0 is equal to 100 into PVIFA 10%, 5 plus 1000 into PVIF 10%, 5. This will be exact 1000 rupees. So you can see that when K is equal to 10 and C is equal to 10, see, same. Then, now what is this? This is B0. Then Bn will be equal to Bn. B0, sorry. B0 will be equal to Bn. So this will be same. So when K and C are same, B0 and Bn will be same. It is a universal fact. In the exam, when they give K equal to C for a bond, do not calculate the price. It is a crime. Directly write equal to Bn. I repeat, whenever they give in the exam for a problem, K is equal to C. Suppose they give the information directly or indirectly. But if K equal to C, you can see this. If K equal to C, then B0 will be equal to Bn. You need not calculate. You can straight away write. We know that. You can write. So you can see that when K is more, you can see when K is more than C, when K is more than C, you can see now K is, this is 10%, now K is 12%, then what happens? Price falls. When K is 8%, now 8% is less than C, then the price rises. So you must understand the relationship between K and C. How to remember? See the equation. If this is 10, this is 8. The numerator is heavy, is it not? Where is C? C is in the numerator. Where is K? K is in the denominator. If C is more than K, means numerator is heavy. The 10 is a greater number than 8. So if C is more than K, then since numerator is heavy, I will get the answer this 1080.30. If C is less than K, means numerator is less, denominator is more, then I will get the answer less than 1000. So 1000 is the center. The 1000 is the center. So B0 equal to 1000 when K is equal to C. When K is greater than C, now K greater means denominator heavy. I'll put it here, this side I'll put. When K is greater than C, so think of the bond price equation. Denominator is heavy. Then B0 will be, so this is equal to Bn. B0 will be less than Bn. If K is less than C, B0 will be greater than Bn. A very, very important principle of bond market. K and C will decide. So using K and C, you can visualize the price in the mind. You can't calculate unless you substitute, but you can visualize. Okay. So this is a very, very important aspect of bond market. K equals C, B0 equal to Bn, principle number 1. K equal to C, B0 equal to Bn, principle number 1. If K is greater than C, means denominator more. And denominator more, obviously, see if this is 10 and this, suppose you divide 10 by 12. If you do 10 by 12, what you get? Do you get answer less than 1? Yes. So therefore I will get the answer 927.5 less than 1000. So my B0 will be less than 1000. If K is less than C, then I'll get the answer greater than 1000. I got 1080.30. Okay, so it's a very, very important principle. Now coming back to this argument, I was telling that I know B0 from market, I know C, I know Bn, I know N, how to calculate K. So we are having two methods to calculate K. Two methods to calculate K. If B0, Bn, C and N are known. Method number one, approximate method. So K is equal to, now what is K? K is return. K is return. How we calculate return? Simple. Income, what you get from the instrument, plus capital gain divided by investment. Now this is how you calculate return. Suppose you buy share today, 100 rupees, and you keep it for 1 year. You got 10 rupee income, and you sold for 120 rupees. So 20 rupee capital gain. So 10 plus 20 upon 100. You calculate return that way. So we are going to use the same formula here. So in bond, what is the income? Income is C. Coupon which you get every year. What is capital gain? Now I am buying at B0 and at maturity I will get Bn. So I can write Bn minus B0 will be the capital gain. If B0 is the price I pay today, Bn I will get at maturity. So Bn minus B0 is the capital gain. Remember this return I want per annum. Is it not? I want the return per annum. Now coupon is per annum, no problem. But what about capital gain? Capital gain is not per annum. Therefore, I should divide by n. Remember, this is an approximate method. So certain adjustments are there. Okay, so capital gain per annum. So this income per annum, capital gain per annum divided by investment. Now in the numerator, see capital gain, just see it's a 5-year bond. 5-year bond. I bought at 980 and I sold at 1000 over a period of 5 years. So 20 rupees I made over 5 years. So therefore 4 rupees. So I calculate capital gain per annum. I divide by number of years, I get 4. So actually I am realizing 1000 only in the 5th year. Am I realizing 4 years every year? 4 rupees every year? No. I am not getting 4 every year. I am realizing 1000 only at the end of 5th year. But I am normalizing it, or I am averaging 20 rupees every year. So since you are doing averaging in the numerator, you should do average investment in the denominator also. So what is the investment you are making today? B0. And when you will get Bn at the end of 5th year, so you take the average. So this will give you the return K. So this is a formula of approximate method. Second is by interpolation. So for interpolation, you need 3 values. Now let us take the example which we took above. Suppose it is given C is equal to 10%. I am taking the same example. N equal to 5 years. Bn equal to 1000. Now K is asked and B0 is given as 950. Now they are asking K. Now that's what we have calculated here. Now how do you find out by interpolation method? Now for finding interpolation, we need two values, lower, higher, and the middle one will be unknown. See, this is a rapid revision course. I can only tell you in snippet or in short how we do it. So that's what I'm doing, absolutely what is required. So what you should do is, you must first estimate where K will lie. So you know that when K is increasing, B0 will decrease. Because we calculated just now. See, K greater than C, B0 will decrease. B0 will be less than Bn. If K less than C, B0 will be more than Bn. And here I want one lower value of K and one higher value of K. So I must estimate what is the price here? 950. Price is 950. So I should keep that in mind. So I must find two values, lower and higher, in such a way that price is between these two. Suppose I take K equal to 8% and K equal to 12%. Now what is the price? Price at K percent, 8% is 1080.30. What is the price at K equal to 12%? 927.5. Why I took two values? You can see that 950 lies in between these two. So I must take two values of K and calculate B0 and ensure that this value is between these two. In the exam till now, last 20 years, not a single problem on interpolation has come. Institute has accepted approximate method. Still, my duty is to teach interpolation. I am teaching. Sometimes interpolation has been used to calculate. Okay, so in semester answer also you will see. At that time, you should not think I don't know interpolation. You already learned interpolation in IPCC, IRR. Better you go through that and master it. Because certain attempts, interpolation has been used in other chapters. Interpolation you must know. So in this case, I will have to find 950. So what we do is, I tell my students very simple method. So you have to find two values, lower value. You can see 8 is a lower value and 12 is a higher value. So I write like this. But when I write in a different way. I write 1080 two times and K equal to unknown for 950. Put a dash here. Here I put a dash, I write 927.5. So this is A, this is B. So I have to find the difference. So A will be, here it will be 130.3 and here it will be 70 to 50, 150 to 80. So this K will be equal to 8%. This 8% will come, lower value plus A upon B into higher value minus lower value. So this is your higher value, this is your lower value. So when you do this, you get the value of K. So better you see this again so you'll understand. Summarize If we are to find out K, we can use approximate method, which is accepted in the exam, so we can proceed with that, or interpolation method. If it is interpolation method, first you have to find the range within which the expected answer will lie. In this case, we got B0 equal to 950. So I know that when B0 was 1080.30, it is 8%, and 920 is on half, 12%. So I know that 950 lies between 1080.30 and 920 on half. So you must find 1% for which the price will be above 950. Then you have to find another percentage for which the price will be below 950. And then you write like this. Lower value write down first and write the price 2 times. Unknown value write the price in the first column. Higher value write next, write the price in the second column. Find the difference. Get A, you get B. So K will be equal to lower value 8%. So this will be 12 minus 8. And A will be substituted here, B will be here. So this is about interpolation. Now, when we have 5 parameters in bond, B0, Bn, C, K, N. Can I have a bond without C? Without C means what? No coupon. No coupon means zero coupon bond. So what is the zero coupon bond? Zero coupon bond is B0 equal to C upon 1 plus K. So C upon 1 plus K square plus C plus Bn upon 1 plus K raised to N. Now zero coupon bond means no coupon. So 0, 0, 0. So all these terms will get cancelled. So what will remain? So we have B0 is equal to Bn upon 1 plus K raised to N. So zero coupon bond formula is very simple. B0 equal to the price of zero coupon bond today. Remember, K is positive, always positive. Always positive. Whenever I make an investment, I expect some K, is it not? So K is always positive. So when K is positive, this number is positive. Now when this number is positive, suppose I write 1000 upon 1.2. What will be the answer? Answer, whatever you get, it will be less than 1000, is it not? Because 1000 upon 1 plus something will always be less than 1000. So this B0 will always be less than Bn. Always. Therefore, zero coupon bond. Now, whenever B0 is less than Bn, we call it as discount. The bond is quoting a discount. When B0 is greater than Bn, we call it as bond is quoting at premium. So whenever the price of a bond is less than the face value, we call it as discount bonds. Therefore, zero coupon bond whose price is always less than Bn, they are also called discount bonds. So other name for zero coupon bond is discount bonds. So zero coupon bonds are called discount bonds. Now when B0 is greater than Bn, we call it as premium bonds. Premium bonds are not sold in the market, nobody will buy. Okay, suppose I want to borrow from you 1000 rupees. Suppose I tell you give me 1050, I will return only 1000. Nobody will give. Okay. So coming back to zero coupon bond, So zero coupon bonds are those bonds which do not pay coupons. Therefore, the formula is very simple. B0 equal to Bn upon 1 plus k raised to n. Zero coupon bonds always quote at discount. Your denominator is always some positive figure. So Bn upon positive figure will always be less than Bn. Therefore, B0 answer will be less than Bn. Now what if, now let us again write the 5 parameters. B0, Bn, C, K, N. What if there is no N? Means bond is not maturing at all. Then it is called perpetual bond. So in perpetual bond, there will be no N. So the formula is even simpler. B0 is equal to C upon K. So perpetual bond formula B0 equal to C upon K. So when K increases, B0 decreases. When K decreases, B0 increases. So B0 is inversely proportional to K. So this is your perpetual bond. So what all bonds we have seen? Coupon bond, zero coupon bond, perpetual bond, semi-annual bond. So all this, generally you get problems. Every atom you get a problem. You don't get a separate, dedicated problem, but it will be part of a problem. Even in November 2020, they asked calculate the price of the bond. The general formula what we used, the formula, the initial formula what we use, this was asked. So this came in the November 20 exam also. Calculate the price of the bond. Usually in a problem, you will be asked to calculate price for various situations. So there will be many questions. Okay. Now this is about basic sub bond. Now in a bond there are two major risks. It is called price risk and reinvestment risk. Now let us write the bond price formula. B0 equal to C upon 1 plus K, C upon 1 plus K square. I am assuming 5-year bond. Plus C plus Bn upon 1 plus K raised to 5. So what I'm going to take LCM equal to, LCM will be 1 plus K raised to 5. So C into 1 plus K raised to 4 plus C into 1 plus K cube plus C into 1 plus K square, C into 1 plus K plus C plus Bn. So this is your B0, is it not? So B0, I am cross multiplying 1 plus K raised to 5. So will be this. So I call it as A. So this will be A. Now what I have done, I have written a bond price equation. I have rearranged the terms by taking LCM. Now please observe very carefully. We are going to learn a very important concept. Now what is B0? B0 is investment today. What is this? This is tenure of the bond. What is this? Expected return per annum. Now, this is like our component test formula what we have learned in school. Amount is equal to principal into 1 plus r raised to t. Are you able to correlate here? P into 1 plus r raised to t. Right? So this is your principal plus 1 plus r raised to t. Is it not? So we can find that when you invest in a bond, it is similar to investing in a compounded fixed deposit. Compounded fixed deposit. Suppose you invest, so this amount we call, is it not? So if you invest in a bond, what amount you will get? You will get P into 1 plus R raised to T. That is B0 into 1 plus K raised to 5. So in bond, so we can say bond proceeds will be equal to B0 into 1 plus K raised to N. So this is what you are going to get. So when I invest in a 5-year bond, which is paying coupon, at the end of 5 years, I am going to get this. Remember, I am going to get compounded rate of interest. But there is a condition. When you will get this, just see here, now carefully. Just see here. So I am writing from here. So B0, or I'll write bond proceeds equal to B0 into 1 plus K raised to 5 will be equal to first coupon if I reinvest for 4 years. Means first coupon if I get, what I should do, first coupon when I get from the bond, I must keep in a cumulative fixed deposit for 4 years at same rate of K. When I get the second coupon, I must keep in cumulative fixed deposit for 3 years at the same sorry, let me take some water. So second coupon when I get, I must keep it for cumulative fixed deposit for 3 years at same rate of K. Third coupon, I must keep it for 2 years. Fourth, for 1 year. And I will get C in the 5th year and BN in the 5th year. So this is what we wrote just now. This entire thing is our A. You can see this. So I will get bond proceeds. I will get cumulative fixed deposit where I can earn K% every year, provided when I receive the first coupon at the end of year 1, I keep in a cumulative fixed deposit for 4 more years. When I receive the second coupon at the end of year 2, I keep it in a cumulative fixed deposit for 3 years and so on. Remember, I have to keep at K every year. Then only this will be equal to this. If I am unable to do this, when you will be unable to do this? Because as time passes, your K, the interest rate in the market will change. Interest rate is not your, you can't control it. So it will change. So when it changes, you may not be able to keep at this rate or this or this or all of this. Then what happens? Then you will not get this. Then what happens? When I am not going to get what I am expecting, what is called risk. So I will face risk if I am unable to reinvest my coupons every year at the desired rate, and that is called reinvestment risk. And that is called reinvestment risk. Now suppose I wanted this money. Suppose I wanted this money, that is B0 into 1 plus K raised to 5. So I do this perfectly. I do this perfectly. I do this perfectly. I do this perfectly. And I also get this. But I don't get BN. Why I don't get BN? What I do is, you gave me money and I bought. You gave me money and told that I will come after 5 years. I said, okay. You come after 5 years. And you said you want K% returns. I said, okay, no problem. I will give you K% per return, K% per annum. So I promise you that I will give you this. So you gave me 1000 rupees and you expected 10% every year. So I promise you, when you multiply this, you get 1610.51. So you gave me 1000 rupees and you expected 10%, and I give you a promise, come after 5 years, I will give you 1610.51. So you listen to me and go away. So you are giving me how much today? You are giving me 1000 today. What I do, I know that you are going to come after 5 years. But what I do, I invest your money in 7-year bond. I invest your money in 7-year bond. When I invest your money in 7-year bond, what will happen? Assume that first year I get this, second year this, third year this, fourth year, fifth year. Now at the end of 5th year, you are going to come. But I invested your money in 7-year bond. So my issuer will not return the face value. So what I have to do? I have to sell your bond in the market. When I go to sell your bond in the market, I don't get my 1000 rupees back. I get say 980. Then what happens? Then if I am going to get less than BN, will this be met? Then my bond proceeds will be less than required. Then my bond proceed, if I am not going to get 1000 back, then I am not going to get my bond proceed. This is called price risk. So reinvestment risk is that risk which the fund manager faces because he is unable to reinvest every year coupons at K. Price risk is that risk where the fund manager does not receive the intended bond price which he paid today on sale at maturity, on sale later. Suppose you pay 1000 rupees today, you must get 1000 back. If you get 980, then you are going to face price risk. So price risk and reinvestment risk are very important. But the problem with these two risks is, or I can say advantage also. So when K rises, my reinvestment income increases. Okay. So suppose I'm investing in a bond today and every year K is increasing. So as I receive coupons, I will keep on investing at a higher rate. In that case, my reinvestment income will increase. But When I go to sell the bond in the market, in case I've invested in a longer tenure bond and I go to sell the bond in the market, then what happens? Then you know the formula B0 equal to C upon 1 plus K, etc. So when K increases, what happens to this? You get B0 less. So you will get less price. And what happens when K decreases? My reinvestment income will decrease. And if this K decreases, you will get higher price. So price will increase. So are you able to see that this is increasing, this is decreasing? And when this is decreasing, it is increasing. So the change in K is creating opposite effects on reinvestment income and price. So this property of movement of RI and price will help us to manage both price risk and reinvestment risk. So that is achieved by the concept of duration. So summary, two main risks of bonds are price risk and reinvestment risk. So reinvestment risk comes out of inability of fund manager of not being able to reinvest the coupons at the desired rate of K. Means not receiving expected reinvestment income. Price risk results out of inability of the fund manager of not being able to sell the bond at the desired price. But luckily, K, when it changes, it creates opposite effects on reinvestment income and price. And this we will use it to our advantage and manage both the risk using the concept of duration. Okay, let us see what is duration. Now, duration is a very important measure in bond market chapter. Let us first calculate duration. Let us take the same example of bond. I call it as A, C equal to 10%, K equal to 10%, N equal to 5 years, Bn equal to 1000. Now, it is a no-brainer that when K equal to C, remember B0 can be directly written as 1000. This is very, very important. So whenever K is equal to C, don't calculate B0. I repeat, in a bond, whenever K is given as C, do not calculate B0. Straight away write it equal to Bn. What is B0? Whatever is Bn. Bn is 10,000, B0 is 10,000. If Bn is 1000, B0 is 1000. Now why we require duration? I told you that whenever we are investing in a coupon bond, we will be receiving coupons every year. And when we receive coupons every year, we have to reinvest the coupons at the same rate of K at which I am buying the bond today. Then only I will be getting. You can just see here, we wrote. You can see bond proceed. I'll remove. You can see that the bond proceeds should be this much. This is possible when I reinvest C at this K. When I reinvest second C at this K. But K is going to change every year. Interest rate will not be constant for you. So when this is going to change, I am going to face reinvestment risk because I will be unable to reinvest every coupon at this rate. Similarly, if I am buying a longer tenure bond and try to sell the bond in the market, I will not get this. I will not get BN. So I may not get desired reinvestment income, which is called reinvestment risk. I will not get the desired price, which is called price risk. So I have to manage. Therefore, duration is a technique which you are going to use. But first, you have to understand what is duration. So duration, for understanding duration, we are going to take this example. So duration is like a payback period. So you can say duration is a weighted discounted payback period. Why it is called so? So we are going to discount it. We are going to apply weights also. Let us see how. So what I'm going to write? I'm going to write period. See, the format of the table is very important. Period, cash flow, PV factor at the rate of K%, PV of cash flows, and this period is I can call it as T. So T into PV of cash flows. So what I wrote, period, that is I call it as T. Then I write cash flow, what I'm going to get from bond. Then P factor at the rate of K. Now K is 10%, so I'll write 10% P factor. Then multiply the P factor with cash flow, PV of cash flow. Then finally multiply with T. So I get the last column. So period, it's a 5-year bond. So 1, 2, 3, 4, 5. So it is a 5-year bond. And in the 5th year, I am going to get 2 cash flows. One coupon, other is this value. So I write 5-year twice. What is it? Now I am going to take bond A. What is the first year cash flow? 100 rupees. Second year cash flow, 100 rupees. Third year cash flow, 100 rupees. Fourth year, 100 rupees. Fifth year, 100 rupees. I am going to get 100 rupees for 5 years. And I am also going to get 1000 rupees in the 5th year. That is your BN. So this is your C. And this is your BN. Now we are trying the P factor for 10%. So this is nothing but 1 upon 1.1. This is nothing but 1 upon 1.1 square and so on. Now PV of cash flow. So multiply. So 100 into 0.909 equal to 90.9. We'll write 2 times. And finally 62.621. When you add, it will be 1000. Why? Because it is a sum of the present values of the cash flows from bond. So it is actually, what is this? This is actually C upon 1 plus K plus C upon 1 plus K square plus C upon 1 plus K raised to 5 plus Bn upon 1 plus K raised to 5. Now this is what we have written here. So this is nothing but the price of the bond. So what should be price? Since C equal to K, B0 should be 1000. So you need not calculate at all. You can straight away write 1000. But if you write wrong numbers and write 1000, you will not get marks. You must multiply correctly. Now multiply by period. This period is your T. So first will be 90.9 into 1 because it is a first period. Then T will be 2. 82.6 into 2. So that will be 165. Then 75.1 into 3. 225.3. Then 68.3 into 4. 272.3 or 2, sorry, 273.2. Approximately you can verify. And 62.1 into 5. This will be 310.5. And this will be 621 into 5. So when you add this, you will get approximately 4170. Now duration is 4170 upon 1000 equal to 4.17 years. So duration is 4.17 years. So this is how we calculate duration. There is another method. There is another method of calculating, or D is equal to, first what we wrote all the cash flows of each year. So T is here, if T1, T2, T3, T4, T5 like that. So we wrote cash flow 1, cash flow 2, cash flow 3, like that we wrote, correct? That's what we did here, is it not? First we wrote all the cash flows. Then what we did? Then we discounted the cash flows. So you can see, we wrote the discount factors and we multiplied. So we got, then we calculated discount, then we discounted. Then what you did? Then you multiplied with P factors, sorry, T. So I will write here into T. Then what you did? Then I took the total. So summation. Then what you did? You divide by B0. So 1 upon B0. You got the answer, this. So 1 upon B0 summation of C of T into T upon 1 plus K raised to T. So this is how you calculate duration. Now duration of a coupon bond is calculated like this. What if it is a 5-year? What about 5-year zero coupon bond? Now 5-year zero coupon bond means this will be 0, 0, 0, 0, 0. So therefore this will be 0, 0, 0, 0, 0. So only this will be there. So when you do this, so my duration will be, duration of zero coupon bond will be, this total will be 3105 because they are all 0. So 3105 divided by, what is the price of the zero coupon bond? Price of zero coupon bond will be Bn upon 1 plus K raised to 5 equal to 1000 upon 1.1 raised to 5. equal to 621. So this will be divided by 620. So when you cancel, we get 5 years. So we got duration of zero coupon bond same as maturity. So we got duration of zero coupon bond same as maturity. Why? There are no coupons. So it is again a very universal kind of rule that you should not calculate duration of zero coupon bond. You have to simply see what is the maturity and that is the duration. Now think of a payback period concept. Suppose I invest in a bond. It doesn't pay me anything till maturity. And it pays me everything at maturity. So what is the payback period? Payback period is that maturity period. Because we are not getting anything in between the years. We are getting everything at the end. Zero coupon bond is also like that. You invest today, you don't get any coupons till end, and in the end you get your entire money back. So therefore, duration of zero coupon bond is equal to maturity. Okay, so we have calculated these two. So we can say that duration of a zero coupon bond is equal to years to maturity. So if we have a 5-year zero coupon bond, the duration of zero coupon bond will be 5 years. If we have 2-year zero coupon bond, the duration of zero coupon bond will be 2 years. Why? Well, because if you see duration as a payback period, and in zero coupon bond we get all the cash flows only at maturity. So we don't get any intermediate cash flows. So if I take 5-year zero coupon bond, I'm paying B0 today and I'm getting my BN. There is no coupon, remember, no coupon. So I'm going to get all the cash flow only at maturity, that is BN. So no intermediate cash flow. So we have one cash outflow and one cash inflow. So we know payback period of such instrument is years to maturity because only one cash flow. So 5-year zero coupon bond will have a duration equal to 5. 2-year zero coupon bond will have duration equal to 2. Now we will apply this principle later on, to understand duration. But for now I will say, whenever you have one outflow and one inflow separated by n years, then duration is equal to n years. It can change also. Whenever I have one inflow and one outflow, duration is again n years, separated by n years. Now you would wonder what? This is investment. This is loan. Suppose I have one inflow, I got loan. I need not pay anything for n years. Then I have to repay my entire loan with interest. So we have one inflow, one outflow, one outflow, one inflow, separated by n years with no intermediate cash flows. Then the duration is n years. You have to remember this. This will use later on in the fixed income portfolio management problem. Now coming back to this, so we have learned duration. Now for bond A, how we calculate, how we write using formula. So duration is summation of cash flows into T upon 1 plus K raised to T 1 upon B0. So this is the formula of duration. So for bond A I will write, first year I got 100 rupees multiplied by 1 discounted once. Second year I got 100 rupees multiplied by 2 discounted twice. Third year I got 100 rupees multiplied by 3 discounted thrice. Fourth year I got 100 rupees, multiply by 4, discounted 4 times. Fifth year I got 100 rupees plus face value, multiply by 5, discounted 5 times. So this is entire thing added, that is summation, divided by 1 upon B0. Now K is equal to C, therefore B0 equal to Pn. So this gives you duration. And this you will see comes to 4.17 years. So the same thing, 4.17 years, we calculated using table method. You see, calculated using table method. This is table method and this is formula method. Now when to use which method in the exam? Now when you know, suppose you know 1000, K is equal to C, they are given. K equal to C, they are given. Then there is no need to calculate B0. Then you prefer this method. But they have not given K equal to C. They have not given K equal to C. Then also you can do this. You have to first find bond price. Then you use this formula. You can find. But you may at that whenever K is not equal to C, you can prefer this method. Why? Because the total of this column will be bond price. So you will get two answers in one shot. You will get B0 also here, D also here. So you may, but table method is a time consuming. Be prepared. So I tell my students not to do table method unless it is required. Or you know, unnecessarily you spend some 2-3 minutes extra, that's all. But if you are finding you have confidence only in table method, then do that. Don't do a formula method. Okay. So this is about duration. Now what is the duration of semi-annual bond? Duration of semi-annual bond. Remember, we have to calculate duration. Same formula. Calculate D using same formula and divide by 2. Because when you calculate duration using same formula, you will get semi-annual duration. So you have to divide by 2. You have to, don't forget, you have to divide by 2 in the end to get semi-annual, to get annual normal duration. So to get D, whatever answer you calculate, for in semi-annual bond, we are going to do a problem, you can go through it, you will understand. So we have to use the same formula, but divide by 2 in the end. That is the answer for D. Next. Suppose you discount, or sorry, suppose you differentiate. Now differentiation, integration you have learned in 11th-12th standard. In case you opted for mathematics, it must be there. So if you differentiate D, B0 with respect to K. Now what is B0? B0 is C upon 1 plus K plus C upon 1 plus K the whole square added as C plus Bn upon 1 plus K raised to N. This is the equation of B0 for any year bond. The price of a bond formula. Suppose I differentiate this with respect to K. what answer I will get? I will get this answer. Delta B0 percentage is equal to minus D into delta K percentage upon 1 plus. Very, very important formula. Now, had it been a regular course, I would have derived this entire part. Now we would get this. A very, very important formula. Do not forget this. Let us understand the formula. Now left hand side is change in bond price in percentage. This is duration. This is current value of K. This is change in K in percentage. Why it is an important formula? Just see here. If I know the duration of bond, if I know current K, and if I know how much K is going to rise or fall, then I can find how much B0 will change. Let me give an example. Suppose I am having a bond of 1000 face value with same price, because C equal to K equal to 10%, N equal to 5 years. So this I am having now. Currently I am having this bond. Then I am listening to a monetary policy speech by RBI governor. He is telling interest rates have increased by 2%. Now this bond we just now calculated, D is 4.17 years. Now RBI government is telling interest rates have increased by 2%. Now I can, using this I can find delta B0 percentage. So this I can find. How? Minus D. So minus 4.17 into delta K. So if RBI governor side increases by percent, divided by current value of K. K is 10%. 1.1. So this will give you minus into plus minus 4.17 into 2 divided by 1.1, 7.58 minus 7.58. So without using the bond price formula, I can calculate change in bond price. So when I listen to RBI governor's speech, and having known that K has risen by 2%, knowing duration, knowing current K, I can calculate change in bond price. Remember, this is not exact change in bond price. What the exact change you will get, see, B0 equal to C into PVI of A, sorry, K comma N plus Bn into PVIF K comma N. So this will be 100 into PVI of A 12 comma 5, 1000 into PVI of 12 comma 5. We calculated this as 927.5. Earlier we calculated. So current price is 1000. What is the change? Change is minus 72.50 or minus 7.25%. So with exact bond price, I am getting answer of minus 7.25%. But with duration, I got minus 7.58%. So they are not same. Okay, so duration gives me approximate price change, not exact price change. If you use duration to calculate price change, you will get approximate price change, not exact. That is because of the property of convexity. So we will learn formula for convexity slightly later. Okay, convexity is a property where the bond price do not change with K, linearly. Linearly means price rise and price fall for change in K is not same. Now you can see here, we did this problem, K equal 10%, K equal to 8%, K equal to 12%, 1000, 1080.30, 927.5. We calculated this in the beginning. Now yield is falling by 2%. Here yield is rising by 2%. What is the change in bond price? It is increasing by 8.03%. What is the change in bond price? It is decreasing by 7.25%. So are you able to see that when K changes by plus 2, bond price is falling by this much. When K changes by minus 2, it is increasing by this. So the fall or rise of K is 2% only. They are same. But these are not same. It is not minus 7.25 plus 7.25. It is minus 7.25 plus 8.03. Now these prices we calculated by substituting in the bond price formula. But we find that when K changes by equal quantum up or down, B0 changes are not linear. Linear means they must be equal change. They are not linear. They are non-linear and they are convex. So this is a simple, see in the exam you won't get an in-depth question, but at least you will know that if I calculate bond price change using bond price formula, the answer will not match with the bond price change calculated using duration formula. So this formula you must remember. This is a very, very important formula. And they asked this problem in the November 2020 exam. So you can calculate this when you know this. They asked in November 2020. So when you see the problem, you will get a full revision of whatever I stated now. Okay. So I explained, they are not linear, they are convex. Now we wrote this formula. Let me rearrange the formula. So delta B0 percentage equal to minus D into delta K percentage upon 1 plus K. So I am going to rearrange. So delta B0 percentage equal to delta K percentage equal to minus D upon 1 plus K. Now what is left hand side? Left hand side is rate of change of bond price with respect to change in K. To what extent B0 will change when K changes? It is nothing but risk. or volatility. It is nothing but risk or volatility. Now what is risk? Now when K is changing, my bond price should not change. If it changes, then I am facing risk. So whenever K changes, my value should remain intact. Then only I am not facing any loss. But if the value changes, then I am facing risk. Therefore, it is a measure of risk. So whenever they ask volatility, they are asking this. You should calculate D upon 1 plus K. So D upon 1 plus K is a formula for volatility. Because the left hand side is nothing but rate of change of price with respect to yield, which is the real definition of interest rate risk. So the interest rate risk is defined as delta B0 percentage upon delta K percentage, also called volatility, but it is calculated as D upon 1 plus K. You should not use minus sign. Minus sign explains inverse relationship between B0 and K. So you should not take minus into calculation. You should simply do D. They will ask in the exam. They asked in November 20. This also came in November 20 exam. Calculate volatility. So first you have to calculate duration and then divide by 1 plus K. That is the answer for volatility. Okay. Now this term is popularly called as modified duration. So modified duration is D upon 1 plus K. Other name is volatility. So when you write only D, it is duration. When you divide by 1 plus K, you have modified the duration. Therefore, it is called modified duration. Popular name is volatility. So whenever they ask modified duration, you will first calculate duration divided by 1 plus K. Whenever they ask volatility, you will do the same thing. Calculate duration divided by 1 plus K. Okay. So we have learned what duration, modified duration, volatility. Now let us write the formula for. I hope you are writing all these things the way you want to study on the last day. Convexity. Now I said when I differentiate B0 with respect to K, I will get duration. If I differentiate again, I will get convexity. So when I differentiate B0 with respect to K, I got duration. You see this formula, I'll tell you. Let me take you to this formula. So I'm just going to write just here. This entire thing I am writing now. So I am keeping D on one side equal to delta B0 percentage. I'll put minus upon delta K percentage upon 1 plus K. So delta B0 percentage remained there only. Minus sign I have shifted. Delta K goes to denominator and 1 plus K goes to numerator, but I have written denominator of denominator. So when I differentiated the bond price equation, I got this formula D. When I differentiate again, I will get convexity. And the formula is, please learn only the formula, you don't have anything else. This again came in November 20 exam. Came for the first time in last 20 years. Record. So convexity The formula is, just see, I will write duration formula and I will write convexity formula. Then you will understand what we are doing. In duration, what we did, we first wrote cash flow for every year, 100, 100, 100. In convexity also, you will write first cash flows. In duration, you discounted each cash flow. In convexity also, you will discount each cash flow. In duration formula, you multiply it by T. In convexity, you will multiply by T into T plus 1. In duration formula, you took summation. Here also you will take summation. In duration formula, you divide by B0. Here you will divide by B0 and also by 1 plus K square. So what is the change? The change is you are doing into T plus 1 here and you are dividing by 1 plus K square. So these two formulas are very important. Now you can, if they ask the way they asked in November 2020, you can do the entire calculation in one table, especially when K is not equal to C. How? Just see, I write period, then I write cash flows. You can copy the format, is very, very important. So I am giving table format. When K is not equal to C, then I need B0, then I need duration, I need convexity. All three in one table you will get. Period, cash flow. Then PV factor at the rate of K. So for K percent, P factors. Then PV factor into cash flows. So we can say this, suppose this is T, this is A, this is B. So this will be AB. Then you will do T into PV of cash flows. So this will be TAB. Then you will do T into T plus 1 into PV of cash flow. So you will do T plus 1 into AB. Now the summation will give you B0. This summation will give you, say, X. This summation will give you, say, Y. Therefore duration is equal to summation of X, the total, divided by B0. Or sorry, I will write X upon B0, not summation. So summation will give you B0, summation will give you X and summation will give you Y. So that X upon B0 will give you duration. And convexity will be 1 upon B0 into 1 plus K square into Y upon, or you can write down like this, 1 upon 1 plus K square into Y upon B0. We'll write in a better form. So we should take the total. X upon B0 will give you duration, Y upon B0 and divided by 1 plus K square will give you convexity. So in one table, you got everything. This you will adopt when K not equal to C. When K not equal to C, prefer this method. Now I have solved this number 20 problem. So when you go there, it will be a revision. Okay. So this complete duration convexity calculation. Okay. So next we come to what is called as immunization. Immunization means protection. So when we vaccinate, we get protection from a virus. So immunization means protection. So here we are going to protect the bond from reinvestment risk and price risk. Okay, suppose let us say an investor is giving you 1000 rupees. He wants 10% compound interest for 5 years. Therefore, he will give you 1000 today, and at the end of 5 years, he wants 1000 into 1 plus 10% raised to 5, or compound interest formula. This will be 1610.5. Now remember, he is giving you, so you are a fund manager. So your job is to earn him this much return. So for fund manager, this fund manager, investors' money is a liability. And what you are going to do with investors' money? You are going to invest in bond. Invest in bond. And investment in bond is asset for you. Now you are the fund manager. Investors' money is a liability for you because you should return to him. And if you use investors' money and invest in a bond, then bond investment is asset for you. Okay. Now if you draw this now investors' money, you can see you will get an inflow. Now I am writing this from your point of view, from fund manager's point of view. So this will be inflow. So you are going to get inflow. After 5 years, you should return the investor 1610.51. So it is outflow. And inflow and outflow is separated by 5 years. So duration of liability is 5 years. Duration of liability is 5 years. Why? We learned in zero coupon bond, when there is one inflow, one outflow, no intermediate cash flow, then the duration is that term. In this case, 5 years. So duration of liability is 5 years. If fund manager ensures that duration of asset is also 5 years, then so if DO is equal to 5 years, which is same as duration of liability, then there will be no price risk, no reinvestment risk. So this is the technique of managing price risk and reinvestment risk. First, identify the duration of liability. That is what investor is giving. And then invest in that bond whose duration is equal to the duration of liability. When you do that, then the price risk and reinvestment risk will cancel out. Why I am using the word cancel out? Because they move in opposite direction when K changes. So the technique of protecting or immunizing your portfolio is to ensure that duration of your investment, that is asset, matches with duration of investors' money, that is liability. So this is the technique fund managers use in the real world to offset price risk and reinvestment risk. There are other risks like credit risk or default risk. Suppose you invest in a bond where the company's management is, corporate governance is so bad, then you are unlikely to get your BN back, that is your face value back. So they face credit risk or default risk. Okay. So these are the three major risks. Now, this what about immunization? So we have a problem which you can go through, and I urge you to go through two problems which are asked in the previous exam. Same principle, absolutely same principle. That will give you good confidence. I have solved a separate new problem because you have got two problems ready which are asked in the examinations. Now, after we complete immunization, so the next thing is forward rates. Now, whenever you want to find rate for the 5th year, remember I want to find, now this is 0, 1, 2, 3, 4. So this is the 1st year, 2nd year, 3rd year, 4th year, 5th year. I want to find the rate for the 5th year, only 5th year. What will be the rate after 4 years? So I want to find R5, or I want to find forward rate for year 5. What is the formula? The formula is 1 plus K 5 raised to 5, 1 plus K4 raised to 4 minus 1. So what is K5 and K4? Their expected rate of return of a 5-year investment. Expected return of 5-year bond or 5-year investment. This is expected return of 4-year investment. Expected return means, suppose it is same K. Suppose I am making a 5-year investment. 1, 2, 3, 4, 5. So K, 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 K and K. So this K is only asked, is used here. It is popularly called as yield, also called as spot rate. So they will give you spot rate is 10%, means they are referring to K. They will give yield of 5-year investment 10%. So that is referring to K. So when they say 5-year investment, K5. Yield of 4-year investment is 8. So K4 is 8, like that. Okay. I forgot to mention one very important term. Just want to put that I got reminded. Now, when I have 950, suppose I know the price B0 equal to 950. So I will calculate K using C, Bn, B0, N. So the K which I will calculate, K, I wrote here, just a minute, I'll show you. I'll use this space. Suppose I have B0, Bn, C, N, and I am calculating K. B0 I get from market, and using B0, using Bn, C and N, and either by using approximate formula or by using interpolation, I can calculate K. Now this K is popularly called yield to maturity or YTM. Now how you are getting YTM? You are getting YTM from market price. Remember, whenever you are calculating YTM, you must have market price. I repeat, whenever you are calculating YTM, you must have market price. And when you have, now suppose you have bond price formula like this, 100 upon 1 plus K, 100 upon 1 plus K square, 100 plus 1000 upon 1 plus K raised to 5. And remember, here we are given 1000 or I am given 950. Now you can see coupon is known, face value is known, term to maturity is known. 950 I get from market. So when left hand side is 950 market price, I repeat, it is a market price. Then the K what you will calculate is called YTM, provided two more conditions is satisfied. Condition number 1, you account for all the cash flows till maturity of the bond. You should not take only 2 cash flows or 3. You should take all the cash flows till maturity. Therefore, it is getting the name to maturity. Yield. So K is called yield to maturity because you have taken all cash flows till maturity. And by substituting K here, LHS will be equal to RHS. So for K to be called YTM, there are 3 rules to be satisfied. Rule number 1, left hand side should be market price of bond. Rule number 2, all cash flows till maturity should be taken into calculation. Rule number 3, when left hand side is market price, it should equal the right hand side, which is nothing but the discounted value calculated using YTM or K. YTM is a very important. So here, why I got reminded, because this K is 4-year YTM. This K is 5-year YTM. Means we got YTM using market price of the bond. So I calculated K using the price of 5-year bond. So that is our K5. I got K4 using the price of 4-year bond. Obviously they will be different. So that is your K4. And when I substitute K5 and K4, I will get F5. So similarly we can do for R3. 1 plus K3 cube 1 plus K2 square minus 1. You see, this is 3, this is 3, this is 3. This is 1 less. Let us write one more, then you will understand. Suppose I want to find R2. Then it will be 1 plus K2 square upon 1 plus K1 raised to 1 minus 1. Again you can see this is 2, this will be same, and this will be 1 less. Similarly I can write K6, sorry, R6 will be 1 plus K6 raised to 6 upon 1 plus K5 raised to 5 minus 1. Now this problem, they have asked, they didn't ask according to me. I'm not very sure they're yet to ask. No, they have asked once, sorry. They have asked once. So where they will give multiple year spot rates or yield, and they will ask you calculate forward rate. So forward rate, so finally we are getting the formula. We can write general formula. Rn is equal to 1 plus Kn. Remember n same, raised to n upon 1 plus Kn minus 1. That is 1 less. Again 1 less minus 1. I can write R as F also. Rn or Fn. A very important formula for forward rates. Okay, they have asked many years ago, so it's a very important question for the coming exams. Now we generally write, now using K, bond price is B0 is equal to C upon 1 plus K plus C upon 1 plus K square plus C upon 1 plus K cube C plus Bn upon 1 plus K raised to N. This is how we calculate, is it not? Now using R, how to calculate? Using R, bond price will be B0 equal to C upon 1 plus R1 plus C upon 1 plus R1, 1 plus R2. Remember, two periods are there, R1, R2. Next will be C upon 1 plus R1, 1 plus R2, 1 plus R3, and so on. So like this we calculate. This is also very important. And I have solved one problem. So when you go through it, I tell you this revision course is complete. If you master this, then you are covering almost everything of the syllabus. So this is how we calculate forward rates, in case they give bond price or 3-year bond, 4-year bond, etc. Now next comes reissue of bonds. When reissue of bonds come, let me give an example. Once upon a time, it's an old story but true story. Once upon a time, IDBI gave a loan to SR Group. For 15 years. Now, how IDBI gave? IDBI issued bonds for 15 years at 15%, assume. So IDBI issued bond for 15 years, collected money and gave it to SR. So for IDBI, this is asset and this is liability. So they match asset and liability duration. So you collect money from investors for 15 years, give it to IDBI. Remember, you have to pay coupon for 15 years. 5 years pass. 5 years pass, interest rate crash to 10%. So after 5 years, now what they did, they were paying investors 15, and they were charging interest rate, so loan interest of 17%. So then what IDBI is earning? So IDBI is earning is 17 minus 15 equal to 2%. Because they have to pay investor 15%. Therefore, they charge SR 17%. 17 minus 15 is 2%. So 2% was IDBI's income from this business. After 5 years, interest rates fell to say 14% in the market. Interest rate crashed to 14%. Remember, when interest rate is 14%, you are paying your bond holders 15% because you issued many years back. Now SR is going to pay you 17% when the interest rate in the market is going at 14%. Will SR keep quiet a business? No, SR comes to IDBI. The true story, numbers are modified just for your understanding. SR came to IDBI. Sir, interest rates have crashed. Why you are charging 17% to us? Reduce interest. IDBI says, give me some time. So what IDBI does, IDBI goes to market, issues new bonds. At 12%. So IDBI goes to market and issues new bonds at 12%. So they get this money. Using this money, they return bond face value BN to the old investors. So using new bond holders' money, they return old bond holders bonds and return the face value. Means this 15% tap is closed. They need not pay 15% now. Why? Because you have returned their face value back. Now this can be done only there is a call option in the bond. Call option means IDBI has got a right to call back the bond. Please give your bonds, take the face value. So this call feature will be printed in the bond document. So due to this call feature, IDBI was able to call back the old bond and return the face value. But for that IDBI needs money. Therefore, they issued new bonds first. So assume that 10,000 crores. So issue 10,000 crores, return the 10,000 crores, and this is gone now. Now you are paying only 12%. Now you can exceed. So you say, okay, SR, I am reducing your interest to 14% now. So now again IDBI will ensure 2% spread. So reissue of bonds means issuing new bonds, using the proceeds, returning the old bondholders' money. But is it beneficial? Is the benefit exceeding cost? And that is what you will find in the dedicated problem after this video. So reissue of bond is very important problem, and it is explained in detail when I solve the problem. So the concept is also covered there. But you know why reissue of bond arises. So reissue of bond will arise whenever interest rates in the economy falls. Why? Whenever interest rates in the economy falls, then this guy, that is who has who have taken loans from you, they will knock at your door. Look, we are paying more interest on loans. Please reduce our loan rate. Therefore, you will be forced to close this bond and you will have to issue new bond. So issue new bond and divert the money and close the old bond. And this problem is explained. Okay. The last part is convertible debentures. This you see in two parts. There is a formula video where everything is explained, and there is one problem where the payback period, the premium payback period is explained, because for others you don't require. So if you remember the formula, you can solve all the problems. Okay, so see the formula video and see the problem. It summarizes entire convertible debentures for you. Okay, as such, for general knowledge, convertible debentures are those debentures which provide a bondholder an opportunity to convert the bond into equity shares. And convertible debentures are traded in the market. Suppose at the time of issue or the public issue, you are unable to buy the convertible debenture, no problem. You can go to market and buy later on. So convertible debentures will give you an option to convert your debentures into equity shares. Till the time you convert, the convertible debentures will give you your coupons. Once you convert, you don't get coupons, you get equity shares. You become owner of the company, part owner of the company. So till the time conversion takes place, you receive income by way of coupons. After conversion takes place, you get dividend because you become shareholders. Okay, this is all about whatever you have in this chapter of bond market. As you saw, very lengthy chapter, and you will be saved only if you do this chapter very well. Look at all the formula, all the problems, then only you will be very confident. And as I tell you, so many things I have said. Okay, listen to me, pause, right, listen to me, pause. If you follow that, then you have made a good short notebook, and that you read in the last day. That is enough. Hope you got this. Let us now go to the next chapter, bond markets. Let us see all the formulae and concepts in this chapter. The first formula, as you can see, is the price of a bond. Now, price of a share is nothing but future dividend discounted. Price of a bond is nothing but future coupons. Whatever bond is going to give, you can see we are discounting coupons. In most bonds, coupons remain same throughout the tenure of the bond, and bond returns the face value at maturity. So if n is a maturity period, I get the face value back. So this is your face value, this is your coupon, this is expected rate of return, and this is bond price. So B0 is equal to each coupon you discount. First coupon you are getting discount one time. Second coupon you are getting at the end of second year, discount 2 times, and so on. So in a 5-year bond, we will have 5 factors, 5 terms, and the last term will be C plus BN. That is when you are getting coupon and face value. Now this can also be written using PV factors, and that is this formula. C into PVIF K% comma N plus BN into PVIF K% comma N. Now I am getting C every year, and I am getting for n years, and I am discounting every coupon using K. Since I am getting every year, I have this annuity A. So in the exam, sometimes they will give you PVIF A. So you must know how and where to use it. Similarly, face value of the bond which I get at the end, but I am getting only once, so there is no A here. And we discount by the same K, therefore PVIF, there is no A. AM. If it is a semi-annual bond, now just see here, this is coupon. In a semi-annual bond, suppose in an annual bond I get 10% per annum. In semi-annual bond I will get 5% 2 times. So it will become C upon 2. You can see here C upon 2 PVIFA, because I will get C upon 2 times in a year. If my annual expected return is K%, then for every semi-annual it will be K upon 2. Therefore we have K upon 2 here. Suppose I have a 5-year bond, annual coupon, then there will be 5 periods when I will get my coupon. But if I have a 5-year bond and I am getting 2 coupons per annum, then it will be 5 into 2, total 10 periods. So we have 2 into 5, then 2n. And I get face value at maturity, PVIF K upon 2n. Next, yield to maturity. Now what is yield to maturity? Now yield to maturity is that value of K. Yield to maturity is that value of K which, I have to find this value of K. Is that value of K where market price of the bond, so B0 market, matches the present value of all future cash inflows from the bond. Left hand side should be market, remember. Then only this K is called yield to maturity. So left hand side market price is equal to all cash inflows, that is coupon income plus face value discounted with that K, which is known as yield to maturity. Another important condition is you must have accounted for all the cash flows till maturity. Therefore, it got the name yield to maturity. So when you solve, you can find K. Now there are 2 ways you can find K. One is by interpolation method. This you can see in the problem section where I have explained the interpolation concept, because with numbers it can be easily understood, and I have explained the interpolation method there. And other is approximate method. Approximate method is, remember, I want to calculate yield to maturity. So what is a 1-year return? Every year I get coupon, so therefore we have C. Now B0 is the price paid today. Bn is the price we receive at expiry. B0 I am paying today, buying the bond. At expiry, issuer is giving you back the face value, that is Bn. So how much you earned? I earned Bn minus B0. So that is what is written here. But this I have earned over a period of n years. N is a tenure of the bond. So if I divide by n, so I get capital appreciation per annum. So I bought at B0 and I got Bn at maturity. So I got Bn minus B0 divided by N. So capital appreciation per annum. And I already got coupon per annum. So the numerator is total inflows from bond. And denominator should be investment. See, return on investment. So the numerator is return from the bond. Denominator is investment. Return on investment, that is yield. And what is the investment? Now we take the average of beginning and the last year. So we have Bn plus B0 upon 2. What is a zero coupon bond? A bond which does not pay any coupon. So you can just imagine this will get cancelled. This will get cancelled. This will get cancelled. This will get cancelled. Why? Because zero coupon bond. So everything will be zero. And this will also be zero. So then what happens? We get Bn upon 1 plus k raised to n. So zero coupon bond formula is Bn upon 1 plus k raised to n. What is a perpetual bond? Perpetual bond, a bond that pays coupon forever. Suppose C is a coupon this paid and K is the expected rate of return, then C upon K will be your price of the perpetual bond. Next we come to duration. Formula for duration of the bond. Now this is the formula which we can use if we want to calculate duration very fast. Let me explain this formula. Whatever cash flow the bond is giving, that is coupons and face value. For example, let us take a 5-year bond. So what is the cash flow bond is giving? Bond is giving coupon. It is giving 5 times coupon. And it is giving cash flow in the form of face value at the end of 5th year. Remember, I am taking 5-year bond. So it is giving me cash flow at the end of 5th year. When I get the first coupon, I get in the first year. So multiply by 1. When I get the second coupon, I get in the second year. Multiply by 2. Third coupon, I multiply by 3. Fourth coupon, multiply by 4. Fifth coupon and face value, multiply by 5. Discount the first coupon one time using K. So I discounted one time. Discounted 2 times. Discounted 3 times. Fourth one I discounted 4 times. Fifth one I discount 5 times. Add all of them. Take the total. Divide by B0. And this is what is duration. So if at all you want to calculate only duration, then this is the best way to do, provided you already know the bond price. Write the first coupon, multiply by 1, discount once. Write the second coupon, multiply by 2, discount twice. Write the third coupon, multiply by 3, discount thrice. Write the fourth coupon, multiply by 4, discount 4 times. Then whenever we have a face value in the 5th year, so add face value and coupon, multiply by 5, discount 5 times. Take the total, entire total divided by B0. Now B0, if it is not known, then we can use the table method. Table method is write the year, write cash flow. Take PV factor of K percentage. Calculate PV of cash flow. Then this is your weight. So multiply by weight into PV of cash flows. So let us call this total as A, this total as B. So B upon A will give you duration. So both the methods you should be familiar, but prefer the formula method if at all you want to save time. If I have a bond portfolio and if I know each of the bonds proportion where in terms of value, suppose I have two bonds in a single portfolio of bonds. One bond is 7 lakh, other bond is 3 lakh. The value I invested in one bond is 7 lakh. The value I invested in second bond is 3 lakhs. So total bond portfolio value is 10 lakh. So first bond proportion is 70%. Second bond proportion is 30%. So 70% into duration of first bond plus 30% into duration of second bond. So we can calculate duration of bond portfolio. Suppose you calculate bond duration using this, then this divided by 1 plus k. So if you do this, so this upon 1 plus k, it is popularly called modified duration. In the exam they have asked twice, calculate volatility of the bond. So volatility, calculate duration first, then divided by 1 plus k. So you have to remember this, do not forget. Let us see convertible bonds. There are various terms in this particular section of bond market. The best way to master these terms is to look at the problem which we have solved in the class. And in this revision video series, we have one problem which explains the toughest part of these terms, which are based on favorable income per share. So this one, what you're actually able to see here, these three are explained in that problem. So when you solve the problem after reading our notes, if you are able to crack it, then it's really good. Let me run through the terms. Conversion ratio is the number of shares per bond. Conversion price, this is the formula, face value of bond divided by conversion ratio. Conversion value, so whatever shares you are getting on conversion multiplied by current market price of share. Then conversion parity or market conversion price, they both have same formula, market price of convertible upon conversion ratio. Convertibles are traded in the market, so whatever price they are traded, that is market price of convertible. You have to divide by conversion ratio. Conversion premium, you are buying a convertible from market, divided by conversion ratio will give you market conversion price minus stock price will give you conversion premium. It can be calculated based on ratio also. Therefore, conversion premium divided by market price. State value is a term associated with convertibles. Assume that we have a convertible and believe that it doesn't have conversion option. Then it will be like a pure bond. Suppose you use the bond pricing formula and calculate the value of that, it is called state value. So state value is the intrinsic value of the bond as if there is no conversion option. Whenever they are asking state value, they will give you the discount rate which are supposed to use to calculate the price of the bond. Next is percentage premium over state value. Suppose I am buying a convertible at this, say 1020, and state value is given as 1000. So 1020 minus 1000 upon 1000, that is 2%, is a premium you have paid over state value. Now, sometimes they will ask, suppose the conversion option is lost because shares have become junk, then this 2% is gone. So sometimes they will ask you calculate percentage downside risk. Now here, depending upon the question, you have to be seeing carefully. Percentage downside risk means if you are losing conversion option due to shares becoming junk, then this premium 2% what you have paid over state value is lost. So we can use it to calculate percentage downside risk also. Suppose they are asking percentage downside risk on investment, then the denominator will be the market price of convertible, but that is rarely asked. So whenever they ask percentage downside risk, you can use this formula, but write that it is a risk which is faced by the bond convertible investor, and he assumes that the conversion option will not be available, and then you're supposed to use this formula. As I already said, the remaining three you will very well know after solving the problem which is given. Why I am telling you? Because there are a lot of variables, so we can't actually calculate in mind so many things. So therefore, I always believe convertible bonds are best learnt by keeping the formula on one side and by keeping another problem on one side. Solve them, link with the formula. So when you actually learn convertible bonds, keep the problem with you and test yourself one after another.